Hello. Very, very good morning, everyone. Not audible. Very good. Yeah. Now, first, let me ask live student also. Is the voice audible, everyone? Live student? Can you inform me fast so that we can start? Audio, everything is right? Yes, sir. Okay, everything is right. Now, before I start revision of CA final financial reporting, I hope everyone is for that only. And most probably everyone is for November 2024 exam. Now, before I start, one thing I just want to say that this revision lecture will be important, means will be beneficial if you actually take it as a point that you need to write exam and pass the examination. The intention should be that. Always whenever you take the classes, if you have the intention, the first point is required intention. What is your intention? Everything depends upon intention. Why we are here? Why we are here? We are here to pass the CA examination, whatever may be the question paper. Question paper may be easy. Question paper may be complicated. Question paper may be worst. Question paper may be out of book. Whatever may be the situation, we are here to pass. If that is the intention, then any class, any revision lecture will be beneficial. You are not supposed to be here that whatever I am teaching, that only will come. If that is the objective, then this class might not be beneficial in exam hall. Exam hall is totally different scenario. Question may come whatever I am teaching. Question may be out of whatever I am not teaching. Yeah, whatever I am not teaching, the question may be from there. A question may be from out of book. But the syllabus remains same, na? Concept remains same. Concept is not going to change. Whether any IND AS will change, whether any concept is going to change, concept remains same. The first factor what I have understood, that we means including me. I always say I am also part of student only, because we also came from that phase. We also experience everything whatever you are experiencing right now. We as a student always think that we should do a limited number of questions and questions should come from that and we'll pass. Then to everyone will pass. But we all know one fact. What is the fact? The CA examination is not for selection, it is for rejection. This fact we know. Yes or no? This fact we know or not? Bolo yes or no? Everyone say. This fact we know now. This examination is not for selection, this examination is for rejection. The best among you will become C, because the passing percentage is already defined. It is already defined that leaving the last attempt. Correct now? It is most probably 20-25%, not more than that. So we know that fact. So on that assumption, if you are taking any class, on that belief that yes, we are here to pass the examination, we are here to make out in this attempt, then only any class, any revision lecture will be beneficial for all of you. Got this point? So we should concentrate basically on concept. We should not focus on questions. However, of course, we'll take a lot of questions in this revision lecture, on the belief that if that question comes, we are at a higher stage. But if that question is not coming, if similar question is coming or a different question is coming, whether we are able to do it? Yes, we are able to do it. And if you are able to do it, it may be wrong, it may be correct. That you don't know in exam hall. Yes or no? You are attempting, so when you are attempting, you don't know whether it is correct or wrong. So you need to attempt it. one point is clear, the worst paper, the marks will be higher, because it is worst for everyone. A new question is a new question for everyone. It is new for a teacher also. Even I am writing exam in that attempt and a new question came, it is quite possible I am also not able to attempt, because that 3 hour our efficiency should be at highest level. So everything depends upon that 3 hours, how you are reacting in that 3 hours. Whatever you have done in the past, whatever you have done in the past, whether you have covered 100% syllabus 3 times, or whether you have covered only one time 100% syllabus, or you are 80% done. Sometime I have seen 80% done, you will pass, because that 3 hour you are at highest efficiency. You have done only 80%, but you will pass. You have done 100%, you will not be able to pass. Why? Because that 3 hours you are not able to perform. Got this point? It is in every game. Not only, I always say this is CA examination is a game of our life. We are here to play that game. So every game, whatever you are playing, suppose you are playing cricket match. So if your efficiency will be high at highest level, you will be able to perform. If your efficiency is not at highest level, even Virat Kohli will be out in zero, na? If his efficiency is not at highest level, even though he is a great cricketer, but last series he was failed. Correct now? At that point of time, it is quite possible that he was not at that highest level of efficiency. So everything depends upon your mindset, how you are thinking. Right now in this class, if your mindset is positive, believe me, you will be able to understand everything. You will be able to understand everything. And if your mindset is not positive, whatever I will say, you might not understand. So first, I just want one promise from all of you, that we are here to pass. Only one thing, means from now onwards, you will not say that I may fail. The moment this point will come in your mind, I may fail. The moment this point will come, then the probability to pass will be less. I am not saying that you will fail, but the probability will become less. You know probability. We have done IND AS 37. If it is probability, then we don't recognize, then to only disclosure is there. Yes or no? If the obligation is not probable, what will do? Contingent liability or provision? Contingent liability means we are not recording in our books of account. Therefore, ICA will not record you. If you are saying I will not pass, if that is coming in your mind, no matter whatever you have done, dekho, as a CA final student, I always believe that 80% you have covered. 80%, believe me, 80% you have done before exam. Yes or no? There will be a very less percentage student who have not studied only and going to exam hall. If you are going to exam hall, means you have studied. Yes or no? But the point is that have you studied, and whether you are positive about your life or not, whether you are positive about your approach or not, whether you are thinking that whatever question will come, this exam I am going to pass. If that belief you have, believe me, whatever question will come, you will be able to attempt. Attempt, I am saying. Whether it is wrong, it is correct, that I also don't know, you also don't know. But that belief is required, then only you can complete 100 marks paper in exam hall. And to pass any examination, 100 marks paper should be written. And it can be done if you are positive. That belief I require. With that, I just want to start the revision lecture. In this revision lecture, as I have already informed, that we will cover 5 important chapters of CA Final Financial Reporting. First is consolidation, then business combination. Consolidation, business combination from ICA point of view is 1 chapter. From faculty point of view, 2 chapters. From your point of view, 2 chapters. But from exam point of view, it is 1 chapter. Either question will come from consolidation or question will come from business combination, but it is not a trend. It is quite possible question is not coming from both chapters. A question may come from both chapters. It is quite possible. So don't select it. Last attempt consolidation, this attempt business combination. This is bakwas assumption. Okay. Don't go as per that trend. ICI is there to change the trend. So don't think in this way ki last attempt consolidation they have asked, so this time we will leave consolidation. Correct? Don't go as per that trend. Okay. So consolidation, business combination, and third chapter is financial instrument. One of the important chapter I say, because 20 marks is from that chapter. Consolidation, business combination also combined basis 20 marks, combined basis. Then revenue recognition, one second important chapter from student point of view, because this is one of the chapter where students actually are not comfortable. Why? Because this totally based on content. In this practical question you can write only when you know the content. If you don't know the content, you will not be able to write. And the last share based payment chapter is very simple. It is very simple. So in these 3 days our objective is to cover all these 5 chapters. These 5 chapters almost cover 50 to 60 marks of question paper. 50 to 60 marks of question paper. So what about balance? So whether you will not do balance chapters, of course I may plan some balance chapter in my later month, means maybe in the month of September or maybe in the month of October, but it will be totally YouTube live. That will be totally YouTube live. I may plan. I mean, till now not planned. Of course I will plan it. Correct. So balance chapter, if you want, it is already available in my YouTube channel for May 2024 attempt. So if suppose you want to complete right now only in this month only, so it is already available in my YouTube channel. And May 2024, November 2024, the syllabus remains same. So you can of course rely on that YouTube video also. Correct. But if you want live lectures, of course I will plan soon. But when I will plan that, I also don't know right now. Okay. So leaving about balance chapter right now, let us concentrate on what these 5 chapters. So you need to start, means what you want. I should start from which chapter? Because first day let us start from your point of view only. So we should start from which chapter? I will give you 3 options only. Huh? Consolidation, business combination, or financial instrument. Business combination. How many are saying business combination? Sir, please increase the volume. Now it is audible. We have increased the volume. Is it audible? Everyone please respond. Mic is okay. How many are saying business combination? How many are saying financial instrument? How many are saying consolidation? Oh, wow. So we'll start with financial instrument only. We'll start with financial instrument. Now in my video, if you have referred my video, when we have shared the information about this revision lecture, I have informed that I have shared in my Telegram channel some of the PDF. Have you taken printout of that? How many have not taken printout? So today you will take. Okay, understood? Go to my Telegram channel. Telegram channel is in the name of CA Chiranjeev Jain. Correct? There is one folder named FR Revision Chennai. Correct? So in that chapter I have given my concept notes, IND AS concept notes, then my handwritten notes which I have drafted only for your purpose, totally from examination point of view. And then last, expected questions. Expected question I have given for entire syllabus, but take a printout right now only for these 5 chapters. Okay, so we'll take expected question which I believe may come. I believe chances are probable, not, there is no virtual certainty of that. There is no virtual certainty of that. So it is probable. Okay. Now coming to financial instrument is one of the chapter where I believe normally students do calculation mistake. Normally I believe students do calculation mistake, and because of that calculation mistake, if you have done initial mistake, the initial mistake will be carried forward to the output of the answer. And what is the step marking? Step marking is that suppose step number 1, step number 2, step number 3, step number 4. Suppose there are 4 working notes, and if your working note number 1 is wrong, so working note 2 wrong, 3 wrong, 4 wrong, so how many marks you will get? 0 marks. So if you want to do mistake in working note number 4. Okay, don't do mistake in what? Working note number 1. So normally I have seen, what is my understanding from the analysis of past with my student answer paper, ki student know everything. Either they will do some calculation mistake or they have not understood the information only. They have not understood the information. Because they have not understood the information of the question, then they have done the mistake. But can I say for every question, if you want to write the answer, first you should know the concept. If you know the concept, then you can do it. Okay. Now, financial instrument chapter. Achha, one more point. How many of you are for the first time doing this chapter? First time. For the first time. Means your exam is November. Okay. So for the first time, I will just give one point that normally this whatever revision lecture, this is not designed for the first time student. Normally it is not designed. We take one assumption that you know the base of this chapter, because I will not define the financial asset, I will not define financial liability, because if I'll go for definition also, it will take a lot of time. Correct? So this is not recommended for first time student who is doing this chapter for the first time. But of course, if you have thoda sa knowledge, or if you can do a self study after this, then it will helpful for you. Means you need to do thoda sa, you need to put some little effort by your own. Ki after once I have done, just go to home, just do by your own, so everything will come in your mind. In that way it will help. But if you think that everything will understand in class, that is not possible. I will be clear about this point, and I should be clear to you also. Okay. Now this chapter, if I will say, so has small concept from which normally ICA asks question. So I will first concentrate on those concepts which are important from examination point of view, because you all know this chapter is very vast. If I start teaching, so normally in my regular class I take 40 hours to teach this particular chapter from the start to end. 40 hours I am saying. So that much hours we don't have, that much hours you don't have. So let us start with the concept. First concept which is very important from examination point of view, and the highest probability of exam the question may come, is compound financial instrument. Compound financial instrument are those instruments which have two components. One is what? Liability component. Second is what? Equity component. Means financial instrument is an instrument. Financial instrument is a contract. Financial instrument contract which will give rise to financial asset for one entity, and financial liability or equity instrument for another entity. Financial asset, financial liability, I hope you know the meaning. Correct? At the end, if you ask me, I can also take the meaning also. But financial asset, in simple word, I will say contractual right to receive cash. There is a contractual right to receive cash in simple word. However, we have detailed inclusive definition for that. Financial liability means there is an obligation, there is a contractual obligation to pay cash. Contractual obligation means if I say income tax payable, whether it is a financial liability. Income tax payable is not a financial liability because there is no contract. So this chapter will start with contract, because income tax payable is a statutory obligation that arises because of act. Because of act, so there is no contract. So any liability which is due to statutory obligation will not be covered in this chapter. So any liability or any asset which arises from contract will be covered in this chapter. Correct? Now, any financial instrument which have two components, one is liability component, one is equity component, that will be known as compound financial instrument. But as per the presentation given under IND AS, we will to present liability and equity components separately in our balance sheet. For that, we need to split it. So how to split it and what will be the accounting treatment, that we are going to understand in this chapter. Correct? It is covered under IND AS 32. Splitting is covered under IND AS 32. Accounting, recognition and measurement is covered under IND AS 109. Recognition and measurement is covered where? IND AS 109. Splitting is covered where? IND AS 32. Okay. But we will not do in that way. We will understand this is one chapter, one IND AS, and we will understand from examination point of view. Now, before I start compound financial instrument, you should know three rate of interest. Three rate of interest. There are three rate of interest. One is known as contractual rate of interest. Second is known as market rate of interest. Third is known as what? Effective rate of interest. Effective rate of interest. Correct? Normally students are confused with these three rate of interest only. What are these rate of interest? Contractual rate of interest will be as per agreement, as per the contract. Correct? So contractual rate of interest will be used to only identify or calculate contractual cash flow. Contractual cash flow. So whenever contractual rate of interest is given, it is given for what purpose? Bolo, repeat with me. To calculate contractual cash flow. It can be inflow, it can be outflow. Inflow for financial asset, outflow for financial liability. Understood? Second is market rate of interest. Whenever you want to calculate fair value. Fair value. fair value of financial asset or fair value of financial liability. You will use what? Market rate of interest. You will use market rate of interest, correct? So contractual rate of interest is for what? To identify contractual cash flow. Market rate of interest is for what? To calculate fair value of financial asset or financial liability. And the last one is effective rate of interest. This is used to calculate what? Interest, income or expense, and amortized cost. Amortized cost. Now what is amortized cost? I will explain. Amortized cost is nothing but carrying amount. Amortized cost is nothing but carrying amount. Carrying amount of financial asset or financial liability. Right now we are dealing with financial liability, but this concept will be same for what? Financial asset and financial liability. Can you repeat with me? Contractual rate of interest for what? To calculate contractual cash flow. Market rate of interest? To calculate fair value. And the last, effective rate of interest? To calculate interest and amortized cost. Amortized cost means what? Carrying amount. Means whenever I say carrying amount, you want what? Now, you want which rate of interest? Effective rate of interest. When I say fair value, you want what? When I say contractual cash flow, you want what? Correct. So it means these three will be given in the question. If not given, then what we are supposed to do, that we need to understand. Correct. Now following steps will be applied for accounting of compound financial instrument. First step is what? Identify proceed receive. Identify proceed receive means we are doing compound financial instrument, means we are doing from the point of view entity who has issued such instrument. Who has issued such instrument. For example, convertible debenture. So there are two parties. One is issuer, one is holder. So this we are doing from whose point of view? Issuer means the entity who has issued such instrument. This we are not doing from holder point of view. This we are not doing from holder point of view. Therefore, the issuer will receive the consideration. Whenever convertible debenture will be issued, so what will be received? Consideration will receive. That is known as proceed receive. So first we need to identify proceed receive. So proceed receive means what? Nominal value. You all know about nominal value. Face value, number of units multiplied by nominal value of face value. That become nominal value. Nominal value plus or minus. Plus means what? Premium. Minus means what? Discount. Correct. So plus premium on issue, not redemption. Premium on issue minus discount on issue. That will be what? Proceed receive. This is the first step. Normally student do mistake yahin par. I have seen. Now there will be one more point in your question, transaction cost. Transaction cost will not be deducted yahan se. Transaction cost don't deduct. Normally student deduct transaction cost from yahan se. So write down. Write down somewhere, even though you have not taken the print out, write down somewhere, because today you will take the print out na. You will take the print out. Okay. Those you have taken, very good. Those you have not taken, today only you will take the print out and then write down. Transaction cost will not be deducted. Here normally student do mistake. Okay, hello. Abhi right now only see me, okay? Don't see your friends. Either girlfriend or boyfriend. Only I am your girlfriend and boyfriend, okay? Consider me your friend right now. Say hi. Okay. Only full focus. Focus where? Only on me. Okay. Now proceed receive, understood? The first point where student do mistake, they deduct transaction cost from here. Don't deduct transaction cost from this. Correct. Second, once you have identified proceed receive, step number 2 is what? Identify contractual rate of interest. Here is the contractual rate of interest will be given in the question. If not given, it means it's 0. If not given means it is 0 rate of interest. If not given means 0 rate of interest. Understood? Correct. The contractual rate of interest will be always given in the question, because we are not making contract. Who is making the contract? Question draft. Who has drafted the question? So if not given, we can't assume any contractual rate of interest. Correct. The contractual rate of interest will be always given in the question. If not given means what? 0 rate of interest. 0 rate of interest. And calculate contractual cash outflow. And calculate what? Contractual cash outflow. Now how to calculate contractual cash outflow? That is one question. How to calculate contractual cash outflow? Now contractual cash outflow has two components. One is contractual interest payment and contractual principal payment. Contractual interest payment and contractual principal payment. Interest will be calculated on nominal value. On nominal value, correct? So interest will be calculated on nominal value, not on proceeds. Not on proceeds. Nominal value is what? Understood? If you have calculated proceed, so what was the formula? The formula, this is nominal value. correct? So nominal value multiplied by the contractual rate of interest, nominal value multiplied by contractual rate of interest, understood? As per the number of year, if that is redeemable after 5 years, the 5 year you need to calculate contractual interest, correct? Normally here also I have seen a student do mistake, they will take nominal value, instead of nominal value they will take proceeds. Instead of nominal value they will take what? Proceeds. High chances you have done mistake yahan also. Okay, so this you have understood. Now contractual principal payment. Contractual principal payment means what is the contractual obligation to pay principal amount on redemption date. Now they can be three types, they can be two type of instrument. Either it is redeemable. If it is redeemable, for example I have said redeemable debenture, it is redeemable. So whenever redeemable, it will be always classified as financial liability. But if it is convertible, means if I say convertible debenture, it is convertible. Now convertible can be either optionally convertible or compulsory convertible. Now optionally convertible, compulsory convertible. Optionally will be always classified as financial liability. Principal component will be always classified as financial liability. For example, I said optionally convertible and the holder has an option either to convert or redeem, then always classified as what? Financial liability. Initially it will be always classified as financial liability. Now compulsory means it will be 100% converted into equity share. Compulsory, no option has been given, but in compulsory there are 2 points. Either it can be converted into variable number of equity shares or fixed number of equity shares. Fixed number of equity shares, variable number of equity shares. Means right now when the contract was done, then it was said that we'll provide you variable number of equity shares or fixed number of equity shares. Means right now we don't know what is the number of equity shares in case of variable number of equity shares. If this is the case, it will be always classified as what? Financial liability, even though compulsory, correct? But if it is fixed number of equity shares, it will be classified as what? Equity instrument. Have you understood? Correct? One second, can you repeat with me in your mind? Contractual principal payment, if redeemable then? If convertible, optionally then? Optionally variable then? Optionally fixed then? First guy. Optionally always what? Classified as financial liability. Okay? I know where you can do mistake. Understood? One second. Repeat with me. We are doing contractual principal. Redeemable then? Optionally then? Optionally variable then? Optionally fixed then? Financial. Compulsory variable then? Compulsory fixed then? Till now no question of this nature have been asked in exam. Means no question of this nature has been given ICA study material. But ICA can change, then you can say out of book will not do. Any situation you need to attempt. If you know, can I say you can attempt now? If you know, you can attempt because the process will remain same. Now once it becomes classified as financial liability, so it means you need to find out contractual payment amount. If it is financial liability, there is an obligation to pay. So this will be either redemption value or conversion value. Conversion value in case of variable number of equity shares. Conversion value in case of variable number of equity shares. Suppose it is given that it will be converted into equity share worth rupees 40 lakh. Suppose it is given that convertible debenture will be converted into variable number of equity share worth rupees 40 lakh. So what is the conversion value? 40 lakh. So you will take conversion value. Redemption value will be what? Redemption value means nominal value plus premium minus discount. But plus premium on which date? On redemption date. Discount on which date? On redemption date. Of course, plus premium on redemption date. On redemption date. Understood? Okay. Here, can I say if you have done mistake to identify contractual cash outflow, whatever you are doing after that, that is of no meaning. So this area, if you are doing mistake, then after that everything is wrong. So one second. Identify contractual rate of interest. That will be always given in the question. If not given, then 0. Calculate what? Contractual cash outflow. Contractual cash outflow has how many components? 2 components. Interest component and principal component. Interest component will be nominal value multiplied by contractual rate of interest. Contractual principal payment. Redeemable, optionally convertible, compulsory convertible, variable number, fixed number. Now, if it is classified as financial liability, then what is the contractual cash outflow? redemption value or conversion value. But if it is classified as equity, redemption value, what is the contractual payment? Nil. Then the contractual cash outflow is nil. Na? If I am saying it will be convertible into fixed number of equity shares, then there is no obligation to pay any amount. Then your contractual cash outflow will become zero. Contractual cash outflow becomes zero. I have seen students do mistake at this point also. They will not take nil, they will take principal amount. In exam, you know everything, but in exam you will do mistake. Once you have done this, step number 2 over. If you say yes, then I will proceed. Any doubt, raise your hand. Once again I will say. Step number 2 over. Once you have identified contractual cash outflow, now step number 3 is what? Identify market rate of interest. This will be always given the question. If not given, question is wrong, because we can't go to market in exam. Can we go to market? So if market rate of interest is not given, then question wrong. Then attempt it, full marks will be given. Whenever question is wrong, and if you are attempting, then full marks. If you are not attempting, then 0 marks. So whenever question wrong, attempt it. Understood? However, they will provide. They will provide. Don't think, acha sir. Okay. So market rate of interest is not given, means question wrong. It will be always given in the question. The market rate of interest will be given in the question. It will be given as a rate of interest without conversion option. Without conversion option. So whenever rate of interest is given without conversion option, means they have given only for liability. Only for liability, that become the market rate of interest for liability component. Liability component. So identify market rate of interest and calculate fair value of liability component. Fair value of liability component. Now to find out fair value of liability component, you want which rate of interest? Market rate. Therefore you need to identify what? Market rate of interest. Understood? Now what do you mean by fair value of liability component? This is equal to present value of contractual cash outflow discounted at market rate of interest. Can you say present value? So you are expert. Contractual cash outflow already you identified. You can do present value. Present value you are expert. In that I am not supposed to say anything. So fair value of liability component will be equal to present value of identified in which step? Step number 2. Discounted at market rate of interest. In this normally students don't do mistake. If market rate of interest they have taken. Step number 4 is what? Calculate fair value of equity component. So what is the fair value of equity component? Find out proceed receive. Already we have done step number 1. Proceed receive minus what? Fair value of liability component. The balancing figure will be what? Fair value of equity component. Understood? This is the formula given by IND AS 32. IND AS 32 has provided this formula. First find out proceed receive minus fair value of liability component. The residual amount will be what? Fair value of equity component. Understood? Correct. After this you need to identify transaction cost. Transaction cost. Normally out of 10 questions, only in 1 question in ICS study matter they have given transaction cost, and that is one of the popular question of exam. In 1 question, 9 questions they have not given transaction cost. In 1 question they have given transaction cost. Correct now? And that is only important question from exam point of view. So identify transaction cost. If given, if not given means 0. Then this step is not applicable now. Then this step is not applicable. To identify transaction cost, if any, given in the question. Correct. If transaction cost is given, then what IND AS 32 say that transaction cost will be allocated to both component. Both component in the ratio of their fair value. In the ratio of their fair value. Fair value already we calculated in step number 3 and step number 4. So allocate transaction cost to liability component and equity component in the ratio of their fair value. So liability component write down, equity component write down, fair value write down, transaction cost total write down, total transaction cost. That will be given. The total transaction cost will be given. Suppose they have given 3% of proceeds or 3% of face value, whatever given, that become the transaction cost. This will be allocated in this ratio. You have calculator, you can allocate. You have calculator, you can allocate. And this become net profit. You will do plus ki minus. Plus ki minus. Minus. Because this has been received and this has been paid. So this is minus, this will become equal to. So this become net profit and we'll do journal entry with net profit. Means now the initial journal entry, the first journal entry will be done with the net profit. Net profit, not with the gross profit. This become gross profit, this become net profit. So what will be your first journal entry? First journal entry means on the date when the contract was made, when the instrument was issued. Correct? On that date, bank account debit to financial liability to equity instrument. Understood? Have you understood? Correct. This is with net profit. This is with net profit. This is with net profit. But suppose transaction cost is not given, then this step is not applicable. Then you are doing journal entry with this, huh? If the transaction cost is not given, then this becomes 0, 0. So net profit is equal to gross profit. Understood? Then I hope you are able to understand my emotions also. Got this point? So initial journal entry is this. Up to this, question may be asked for 2 marks in MCQs. Up to this, question may be marked for 2 marks in MCQs. They will say identify the financial liability on initial recognition. 2 marks MCQ good question. Only calculate a fast. Understood? Then after this, if they are asking, then it become a better question for 6 marks, 8 marks, 10 marks, 40 marks, depending upon what they are asking. Depending upon what they ask. However, up to this, they may ask a question of 5 marks or 6 marks also. Correct? If they ask journal entry also. Correct. Then after this, step number 6 is identify effective rate of interest. So first you have identified contractual rate of interest, then identified market, then effective rate of interest. So effective rate of interest means what? Just first ask one question. Is the transaction cost given? Is the transaction cost given? If no, then effective rate of interest will be equal to what? Market rate of interest. It means they will not provide an effective rate of interest, because effective rate of interest will be equal to what? Market rate of interest. Means out of 10 questions, 9 questions they have not given EIR. Why? Because there was no transaction cost. Correct? But effective rate of interest, they have become what? Equal to market rate of interest. But if transaction cost is given, then effective rate of interest will not be equal to market rate of interest. It means we need to identify effective rate of interest. 99.9% effective rate of interest will be given in the question. Only 0.01% chance is that they have not given. Then we need to calculate what? Effective rate of interest. Understood? So if if effective rate of interest is not given in question, then calculate effective rate of interest. If given, thank you very much. 99% it will be given. 1% or less than 1%, I will say it might not be given when they want to trouble you. When they want to trouble you. Correct? So if not given, then calculate. And how to calculate it? How to calculate it? Can you see? Because this was the present value based on what? Market. But now it become net profit. So of course your effective rate of interest will change, na? Are you getting? Because this was the present value of contractual cash outflow at market rate of interest. Yes or no? Are you getting what I am saying? This was. But now it become net profit because of our transaction cost. So we need to find out one rate of interest at which present value of contractual cash outflow will be equal to what? Net profit of financial liability. Means use the IRR concept. What you have done in AFM or FM. IRR concept. You know IRR? Correct? So you need to find out effective rate of interest at which the rate of interest at which present value of contractual cash outflow of liability is equal to net profit of liability component. And if you know IRR concept, you can do it. Take 2 rate of interest. One is higher, one is lower. You know the IRR concept, that you can apply. But 99% it will be given. So up to step number 6, have you understood? So can you repeat with me once again? Step number 1 is what? Step number 1, identify profit. Profit is equal to what? Nominal value plus minus premium discount. Plus minus premium discount. What you are not supposed to deduct? Step number 2 is what? Identify contractual rate of interest and calculate contractual cash outflow. Interest component, principal component. Interest component will be nominal value multiplied by contractual rate of interest. Principal component, redeemable, financial liability. Convertible, if optionally, then financial liability. If it is compulsory, variable number equity share, then fixed number equity share, then equity. If it is liability classified as financial liability, then we need to find out contractual cash outflow. It will be either equal to redemption value or conversion value. Redemption value means what? Nominal value plus premium minus discount at the time of redemption. If it is fixed number equity share identified as equity, then contractual cash outflow will be equal to 0. Then step number 3, identify market rate of interest. That will be always given a question, and calculate fair value of financial liability. Fair value of financial liability component, fair value of liability component will be equal to present value of contractual cash outflow discounted at market rate of interest. Step number 4 is what? Calculate fair value of equity component. Proceed minus fair value of liability component will be equal to fair value of equity component. Then identify transaction cost. It may or may not be given the question. If given, then we need to allocate transaction cost in the ratio of fair value of both component. Correct? And deduct from both component, will find out net profit. With this net profit, will pass our first journal entry. First journal entry will what? Bank account debit to financial liability to equity instrument. Then identify effective rate of interest. If transaction cost is not given, then Now, effective rate of interest will be equal to what? Market rate of interest. Don't say ulta. Market rate of interest is not equal to effective rate of interest. Effective rate of interest will be equal to what? Market rate of interest. Correct? Yes, sir. If yes, acha thoda Hindi you know na? Anyone who don't know Hindi at all? But thoda I can, just thoda. This I can use na? Huh? Little. That is habituated. Okay, take it. So if you are not able to understand, raise your hand. I will translate in English, but I will not use. Yes, effective rate of interest will not be equal to market interest. Then what? In this case, means when the transaction cost is given, then effective rate of interest will not be given as. Sorry, effective rate of interest is not equal to market interest. Effective rate of interest will be given in the question. If not given, then calculate. How to calculate? IRR concept. Correct. Then step number 7 is what? This is last step for this. Calculate interest expense and amortized cost by applying what? Effective rate of interest. Effective rate of interest. This is the format. Year 1, 2, 3, 4, 5. How many years are there? Then opening balance to opening liability. Opening liability will be what? Opening liability will be this amount, na? This amount. This amount. Opening liability. Chalega? This is opening liability. Okay? Opening liability, then plus interest expense calculated by applying effective rate of interest, then minus what? Contractual cash outflow. This become closing liability. Closing liability means amortized cost. Closing liability means amortized cost. This closing liability will become opening balance, then continue. Then at the end, of course, it will become nil. At the end, of course, it will become nil. Subsequent recognition. So year end, at every year end, we'll pass one journal entry for interest expense and payment. So what is journal entry for interest expense? Interest expense account debit to financial liability. With what amount? With this amount, na? With this amount. These are the interest expense. Chalega? Understand? Then payment, financial liability account debit to bank. With what amount? Contractual cash outflow. So if you have done the table, can you see easily you can pass the journal entry? Table is must working note. Even the question is silent about calculation of interest expense. Do working note of that. If you are not doing working note of amortized cost table, you are not given marks for that. So this working note is compulsory, even though they are not asked. Compulsory working note. Compulsory working note. And in table format only. Do in table format. Chalega? Then settlement accounting. Settlement accounting thoda sa interesting hai. In case of optionally convertible financial instrument. Can you see if compulsory, then the financial liability becomes 0 at the end. And for the conversion portion will issue equity share. But if it is optionally convertible financial instrument, optionally convertible, so it becomes as per the option taken by holder. Correct now. So if holder offer cash settlement on conversion, yeah, on settlement date, they say will demand what cash? They are demanding cash, means redemption. Then what journal entry? Financial liability account debit to bank. Financial liability will become 0. And can you see equity component will be closed and transferred to what? Retained earning. So that equity component, which equity component? This equity component will be transferred to which account? Retained earning. Means what is the subsequent? We never do subsequent, no subsequent measurement, right now? No subsequent measurement. Means equity component will remain as per the same carrying amount every year. Will not do subsequent measurement for equity component. So equity is never subsequently measured. Only financial liability and financial asset are subsequently measured. So can this become opening balance? This only become closing balance every year. This is the opening balance as well as what? Closing balance. So at the end, when we debenture holders or any holder opted for cash settlement, then equity component account will be closed by transfer to what? Retained earning. So what journal entry you will do? Journal entry equity instrument account debit to retained earning. This is simple. But suppose holder opt for equity settlement, then can you say financial liability account will be settled by allotment of equity shares? Financial liability account will be settled by allotment of equity shares. Only the principal portion, because interest portion has been paid. Interest portion has been paid. So financial liability account debit to equity share capital towards securities premium. Means this will come at nominal value of equity share capital. The balancing figure will be transferred to what? Securities portion. And can I say equity instrument 1 second will be transferred to retained earnings. Correct. So what journal entry you have done? Can you see me? Financial liability account debit to equity share capital to securities premium. Balancing figure will be transferred to what? securities premium. So this is nominal value. Any balancing figure will be transferred to securities premium. Got this point? Okay, this will depend upon number of equity shares. Sometimes the question does not provide number of equity shares, or they don't provide a nominal value of equity shares. Then we write on equity share capital plus securities premium. Suppose they have not given nominal value, so can you split it? Suppose they have not given nominal value of equity share, can you split it? So what ICI is doing in their study material, they are writing 2 equity share capital plus securities. Together they are writing, correct only. Or you can assume nominal value is equal to 10. You can take that assumption also, but as per IC solution, what they are doing, 2 equity share capital plus securities premium they are writing. But if they have given nominal value, they have given number of equity share, you can find a nominal value. Then balancing figure will be transferred to what? Securities premium. And equity instrument account will be closed by transfer to retained earnings. But in recent solution, this journal entry can be modified also. We can do this journal entry also. This journal entry is also correct. Financial liability account debit, equity instrument account debit, 2 equity share capital, and balancing figure will be transferred to securities premium. This is also correct. So in some of the question they are doing this journal entry. In some of the question they are doing this journal entry. Both are acceptable. Both are acceptable. Whatever you want, you can do it. Don't be confused with my explanation, because in some of the question they are doing this journal entry, some of the question they are doing this journal entry. However, as per IND AS, there is no securities premium account. As per IND AS accounting, entire process will be transferred to equity. So there is only equity account. But because of our Companies Act, our Bakwas Companies Act, they say nominal value and premium. Premium is coming only because of what? Companies Act. Can Companies Act, can IND AS, whether IND AS can override the requirement of Companies Act? No. And therefore we are following what? Companies Act. So this accounting we have done as per Companies Act, not as per IND AS. IND AS says whatever profit received for equity, that will be transferred to equity. So there is no concept of premium under IND AS. So this journal entry we are doing as per Companies Act. Chalega? Yes sir. But whatever, either you are doing this journal entry or you are doing this journal entry, your equity will remain same. Your equity will remain same. Done. This is one part, concept number 1 done. If I take one question, better understanding will come. Better understanding will come. So come to one question. Expected question में आ जाओ. Financial instrument. So I have taken one good question. This question may or may not be asked, but similar question will be asked. Chalega. Question 40. This question 14 is of my question bank. Correct? ABC company issued 10,000 compulsory cumulative convertible preference share. Compulsory cumulative convertible preference shares as on 1st April 2001 at rupees 50 each. The rate of dividend is 10% payable every year. Means dividend is what? Payable. So there is a contractual obligation to pay dividend amount. So here dividend is fixed. In any case, we need to pay dividend. So can you see here why it is compound financial instrument? Because there is compulsory convertible. There is no obligation to pay principal amount. And there is an obligation to pay dividend amount. So one component there is no obligation. For other component there is a obligation. So it has two components. One is equity and other is liability. Correct? The preference shares are convertible into 5,000 fixed number of equity shares. Fixed na? Fixed. But it will be classified as financial liability, equity. Principal portion, interest portion. Principal portion. Interest portion is payable. Dividend portion is payable. Na? Correct. It is fixed number of equity shares. Till now, no question of variable number of equity shares has been given in ICS study material. But they may ask, they may say variable number of equity shares. Then it will be classified as what? Financial liability. Then it will be classified as financial liability. If you know the concept, you can do it now. Even the new question, you can do it. Yes or no? If you know the concept is important than question. Concept is important than question. Question you can do only when you know the concept. 5,000 equity share of the company at the end of 5th year from the date of allotment when CCCPS issued. The prevailing market rate of interest is given how much? 15%. The transaction cost is 2%. Transaction cost is given. So we want what? Effective rate of interest. In this case, effective rate of interest will not be equal to market rate of interest. So in this question, you can see they have given effective rate of interest for liability component 15.86. Everything is given. Correct. Now, first we'll identify what profit. What is the profit? 10,000 into 150. How much? 15 lakh. 50 lakh. So 15 lakh is the total profit given in the question only. From this, whether you deduct transaction cost, deduct करो, मजा आएगा. Deduct ना, deduct. हाँ देखो, yes sir. If deduct then मजा, and that मजा will become सजा. Correct. Normally student do mistake यहीं पर, because transaction cost ना, transaction cost given, they will deduct what? Transaction cost from profit received. Don't deduct. Okay. So 15 lakh. Then what you will do? Second step is what? Identify contractual rate of interest. Whether contractual rate of interest given, how much? Well, you say, I will not say. 10%. 10%. So we need to identify interest component and principal component. Principal component will be what amount? Hat nalayak. It is compulsory convertible. Principal component compulsory convertible na. So compulsory convert. What is the contractual cash outflow? Nil amount. Contractual cash outflow is nil amount. So for principal component, contractual cash outflow is nil amount because it is compulsory convertible. Here also student do mistake. Correct? Understood. And then liability component, it will be 15 lakh into 10%, 1,50,000 every year. For how many years? 5 years. So your contractual cash outflow become 1,50,000, 1,50,000, 1,50,000, 1,50,000, 1,50,000. And for principal component, what is the contractual cash outflow? Everyone will say. No one will remain silent. I said in the first starting, if you have intention to pass, then only you will pass. So don't remain silent. If you are silent, means you are not understanding anything. Correct? Even though you are not understanding, say something. So I will say, na, acha, you are not understanding. I will repeat that point. So say anything. Okay? Correct? Okay. So liability component is what? 1,50,000 every year. Principal component is what? 0. Understood. Chalo. Now, once you have identified this, then we'll identify what? Market rate of interest and calculate fair value of liability component. What is the market rate of interest? 15%. So you will find out present value of contractual cash outflow at what rate? At 15%. So what is it? 1,50,000 payable for how many years? So you will do 1,50,000. 1,50,000 into present value annuity factor. Annuity factor at what rate? 15% for how many years? 5 years. Can you give me annuity factor? Annuity, you have given present value. So present value is coming how much? It is coming how much? Where is the working note? They have done one working note, not done. Okay. So it is what coming? 5,02,823. 823. Exactly same. ठीक है ना, माफ करो. Decimal we donate. We give some charity donation. Okay. Okay. So 5,02,820. Now one doubt come normally in exam. Ki sir, we should use 3 decimal, 4 decimal, या unlimited decimal. बताओ what you will use? 3, 4, unlimited or 2? ठीक है. देखो whatever you are using, write down that. If you are using 2, write down 2. If you are using 3, write down 3 decimal. If you are using 4, write down 4. Means don't write formula and do in calculator. If you are using unlimited, write down unlimited. That you will not write. So either 2, 3 or 4. From my point of view, 3. In every question, whether it is AFM, FR, present value, 3 decimal. Ek standard rules. But write down. Whatever you are using, write down. Understood? So that they can understand that you have used how many decimal? 3 decimal or 4 decimal or 2 decimal. 2 decimal I don't prefer. Because that will not be accurate amount. That will not be accurate amount. And however, ICI has used. ICI has used. If the annuity factor is given, then use the given only. Suppose they have given 0.909. Now we are habituated. We'll use 0.9091. So whether they will give marks? 0 marks. So if they have given information, respect that information. You respect the information given in the question. Even though that information is wrong, use that information only. You can't change the information given in the question. You can't change the information given in the question. You don't have right to change the information given in the question. So wrong information given, take wrong information but do it. Chalega? Yes sir. So in this question it was not given. So 3 decimal kar lo. I think this amount is coming. Then we can find out once fair value is calculated. The next step is what? Calculate equity component. Equity component will be profit minus liability component. Profit is what? 15 lakh minus 5,02,823. This will be equity component. This will be equity component. That हो गया. Then identify what? Effective rate of interest. No. Then identify transaction cost. In this question, there is a transaction cost, and the transaction cost will be allocated to what? Both component in the ratio of the fair value. So transaction cost was 2% of proceed received, whatever given. 2% of 15 lakh, how much? 30,000. This 30,000 will be allocated in this ratio, and allocation you can do in calculator. So this become this minus this become net profit. With the net profit will pass first journal entry. What will first journal entry? Bank account debit how much? Bank account debit 14 lakh 70,000. To financial liability how much? 4 lakh 90,767. To find equity component, equity instrument how much? How in exam write down in this way? Bank account to 10% CCCPS. Financial liability in bracket. To 10% CCCPS. Equity instrument in bracket. In exam, do the journal entry this way. However, if you are doing financial liability also, they will give marks. But use the standard way. Have you understood this point? Bolo. Any doubt? Up to this. Once you have calculated this transaction cost, net profit, the next step is what? Identify EIR. Is the transaction cost given? Yes. Therefore, EIR will not be equal to market rate of interest. We need to find out EIR, and EIR is given in the question. What is the EIR? 15.86. So 15.86 given. Thank you very much. Even though it is not correct, can you change it? Will you recheck by calculating IRR, by using IRR concept? Don't recheck, huh? It is wrong, it is correct. You are not supposed to think that. 15.86 use. Because they have given. They have given. Now you will prepare this table. This table is very simple. Opening liability plus interest. Interest by using which rate of interest? 15.86. Then minus 1,50,000. This will become what? Closing liability. Then at the end, because it was compulsory convertible, the entire financial liability will become 0. Entire financial liability will become 0. What is the first journal entry? Bank account debit. To preferences liability, you can add on our journal entry, whatever I have said. In IC has used different journal entry in different questions. But this is financial liability, this is equity component. Correct. Then interest expense account debit to financial liability. Then financial liability account debit to bank, financial liability account debit to bank. Then same journal entry will be done. Then at the end you will convert what? The principal component to equity shares. What journal entry? Equity component means equity component of preference shares account debit to equity share capital to securities premium. There was 5,000 equity shares of rupees 10 each. So 50,000 balancing figure has been transferred to securities premium. Done. Concept. Have you understood? Now any question of this nature, if you know the concept, we can do it. New question come, if you know the concept, you can do it. If new question is coming, why you say leave it? Do it how much you have understood. You don't decide whether you are doing correct or wrong. Who will decide? Who is checking your paper? You believe in yourself that you are doing correct only. That much faith you should have. You should have faith on your ability. You should have faith on your ability. Whatever you are doing, it is correct, and do it. Chalega? Correct. With this question, I think the concept number 1 is done. Second concept, which I am expecting in this exam, concept number 2 is what? Equity settlement, early settlement for compound financial instrument. Early settlement. Early settlement means in the last question it was to be convertible. It was to be converted after 5 years. But suppose something happened and now entity decided to redeem or buy back before 5 years. Understood? They want to redeem or buy back the instrument before 5 years. That is known as early settlement of compound financial instrument. Early settlement of, so that is known as buyback. Normally one question has been given for buyback, or it can be early redemption also. It can be early redemption also. Chalega. So in that case, what will be the step to follow? First step, find out the amortized cost, या carrying amount of financial liability on early settlement date. Yeah, we can say repurchase date. You can find out by applying all the concept, whatever we are doing in concept number 1. First splitting, then amortized cost table last step, that we can do. But on which date? Up to which date? Up to early settlement date. Suppose they have decided to buy back the entire instrument at the end of 2nd year. तो you will find out carrying amount at the end of second year. चलेगा. तो calculate amortized cost, AC means amortized cost of liability component on the date of repurchase by applying concept number 1. Of course you can do it. You can do it. Then step number 2, can I say when we are doing buyback, so some consideration will be paid. So that consideration paid will become the fair value of that compound finance instrument on the date of repurchase. So suppose they have agreed to pay 1 crore to buy back the entire instrument. So that 1 crore become what? The fair value of that compound finance instrument on that date. So that fair value is for both component, liability component and equity component. That requires splitting. So we need to split. Now you will say how to split. Can I say that fair value, whatever consideration has been paid, that will be split into two components, liability and equity component. So what will be the fair value of liability component? That will be present value of remaining contractual cash outflow. Present value of remaining contractual cash outflow. Discounted at what? Discounted at what? 3 options. Contractual rate of interest, EIR, ki market rate of interest. Understood what I am saying? 1 second. 1 second. Those who are not able to understand, 1 second I am repeating. First step, have you understood? Anyone who have not understood first step? Understood. Second step we are doing. So whatever consideration is paid on the date of repurchase, that become the fair value of compound finance instrument. So that fair value of compound finance instrument will be split into two component, liability and equity, because some consideration is paid for liability and some consideration has been paid for equity. So how much consideration is paid for liability and how much consideration is paid for equity, that we need to identify. So for that we need to find out fair value of liability component on the date of repurchase. We need to find out fair value of liability component on the date of repurchase. That will be equal to present value of remaining contractual cash flow on the date of repurchase. Present value of remaining contractual cash flow on the date of repurchase. Discounted at what rate? Discounted at which rate of interest? Contractual rate of interest, how many you are saying? Contractual rate of interest. Effective rate of interest. Raise your hand. Market rate of interest. Most of you are saying correct. Market rate of interest. Already, 1 second. Those who are saying EIR, kasam khao. Well, God promise. This is only the concept. This first point. For fair value, we'll use what? I said we are here to calculate fair value of liability component on the date of repurchase. You will not use what? EIR. You will use what? Market rate of interest. Which rate of interest? Market rate of interest. Understood? Have you understood? This is the concept. Concept I have given initially only. If you have understood this, you can do all the questions. These 3 is only the crux of this chapter. And normally students are confused with these 3 only. Understood? So 1 second. Those who have said wrong, we are here to calculate fair value of liability component on the date of repurchase. That will be equal to present value of remaining contractual cash outflow on the date of repurchase, discounted at market rate of interest. Now second question, market rate of interest on which date? On initial date ki on the date of repurchase? Initial date ki on the date of repurchase? How many are saying on initial date? Everyone saying on repurchase date, means they will give a new market rate of interest on repurchase date. So current fair value will be based on current market rate of interest. If market rate of interest will change, the fair value will also change. Very good. This too you have applied common sense and I have said that you have done correct. So identify fair value of consideration paid for the buyback. Step number 2 we are doing. Identify the fair value of consideration paid for buyback of compound finance instrument. This will be given in the question. This will be given in the question. This will be given in the question. And such fair value will be allocated, I have not written, will be allocated in liability component and equity component on repurchase date. Will be allocated to liability component and equity component on repurchase date. Formula is what? Fair value of consideration paid minus fair value of liability component on repurchase date. The balancing figure will be fair value of equity component on repurchase date. Same formula, splitting formula, but how to calculate these? This will be fair value of liability component repurchase date. This will be present value of remaining contractual cash outflow discounted at current market rate of interest on repurchase date. This will be always given. If not given, this question is wrong because we can't go to the market. then take assumption and do whatever you want to do, they will give marks. Understood? But it will be given. Can I say you can calculate easily because you are good in discounting? Discounting, though you are good. Then in this case also there can be some transaction cost paid, because when you are doing buyback, some transaction cost may be incurred. Till now no question of this nature has been given in ICA study material, but suppose transaction cost given, what you will do? Suppose transaction cost on buyback is given, what you will do? Apply common sense. Transaction cost given, what you will do? Allocate to both components in the ratio of, in this ratio you will allocate. So any transaction cost paid on buyback date will be allocated to both components in the ratio of their fair value, that we know. Same thing, but no question of this nature has been given. So any transaction cost paid on repurchase date will be allocated to liability and equity component in the ratio of their fair value, current fair value. Once you have calculated it, whether it will be added or deducted? Added or deducted? Whether this was consideration paid or consideration received? Consideration paid or received? Paid. And transaction cost is paid or received? Paid or received? So both are paid. So you will add or deduct? Add. Think and say. Think and say. Everything you know. But you think and say. Don't say suddenly. We see always think, process and then say. We see always think, process and say. So first process it, then say it. Okay? Chalo, you know everything, but for time required. So this transaction cost, if given, you can allocate and then you can add. And then can find out the proceed paid. That I have not given because no question of this nature. Chalega. Then we need to, the last step is what? We need to find out gain or loss on repurchase. Gain or loss on repurchase. So we need to do total liability component, equity component. This is relevant. Now consideration paid, already we have allocated. Consideration paid already we have allocated. Transaction cost paid, so that is also added here. If transaction cost paid already we have added. Correct? Yes. Less carrying amount. This carrying amount also we have calculated for liability component in step number 1 only. What will be the carrying amount of equity component? Same. Carrying amount of equity component will remain same because there is no subsequent measurement of equity component. This will be gain or loss on repurchase. This gain or loss of liability component will be transferred to what? PL. Will be transferred to PL. So any gain or loss of liability component will be transferred to what? PL. But any gain or loss of equity component will not be transferred to PL. That will be adjusted with what? Retained earning or other equity. Retained earning or other equity. So this will be adjusted in what? Other equity. You can say retained earning directly. So journal entry for repurchase of liability component, what? Financial liability account debit to bank. The difference will be transferred to gain or loss. That gain or loss will be transferred to PL. For repurchase of equity component account debit to bank, any difference will be transferred to other equity. Other equity can be retained earning. This is one of the good questions which they have asked in exam, but recently they have not asked. Can be asked, expected in exam. Can we take one question based on that? Question number 18. Question number 18. On 1st Jan 1999, A Limited issued 10% convertible debenture with a face value of rupees 1000 maturing on 31st December 2008. 10% is what? Contractual rate of interest. This 1000 is what? Face value. If they have not given discount premium, then this is what? Proceed. Proceed and nominal value remain same. The debenture is convertible into equity shares of A Limited at a conversion price of 25 per share. Fixed key variable. Fixed key variable. They have given conversion price 25. So 1000 divided by 25. How much? 40. But the fixed key variable? Fixed now. It is fixed now. Conversion price is given. If conversion price not given, then it becomes what? Variable. It is fixed only. No question of variable given, I have already said. No question of variable given till now. But 100%, some attempt they will ask. We don't know which attempt. But if you know the concept, you can do it. If you know the concept, you can do it. Correct. 1000 divided by 40, this is fixed only. Interest is payable half yearly in cash. Half yearly, dangerous. Half yearly. So interest payable half yearly. If you are not reading the question carefully, you will do annually because we are habituated of that. At the date of issue, A Limited could have issued non-convertible debt with a 10-year term bearing coupon interest rate of 11%. 11% is what? Market rate of interest. If because it is half yearly, can you see this become 5.5% and this become 5%. So half yearly to divide by 2, divide by 2. There is no transaction cost given in the question. There is no transaction cost given in question. Therefore, ER will be equal to, so it means effective rate of interest will be equal to 5.5%. Always first you identify these three. Always identify these three: contractual rate of interest, market rate of interest, and effective rate of interest. Now, okay, this is the first part of the question. Splitting you can do. Splitting you can do. Only in this question one doubt will come. It is compulsory convertible ki optionally convertible. It is only one doubt will come. It is compulsory convertible ki optionally convertible. Bolo. Understood doubt? In exam this doubt will come. Abhi to right now I am with you. You will not think. But in exam to you will think na. Compulsory optionally. Question is silent, you can say. Question has not given compulsory, yeah, optionally. So as per ICI solution, as per ICI assumption, whenever question is silent, always assume optionally. Always assume optionally. As per ICI solution, as per ICI assumption, always assume optionally. Of course, you can take assumption compulsory, but I don't know whether they will give marks or not. That assumption is also correct. But why to fight with ICI? We are here not to fight with ICI, we are here to score marks. Correct? We are not here to fight with ICI, we will take as per ICI assumption. That assumption is also correct compulsory because question is silent. But better take what? Optionally converted. So this become optionally convertible. So the principal component will be identified as liability or equity? Liability. Liability. It will be considered as liability. Correct? Now you can identify the contractual cash outflow. So can you give me contractual cash flow? What is the interest? 5% into 1000 means 50. 50 payable for how many years? 10 years. Means how many half year? 20 half year. 50 is payable 20 half year. What is the principal component? 1000. Conversion value is 1000 only. 1000 is the value. The conversion value is 1000. It is financial liability, principal component. Now, of course, we can find out present value by using market rate of interest. That we can do. That we can do. So this I hope you can do, or if you want, I can show you the solution also. Or you want me to do it? Calculation you can do na? Calculation. So what is the profit given? Batao. Profit given how much? 1000. So profit is 1000. What is the present value of liability component? So that they have given 597. This we can calculate 50. Sorry, this is interest component is what? 50 into annuity factor they have given at 11%. 11% is nothing but 5.5%. You use 5.5%. Okay, they have written 11% per annum, but this should be 5.5% per half year. So that will come 597, and 1000 is the principal value. Their annuity factor, their present value factor is 0.343. This is coming 343. This becomes the total fair value of liability component. Total fair value of liability component. 1000 minus 940. So 960 become what? Equity component. 60 become equity component. Can you say with this we can find out the first journal entry? First journal entry what? Cash and bank account debit to liability component to equity component 1000, 940 and 60. Got this point? Understood. Now let us read the second para. Second para what did on 1st Jan 2004 means after how many years? But actual term was 10 years. Means after 5 years something happened. The convertible debenture has a fair value of 700. This is the fair value of what? Fair value of what? Compound financial instrument. Convertible debenture is a compound financial instrument. So this is the fair value of compound financial instrument. A Limited makes a tender offer to the holder of debenture to repurchase the debenture for rupees 1700, which the holder accepts. So what is the buyback price? That is only consideration paid, fair value of compound financial instrument. This now need to be split in two parts, liability component and equity component. At the date of repurchase, A Limited could have issued non-convertible debt with a 5-year term bearing a coupon interest rate of 8%. This is what? Current market interest. Why that is given? To find out the fair value of liability component on the date of repurchase. So this become current. This is 4% half yearly. 4% half yearly. So how the entity account for equity and liability on inception? Inception so we have done. Now at the time of repurchase that we need to find out. Correct. So first we need to find out carrying amount of liability component. On which date? On the date of repurchase. On the date of repurchase. What is the date of repurchase? 1st Jan 2004. Either you can prepare amortized cost table, or can I say in this way, amortized cost table that carrying amount is nothing but present value of remaining contractual cash flow discounted at original EIR. If you are discounting at original EIR, that will come carrying amount, because amortized cost is based on EIR. So if you are doing present value of remaining contractual cash flow discounted at original EIR, you will get fair value of carrying amount. Carrying amount, because you will get amortized cost. Amortized cost is based on what? EIR. Amortized cost is based on EIR. Understood? So either you can prepare amortized cost table, but for 10 year it will be very big. 10 half year na? 10 half year it will be time consuming. So you can use shortcut. You can find out present value of remaining contractual cash outflow. So you will say 50 multiplied by present value annuity factor for how many half year? 10 half year. At what rate? What is the effective rate of interest? What is the effective rate of interest? 5.5, because this was originally 5.5%. This you can calculate. Then 1000 into present value factor, 10 half year is remaining, into what? 5.5%. This you can calculate. This become amortized cost. So carrying amount you have calculated, or you can use what? Amortized cost table, your choice. They have done what? Let's see. They have done, is the working note? Yeah, they have calculated present value of 10 remaining half year interest payment at 50 discounted at 11%. Means they have used what? Present value factor. Means they have also not used that amortized cost table. They have also used what? Present value technique. So this become carrying amount of interest, and this become carrying amount of principal. The total carrying amount become what? 970. Understood? And carrying amount of equity component remain same. Carrying amount of equity component remain same. This you can do. Then we'll split 1700 into two part. 700 will be split into two part by using which rate of interest? By using current market rate. That is how much given? 8%. 8% means 4%. So we can find out present value of remaining contractual cash outflow discounted at 4%. Discounted at 4%. So that if you apply, they have done 8% means 4%. It will come 405 and 680. This for interest and this for principal. This become the total liability component, fair value of liability component, and the residual figure is what? 1700 minus 1085. This become fair value of equity component. Means this much you have paid for which component? Equity. This much you have paid for which component? So this minus this will be what? Gain or loss. With the gain or loss will pass one journal entry. This journal entry has been done. Have you understood? This is one expected question from my point of view. Either same question will come or different question will come, but the concept remain same. Now can you say if you are good in discounting, you can do it. Only calculation is important, and concept about effective rate of interest, market rate of interest, and contractual rate of interest. Only this is the game. Chalega. Concept number 2 is completed from my point of view. Have you understood? Any doubt you can ask me. Concept number 2. Live student, you can also ask me doubt. Okay. So concept number 2 done. For every concept, I will take one good question. One good question. Now before this, I would like to also explain compound financial instrument thoda sa. A 2 marks question can be asked in exam for identification of what? Compound financial instrument. Identification of compound financial instrument. Whether it is a compound financial instrument or it is not a compound financial instrument. So whenever any instrument is given, that instrument will have 2 components. One is interest or dividend, and second is what? Principal. Understood? Now, if suppose there is an obligation to pay interest amount and there is an obligation to pay principal amount, so they have an obligation to pay both amount, so it becomes financial liability. Then it becomes financial liability. So first identify interest component or dividend component, then identify principal component, then identify principal component. Correct? If entity has an obligation to pay both, then it becomes what? Financial liability. Then this is not compound financial instrument, then it is pure financial liability. If the entity has no obligation to pay both, then it becomes equity instrument. Then it is not a compound financial instrument. But if the entity has an obligation to pay this, but no obligation to pay this, and of either this or they have no obligation to pay what? Interest, but they have an obligation to pay what? Principal, then these two situations will become what? Compound financial instrument. This can be 2 marks question. Identify whether it is a compound financial instrument or out of these which are compound financial instrument. They may ask this type 2 marks MCQ question. Can you say whenever they say split, it means it is a question of what? So for practical question, if there is a split means what? It is a question of compound financial instrument. So there, I think even though you don't know, you will be able to understand. You will be able to understand. Correct? So let me take some example and you will say me whether it is compound, it is not a compound. Correct? Only for 2 marks I am doing. Okay? So let me take some example. Okay, can I take? This PDF also I have given to you. If you have taken print out, okay, not taken then also okay. It is given away. Don't read this part. Don't read this part. Okay. This part is not given. Okay. No, not given. Now, let us take some example. You need to identify 2. One is interest or dividend and principal. Redeemable preference shares with fixed dividend, but the principal is redeemable. Yeah. And fixed dividend means what? Obligation to pay. So this become what? Financial liability. Very easy. First example is easy. Then non-redeemable preference shares. Non-redeemable means what? Obligation to pay, no obligation to pay. So no obligation to pay. With cumulative or non-cumulative dividend at the discretion of the issuer. Means dividend is also as per the discretion of entity, means there is no obligation to pay. There is no obligation to pay. No obligation to pay. It become what? Equity. Then redeemable preference share with redeemable means what? Obligation to pay. With cumulative or non-cumulative dividend at the discretion of issuer means what? No obligation to pay. It means what? It become a compound financial instrument. Then non-redeemable preference shares means what? There is no obligation to pay. With cumulative dividend payable only on liquidation, and there is no contractual obligation exists to pay unless upon liquidation. Of course, on liquidation, so everything is payable based on surplus. So that will not take into account. During the lifetime, it was not payable. During the lifetime of the company, it was not payable. Correct. So it will be what? No obligation to pay. So it become equity. Understood? Payable only on liquidation. Only on liquidation means it was not payable during lifetime, means it was based on the discretion of entity. Chalega. Redeemable preference shares with cumulative dividend. Redeemable means obligation to pay principal amount. Payable. Dividend is payable only on liquidation, and there is no contractual obligation exists to pay unless upon liquidation. So there is no obligation. So it become what? Compound financial instrument. Non-redeemable preference share with cumulative dividend. Non-redeemable means there is no obligation to pay cumulative dividend, and there is contractual obligation exists to pay dividend. There is a contractual obligation exists to pay dividend. That entity does not have an unconditional right to defer payment. Means there is an obligation to pay dividend. So it means it is what? Once again compound financial instrument. Then redeemable preference share obligation to pay with cumulative dividend, and there is a contractual obligation exists to pay dividend. There is a contractual obligation exists to pay dividend. Both are payable. It is what? Liability. Compulsory convertible preference share, no obligation to pay. Compulsory convertible with discretionary dividend, no obligation to pay. It is what? Equity. Compulsory convertible preference, no obligation to pay. no obligation to pay. Are you able to understand? With fixed dividend means obligation to pay. It is what? Compound financial instrument. Redeemable debenture principal is redeemable with fixed interest. It is also obligation to pay. It is what? Financial liability. Irredeemable debenture, no obligation to pay. Fixed interest, obligation to pay. It is what? Compound financial instruments. Redeemable debenture, obligation to pay. With discretionary interest, no obligation to pay. It is what? Compound financial instrument. Irredeemable debenture, no obligation to pay. No guarantee of interest. No guarantee of interest. No obligation to pay. It is what? Equity. Zero coupon bond or deep discount bond. Zero coupon bond, I think you have done in AFM, which is issued at deep discount. But can you say it will have some component principal and some component interest? Suppose 10 lakh nominal value and issued at a discount of 6 lakh. So you receive 4 lakh, but you will pay how much? 10 lakh. So 6 lakh is what? Interest only na. Whatever you are paying extra, that is interest. You receive 4 lakh, you are paying 10 lakh. So 6 lakh is what? Interest. So this will be always what? This will be always financial liability, pure financial liability. Now, doubt normally come in this. Correct. Optionally convertible redeemable debenture. Optionally convertible. Now sunna. Optionally convertible. So just try to understand. When nothing is given, always we'll assume it is fixed interest. For debenture, so we'll assume fixed interest now. If nothing is given for debenture, what will assume? Fixed interest. So there is an obligation to pay interest. There is an obligation to pay interest. Now optionally convertible. So optionally convertible, initially principal component will be classified as what? Initially it will be classified as financial liability. This is also financial liability, but then also it is not compound. Then also it is not financial liability because there is an option given. Whenever a right is given, a right has been given to the holder, either they can demand redemption or they can demand conversion. So for right, some proceed will receive. Suppose I have given a right to you that you can use this right once you become CA, and you can come to my class and you can attend any class. That right has been given. So right is not free now. I will charge something right now. Na? So it means some proceed will receive, and that is there is no obligation to refund that amount. So whatever proceed you are receiving for right, there is no obligation to pay that amount. So that become what? Equity portion. So whenever right is attached, always it will be what? Compound financial instrument. So whenever right is given to the holder, it will be always what? Compound financial instrument. Similarly, participating, participating redeemable preference shares. Participating redeemable preference share, which can participate in surplus profit and surplus fund. So right has been given that you can participate in surplus profit and surplus fund. Right has been given, so it cannot be what? Liability. It will be always what? Compound financial instrument. So these both are compound financial instrument always. So whenever right is given, it will be always a compound financial instrument. Understood? So 2 marks question can be asked of this nature. 2 marks question will be asked in this nature, but just try to understand preference shares. Preference shares, interest and principal. If it is redeemable, then what? Bolo. Principal common redeemable, then what? Financial liability. Irredeemable, then what? Equity. Convertible optionally, then what? Financial liability. Compulsory fixed, then what? Equity. Variable, then what? This you have understood? Have you understood this part? 1 second. Those who have not understood, those who are not listening. Principal common, redeemable, then what? Irredeemable, then what? Convertible. Optionally, then what? Always financial liability, because it is contingent. Contingent means what? Financial liability, because we don't know whether what will be opted by holder. Compulsory convertible. If it is fixed number equity share, then what? Equity. But variable number equity share, then what? Financial liability. Rules will remain same for every instrument. This rules is not going to change. But I am doing this concept for interest. Interest means interest or dividend are interchangeable word. When I am saying interest, interest means dividend, dividend means interest. Chalega. Now, if it is fixed, then what? Bolo. If it is at discretion of entity, then what? Then equity. But if the question is silent, then what? Oh my god, here doubt will come. So I am doing this for silent. Suppose they have written compulsory convertible cumulative dividend. In last question it was given it was payable every year. It become fixed. But suppose that para is not given. That sentence is not given. They have given compulsory convertible dividend. Cumulative dividend. Question is silent. Whether it is fixed or at a discretion. Quite possible now. Now my question to you all. So do as per the information of question. If it is a question of what? Compound financial instrument. Just try to understand. Compulsory convertible cumulative preference shares. And question is silent about what? Dividend. So the compulsory, this principle is what? Principle is what? Equity or liability? Are compulsory convertible. Compulsory convertible cumulative preference shares. So compulsory means what? Fixed. It will be fixed only. Because from question point of view. So if it is fixed number, if it is here, it will be equity. Now just try to understand. If it is a question of compound financial instrument, can you consider dividend as a liability? We need to consider it as liability only. Because if you say it is discretion, so it will become equity. Total become equity. Then you are going against what? Question. You are going against question. So in that you need to be smart. Thoda sa smart. MCQ question doubt mein aayega. Suppose they have given option, then you will be doubt. So I will say whatever you have understood that time, do it. Don't waste your much time. If the question is silent, from my point of view, question will not be silent for MCQ type of question. Question may be silent for what? Practical type of question, because in that you need to take assumption. If one is liability, the other will be equity only. If other is equity, then this will be what? Liability only. Then only it is a question of what? Compound financial instrument. Then only you can do splitting. Otherwise, you can't do splitting only. So go as per the question demand. Go as per the question demand. Understood? Have you understood? Done. My job done from exam point of view. Compound financial instrument is over. Compound financial instrument is over. Now let us come to next concept, which is important from exam point of view. Financial asset. Financial asset. Now we all know that. Because already you have studied. Financial asset for recognition measurement can be up to 3 types. Financial asset measured at amortized cost. Financial asset measured at FBTPL. FBTPL means what? Fair value through profit or loss. And financial asset measured at FBTOCI. Okay. Correct. Till now, no question of identification of the classification has been asked. So we presume that type of question they will not ask. How to identify whether it is at amortized cost or FBTPL or FBTOCI. However, I'll give some hint for that. Until now, no good question for FBTPL and FBTOCI. Only they have given question for what? Amortized cost. So from exam point of view, if I'll say, if you know financial asset at amortized cost, you can do all the question of ICI study material. You can do all the question of ICI study material. Good question I am saying, not small question. So concept number 3 is what? Financial asset measured at amortized cost. Financial asset measured at amortized cost. For this, there are 2 types of financial instrument. Financial instrument can be at market term, can be at off market term. Market term means what? The contractual rate of interest is equal to what? Market rate of interest. So in this case, contractual rate of interest will be equal to market rate of interest. So can you say the contractual rate of interest is given in exam question, but market rate of interest is not given? What will assume? It is at market terms, because we can't go to market. It means the contract is at market terms. So if the market rate of interest is not given, it means what? Contract is at market term. Then contractual rate of interest will be equal to what? Market rate of interest. Correct. So whenever it is at market terms, contractual rate of interest will be equal to market rate of interest. It means if the market rate of interest is not given in the question, don't go to market. It means what? Instrument are at market terms. Instrument at market terms means what? Contractual rate of interest will be equal to market rate of interest. Understood? But if it is at off market terms, so they will give you contractual rate of interest, they will give you market rate of interest also. It means it is not at market terms. So from question you can understand whether it is at market terms or it is not at market terms. So this become at off market term. This is only important from examination point of view, because this become lollipop question. They will not ask you lollipop question. Correct? So they will ask only what off market terms in exam. Means they have given 4 or 5 questions. All 4 or 5 questions are of off market terms. It does not mean they can't ask this. And believe me, if they will ask this, now most of the students will do wrong. Why? Because you are not habituated of this question. You are not habituated of this question. Exam may our mind does not work, and we always expect the similar type of question. We always expect similar type of question, and therefore mind become blocked. When a different type of question comes, mind does not work. So don't expect similar type of question. Your mind will start working. Don't expect. Now expect in exam. Bolo, in exam all question will be out of book. Bolo na. In exam all question is going to come from out of book. Bolo. Then only in exam you can do it. If you expect similar question and they are not asking similar question, you will stuck. So in exam, whenever you are entering now, just say to yourself, whatever question will come, whether from the book, out of book, we are going to pass in this exam. If you are going with that assumption, believe me, you will pass. Because new question is new for everyone. Who are attempting, they are passing. Who are not attempting, they are not passing. That is only the rule. Chalega. So it is at off market terms, I think you can identify. So in this case, 100% market rate of interest will be given in the question. If market rate of interest is not given in the question, means the question is wrong. Or in that case, of course, market rate of interest will be equal to what? Contractual rate of interest. Correct? Understood this much? Have you understood? Now, whenever it is at market terms, so can you see the present value of contractual cash inflow at market rate of interest or contractual rate of interest? Both are same. So it will be equal to transaction price paid. Whatever you have paid, that only become fair value. So whatever transaction price you have paid, whatever acquisition price you have paid, that only what? Fair value. Suppose I purchase this mobile from the market at rupees 1 lakh. What is the fair value? What is the fair value? One second. I purchase this mobile from the market at rupees 1 lakh. What is the fair value? What is the cost price? 1 lakh only. I will pay at cost price or fair value. So on the date of purchase, can the cost price and fair value are same? On the date of purchase, cost price and fair value will be same. I hope you are understanding what I am saying. So in this case, fair value will be transaction price paid if I have purchased at market terms. So no adjustment required, and therefore they don't ask this type of questions. Correct? But in this case, can you say fair value will not be equal to transaction price paid? Can you say fair value will be equal to, you will say me, fair value will be equal to present value of contractual cash inflow. Inflow why? Because financial asset. Inflow means coming in. Correct now. So present value of contractual cash inflow discounted at what? Discounted at market rate of interest or contractual rate of interest or effective rate of interest. Market rate of interest. That is the rule. Rule remain same. Rules will remain same. So that is only given. If we need to find out fair value in this case, present value of contractual cash inflow discounted at market rate of interest. Suppose they have given one question, contractual rate of interest is 0 and not given, my mistake, not given, and market rate of interest is equal to 10%. Suppose they have given this question. But contractual rate of interest is what? Bolo, contractual rate of interest is what? Contractual rate of interest is equal to market rate of interest. 100% wrong. Contractual rate of interest will be always given in the question. If not given, then what? 0. Contract na. Contract. If not given means what? 0. Correct na. Contract. The question is based on contract only na. So if question given means contract is given. Contract is given. So if the contractual rate of interest is not given, it means it is 0. It is 0. And market rate of interest will be always given in the question. Understood? These are the point where you will be stuck in exam. If different type of question they are asking. But if you have understood my emotions, you will have no emotions in exam hall. Understood? If you are not able to understand my emotions, then some emotions will come. So emotions and emotions are linked. Got this point? Yes, sir. Have you understood this point? If you have understood this, now let us do the following step. This is the concept. Concept you understood? So there can be two type of question. At market terms, off market term. Normally off market term. But be careful, it can be at market term. They can change the question, correct? At market term means market rate of interest will not be given. If not given means contractual rate of interest will be equal to market rate of interest. In that case, fair value will be equal to transaction price paid. Even though you are calculating, same amount will come. But why to calculate? Fair value will be equal to transaction price paid. But when at off market terms, it means contractual rate of interest will be not equal to market rate of interest. In this case, market rate of interest will be given the question. Will be given the question. If it is different than contractual rate of interest, it means it is at off market terms. In this case, fair value will be equal to present value of contractual cash inflow discounted at market rate of interest. Market rate of interest means it is not equal to transaction price. It is not equal to transaction price paid. Understood? Now let us come to following step. Step number one. Step number one. Identify contractual rate of interest and calculate contractual cash inflow. Similar point. Similar point. Correct? What is this rule? Okay. So here contractual interest component will be nominal value multiplied by contractual rate of interest. Nominal value you know. Then contractual principal component, of course, you can calculate as per the information given in the question. As per the information given in the question, calculate. But in this case, fixed variable wala point will not be applicable. Fixed variable is only in the books of what? Entity. Compound financial instrument we have done in the books of entity. Fixed number of equity share, variable number of equity share, that is only applicable in the books of entity to identify financial liability equity component. Correct now. Here we don't apply. Here we apply principal component. Whatever is the contractual cash inflow, that will identify as per the information given in the question. Correct. Then step number two, identify market rate of interest and calculate fair value of financial assets. Situation number one, if instruments are at market terms, then fair value of financial asset will be equal to transaction price paid. Then don't calculate. If you are calculating, you are wasting your time. Situation number two, if the instruments are not at market terms, then in that case, of course, transaction price paid will not be equal to fair value. To calculate fair value, so transaction price paid, whatever given, minus fair value of financial asset. Fair value of financial asset will be equal to what? Present value of contractual cash inflow discounted at market rate of interest. That you can do. Correct. This you can identify, and the difference will be extra amount paid. Extra amount paid. Correct. Now we need to understand what will be the accounting treatment of extra amount paid. What will be the accounting treatment of extra amount paid? This treatment of extra amount paid depends upon the nature of contract. Depend upon the substance of the contract. So we need to identify what is the nature of the contract. We need to identify the nature of the contract as per question given in ICA study material. Because I can't go beyond that. As per the question given in ICA study material, they have given this type of question. Depends on the nature of contract, means from examination point of view. I am explaining. If it is concessional loan to employee, some concessional loan has been given to employee, the difference amount paid will be the amount paid for receiving some service during the loan period. So that will be known as prepaid employee benefit expense. So it will be prepaid employee benefit expense. We need to apply IND AS 19 to that. IND AS 19, you know, employee benefit. IND AS 19. So whatever extra amount paid, that will not be covered in this chapter. That will be covered in some other chapter, other accounting standard, IND accounting standard. So that extra amount paid will be accounted as prepaid EV expense, and that will be amortized to PL during the tenure of loan. So 5-year loan divide by 5 and charge it to profit and loss account. Means what journal entry will do? Bank account, sorry, financial asset account, prepaid EV expense account to what? Bank. Financial asset will come at fair value. This is the difference amount, and this is the transaction price paid. If it is one question has been given for deposit given for lease. Deposit given for lease. One question has been given ICA study matter, deposit given on lease. I am expecting that question in exam. So if some deposit given for lease contract, means for taking some asset or lease, so whatever extra amount paid, that will be considered as prepayment for lease contract. Any prepayment for lease contract will be debited to ROU asset. Will be debited to ROU asset. So the extra amount paid will be recognized as ROU asset, and that ROU asset will be amortized during the lease term. During the lease term. So it will be accounted as ROU asset. IND AS 116 will be applicable, depreciated over the lease term. Then one more popular question is concessional loan given by parent company to subsidiary company. Some concessional loan given by parent company to subsidiary company, correct? So the difference amount will be considered as that amount has been given permanently. Means this will become a permanent investment in the subsidiary company. So that will be accounted as investment in equity instrument of subsidiary company. Investment in equity instrument of subsidiary company. So here investment in equity instrument of subsidiary company and IND AS 27 will be applicable. IND AS 27 says that it will be accounted in separate financial statement at cost method. At cost method. Understood? And there is no, don't do any subsequent accounting for this because ICA will not ask subsequent accounting for this. Then it can be reverse also. Sometimes concessional loan has been given by subsidiary company to parent company. Subsidiary company has given to parent company. Rare situation but possible situation. Rare situation but possible situation. Subsidiary company has given concessional loan to parent company. It means, can you say loan has been given to shareholders? Loan has been given to shareholders. Parent company is the shareholders of subsidiary company, correct? Now the loan has been given to shareholders, so whatever extra amount paid, that will be considered a deemed dividend, distribution to shareholders, distribution to shareholders. So here treated as dividend distribution, debited to retain earning, debited to retain earning. Understood? However, one more point, suppose you are not able to understand the substance of the contract, means you are not able to understand what will be the account debited, always try transfer it to expense, treat it as expense charged to profit and loss account immediately. So suppose you are not able to understand an exam, what will be the account to be debited? It means no benefit, extra amount has been paid without any intention. Extra amount has been paid without any intention. So whatever extra amount paid without any intention, that will be charged to profit and loss account as an expense immediately because no future economic benefit. If there is no future economic benefit, whatever extra amount paid will be charged to profit and loss account as an expense. Got this point? This you have understood? Have you understood this point? So initial journal entry reward, financial asset account debit with fair value, respective account debit as per the nature of the contract to bank. This will be the first journal entry. Now this financial asset will be measured at amortized cost. So can you say IND AS 109 is applicable only to this? For respective account to apply respective IND AS. So IND AS 109 is applicable only to financial asset which is initially measured at fair value. So initial recognition journal entry, I hope you have understood this initial recognition journal entry. Now step number 3, identify effective rate of interest. Till now no question with transaction cost has been given. Till now no question of transaction cost is given. Most probably they will not be. But if given, you can't say out of book. It is out of from the syllabus only, correct? Because initial recognition is always done at fair value plus transaction cost. Till now, no question has been given of transaction cost for this particular topic. So then identify effective rate of interest. So ask, is transaction cost given? If not given, then effective rate of interest will be equal to market rate of interest. All questions of this nature in ICA study material. If yes, then effective rate of interest will not be equal to market rate of interest, and in that case effective rate of interest will be given in the question, correct? So in that case effective rate of interest will be given in the question. If not given, we can calculate by using the concept of IRR. Then step number 4, calculate interest expense and amortized cost by applying effective rate of interest. Disturbing element, na? Huh? But in exam, suppose in exam hall, this sound is coming, what do you do? Then also you need to concentrate. So we need to concentrate now. That much power we should have. In any situation we need to be effective. So in exam hall also this type of sound may come. So you need to be effective and you should concentrate only on your paper. Chalo, we'll concentrate. We'll learn how to concentrate. So here, so this the same only opening balance. Interest at effective rate of interest, contractual cash inflow and closing balance. The closing balance will become amortized cost. So this amount, opening balance is which amount? Fair value of loan plus transaction cost if any. But till now they have not given any transaction cost. Interest you can calculate minus contractual cash inflow. This you can find out. You can do for all the years. You can find out amortized cost. Then you can do subsequent recognition at year end for recognition of interest income or journal entry. financial asset account debit to interest income. For amount received, what journal entry? Bank account debit to financial asset, and at the end financial asset will become 0. At the end financial asset will become 0. One more concept done. Concept number 3 also done. Can you repeat with me one by one each step? First, step number 1. First word, identify contractual rate of interest and identify contractual cash inflow. That you can easily identify for this particular point. However, it has two components, interest component and principal component. Then identify what? Market rate of interest and calculate fair value of financial asset. If contract is at market term, then fair value will be equal to what? Transaction price paid. But if contract is not at market term, then we to find out fair value of financial asset, that will be equal to what? Present value of contractual cash inflow discounted at market rate of interest. Correct? Then transaction price paid minus fair value of financial asset. The difference will be accounted as per the substance of the contract, means as per the information given in the question. So there are 4 types of question whatever is given in ICS study material. One is for employee, so that will be prepaid expenses. One is for deposit given for lease, that will be ROU asset. One is for concessional loan given by parent company to subsidiary company, that will be what? Investment in equity instrument. One is concessional loan given by subsidiary to parent company, that will be dividend, deemed dividend, that will be transferred to retained earning. Correct. Then initial recognition you can do. Then identify effective rate of interest. If transaction cost not given, then effective rate of interest will be equal to market rate of interest. If given, then effective rate of interest will not be equal to market rate of interest, then it will be given in the question. Apply that rate of interest to calculate amortized cost. Last step, calculate interest income and amortized cost by applying effective rate of interest. Simple only, all the steps done. Let me take one question. I think I have taken that security deposit wala question. Come to question 26. A Limited has made a security deposit whose details are described below. Make necessary journal entry for accounting of deposit. Assume market interest rate for the deposit for similar period to be 12% per annum. But in this question, contractual rate of interest is not given. Then contractual rate of interest is what? Who said market rate of interest? Who said? It is not given. The contract is not given. It means 0. It means 0. It means 0. After saying so many times, you are saying market rate of interest. In exam also, you will take what? Market rate of interest. Be careful. Be careful. Contractual rate of interest is equal to 0. And of course, can you deposit whenever given or received? It is what? At 0 rate of interest only. Always. Now there are 2 types of deposit. Only for your understanding. One is which is refundable. If it is refundable, it is a financial asset. If it is non-refundable, it will be adjusted with goods or services, then it is not a financial asset. So if suppose you have given deposit which will be adjusted with the amount of goods or services whatever you will purchase or whatever you will sell, then it will not be a financial asset. If it is refundable, then only it is a financial asset. If it is refundable, then only it is a financial asset. Chalega. So in this, of course, it is refundable only. So date of deposit given, date of finishing date is given 31st March 2006. Description is given lease, total lease period is 5 years, discount rate is given 12, security deposit is given 10 lakh, present value of annuity factor is given 0.567427. It is given. Now can you use any other decimal? No. So in this case, of course, it is not at market term. So what will be fair value? Fair value will be equal to 10 lakh. Can you say contractual interest payment is 0? Contractual interest payment is 0. And principal, what is the cash inflow? Principal, what is the cash inflow? 10 lakh will be received at the end of 10 lakh will be received at the end of 5. At the end of 5. So 10 lakh multiplied by what? 0.567427. It is how much? 5,67,427. This is the fair value of financial asset. What is the transaction price paid? What is the transaction price paid? 10 lakh. Difference is what? Difference is what? Now, amount bata. Amount is what? 4,32,573. This will be what? ROU asset at the beginning. What is the first journal entry? Financial asset account debit. ROU asset account debit to bank. this ROU asset will be depreciated for how many years? 5 years. 5 years you can divide by 5. Every year depreciation will come. That you can do. This financial asset, this amount will be amortized by applying. We'll calculate amortized cost by using which rate of interest? EIR. Whether transaction cost is given, not given. EIR will be equal to market rate of interest what? 12%. You need to calculate interest income by applying 12%. Interest income by applying 12%. That you can do. Now my job is very less. Calculation. You have calculator. You can do na. What I will do? Nothing na. Concept is required. Calculation you can do. If the calculator was not given in exam, then difficult. Then exam is difficult. But you have calculator. Okay, sir. I think you can do. I think one more question. 28. This is also very popular question. A Limited issued redeemable preference shares to holding company Z Limited. So A Limited is what? Subsidiary company. Z Limited is what? Holding company. A Limited issued. Who is the issuer? A Limited. Who is the holder? So financial asset will be from whose point of view? Z Limited. Z Limited. Holder, in the books of holder, financial asset. In the books of issuer, equity and financial liability. In the books of issuer, who will identify what? Equity and financial liability. So for A Limited is a compound financial instrument. That you can do by applying concept number 1. But they have asked in the books of what? Z Limited. For Z Limited become financial asset. So if this question they ask for A Limited, it is a compound financial instrument question that you can do. But they have asked from whose point of view? Z Limited. Same question from Z Limited. It is a question of concept number 3. Financial asset at amortized cost. Repayment redeemable after 5 years. So non-cumulative redeemable preference shares. Non-cumulative redeemable preference shares. So what they have given? Let us read. Date of allotment, date of repayment, total period, value of preference shares. It is what? 10 crore na? 10 crore. Dividend rate is 0.0001%. Oh my God. Insignificant, immaterial. Market rate of interest 12%. So this become contractual rate of interest. This become market rate of interest. And present value factor is given. Now, my question to you all, in this principal to understood is what? 10 crore. But what is interest? Whether there is any obligation to pay, whether the entity A Limited has an obligation to pay dividend. So Z Limited does not have a right to receive dividend because it is non-cumulative. And now you can see question is silent. Question is silent. Whether it is as per discretion or it is fixed. So can I say we can understand the rate of contractual rate of interest is only 0.001%. 100 rupees na. 10 crore ka this person 100 rupees. This is only 100 rupees. So it is very immaterial. It is immaterial amount. And therefore they have considered it as what? There is no obligation to pay dividend. So there is no obligation to pay dividend. There is no right to receive dividend. Therefore this will become what? 0. This will become 0. Understood? Have you understood this point? Now suppose they would have given here, suppose they have given 10%. Now doubt will come because question is silent. Question is silent about dividend na. They have written only non-cumulative. They have written only non-cumulative. So whether it is fixed or it is not fixed, one doubt will come na. Are bolna rahe. Correct. So I will say take better assumption and do it. Don't fight. Don't waste your time. Take better assumption and do it. However, they will not ask, I know, but suppose they change the question and they have written 10%, one doubt will come. Whether there is an obligation to pay dividend or there is no obligation to pay dividend. Because the question is silent here. Whether it is discretionary dividend or whether it is fixed dividend, that is not given. That is not given. Are you able to understand? But I'll give you one assumption from exam point of view. One assumption. Normally, in a question of financial asset, for interest or dividend. For interest, so always assume fixed. Interest में doubt will not come if question is silent. If question is silent, this is if question is silent. If question is silent, so always say fixed. Correct. And if it is dividend, if it is cumulative, non-cumulative. Non-cumulative, now you can assume it is discretionary. Discretionary. I will say always assume discretionary if question is silent, because non-cumulative. But doubt will come for cumulative. Doubt will come for cumulative. Cumulative discretion or it is fixed. Correct now? So I will say you can assume fixed or discretionary based on your assumption, because no question has been given ICA study for this. So we don't know what is ICA viewpoint. We don't know what is ICA viewpoint for this. Correct now? So here assume and do. This my research as per the based on ICI question. Okay, so till now this question has not been given. Cumulative preference dividend for holder. For financial asset they have not given this type of question. So I will say assume fixed or discretionary if the question is silent. If the question is silent, and do accordingly. I think once you have taken assumption, then you can do now. Once you have taken assumption, then you can do. Then leave it. Let's see what they are giving. Whether they are giving or they are not giving, that is their desire. But we have done now. We have done our job. Okay? Yes. This we have understood. Now it become very simple question. In this, so non-cumulative is what? In this non-cumulative dividend is what? Discretionary, because it is what? Non-cumulative. So always assume discretionary. Always assume discretionary. So here only principal component. So it is at off market terms or at market terms? Market terms or off market terms? Off market terms. It is at off market terms. So 10 crore into 0.56743. This will be financial asset fair value minus 10 crore. That will be the extra amount paid. Extra amount paid will what? Investment in equity instrument of subsidiary company. Then financial asset is what? This amount we can apply amortized cost by applying EIR. EIR will be equal to what? Because transaction cost is not given. So EIR will be equal to market interest, that is 12%. Then you can do accordingly. So these are the popular question in exam. They normally ask this type of question. Chalega. This is also done. So concept number 3 is also completed from my point of view. Concept number 3. You want break? Huh? I understood from your face. Okay. You will take how many minute break? 5 or 10? Chalo, 10-minute break. After break, we will restart. Follow me? Technique is good. Able to recall everything? Recall? So let us start once again, everyone. Now, concept number 4. So concept number 3 was what? Financial asset measured at amortized cost. Now concept number 4 is what? If modification on estimated contractual cash inflow of financial asset. Sometime what happen? Contractual cash inflow require estimation. And if it require estimation, so it might change also. So if it will change, so what will the accounting treatment on the date of modification? On the date of modification. Only one question has been given IC study material, and that question is also asked in exam. If suppose they once again want to ask any question on this, so most probably that question will be only asked, because they don't have time to create a new question. 90% that question will be asked, but 10% they may create a new type of question. So if you know the concept, you can attempt it, whatever question they will ask. Chalega? So we'll take that question only, but what is step? Can you say if there is a modification, what is the topic? If modification in estimated contractual cash inflow of a financial asset, correct? Understood? Now you know the basic concept. So I will ask you question on the basis of basic concept. So be attentive. Means if you are giving wrong answer यहाँ पर, high chances in exam also you give wrong answer. Correct? Because what happen? Our nature will not change. We can't change our nature. Can we change our personality? We can't change our personality. Our nature will remain same. So we need to always think in that way कि what mistake we are doing, just write down that mistake somewhere, and before exam to revise that mistake only. Normally what I will say, I am very weak in identifying left and right. From bachpan, from my childhood, I am very much weak. Sometimes left I will say right, and I will say right to left. You same, you will also become CA. Correct? So it is actually my nature. Means what happened? Right will become left for me, and left will become right. Therefore I never say, or I will take time to identify. So this is what right, this is what left. Achha, go right. I will say in this way. Normally without thinking, if I will say wrong. This is my nature. So because I know my mistake, I know I will commit this mistake, I am careful on that. I am careful on that part na. So whenever you will ask me now, I will take my time. Achha, this is right, chalo go right. This is left, go left. I will say in this way, because I know my nature. So in that way, you need to also identify your mistake before exam. Ki this is the area where you can do mistake, and write down in a piece of paper, and that you revise before exam. Because our nature will not change. Again, we'll do the same mistake. But if you revise that before exam, you can identify, yes, in this area we can do mistake. Be careful. Understood this point? Correct? So whenever you are doing mistake, you should be happy. You should be happy, or you should become sad? Happy, but just before exam, not in exam. So if you are doing mistake before exam, be happy and write down a piece of paper. This is the area where you can do mistake, and be careful in exam when this particular question is asked. This is the only basic objective of a student life. Chalega? Chalo. With this we start concept number 4. But why it is not clear? Live it is not coming. One minute. Now, What I am saying? If the modification in estimated contractual cash inflow of a finance step number 1 is what? Calculate amortized cost based on concept number 1 on the date of modification, that you can do. So calculate amortized cost of financial asset on modification date as per concept number 4, whatever we have done in previous concept. That much you can do. Correct? Then you need to calculate the revised amortized cost. Revised amortized cost. So what do you mean by revised amortized cost? That we need to understand. Revised amortized cost means what? Present value of present value of remaining contractual cash inflow based on modification. Based on modification means I can say present value of modified contractual cash inflow for remaining term on the date of modification. One second. Present value of remaining modified contractual cash inflow. Achha, what we are calculating? Revised. What we are calculating? Revised amortized cost. So we'll find out present value of remaining modified contractual cash inflow discounted by using contractual rate of interest, market rate of interest or EIR. Bolo? One second. I will not say. You need to say. We are calculating what? Revised amortized cost. So that is equal to present value. Don't read. Present value of modified remaining contractual cash inflow on modification date discounted by using contractual rate of interest, market rate of interest or EIR. Confidence came. Everyone is correct. This is concept. Now it means you have understood. Everyone said EIR and that is only correct. Now batao, you only say for this whether you are supposed to see the solution. No, you know now. So if you are not seeing solution, you are getting answer means you have understood everything. So only we do technical error. Once you are conceptually strong, your solution will match with IC solution. Correct? But if you do rectification, for this particular question use this, for this particular question use that, then you will die in exam hall. Understood? So now everyone is correct. What is given? Revised carrying amount due to modification in estimated contractual cash inflow on modification date. Revised amortized cost is the present value of modified contractual cash inflow for remaining period discounted by using original EIR. Original EIR means what you have used initially. Original EIR means whatever you have used initially, that will become original EIR. Can I say you can calculate if you know modified cash flow? If you know more modified cash flow, you know. Now you need to find out the difference between revised carrying amount and original carrying amount. Revised carrying amount and original carrying amount means step number 2 minus step number 1. Step number 2 minus step number 1. Step number 2 is what? Revised carrying amount. Step number 1 is what? Original carrying amount. Original carrying amount means based on original contract whatever we have done. Correct now. So step number 2 means revised carrying amount minus original carrying amount. This will be the amount to be adjusted. Now this amount will be adjusted with what account, that we need to understand. So this will be adjusted with either expense or asset as per that difference account whatever we have used here. Means the differential account, you have understood this. Means if it initially you have adjusted with prepaid expenses, so that difference will be also adjusted with prepaid expenses. Understood? If that was adjusted to ROU asset, so that will be also adjusted with ROU asset. If that was adjusted with investment account, so that will be also adjusted with investment account. If that was adjusted with what? Dividend or what? Retained earning, so that will be also adjusted with retained earning. If that was adjusted to expense, that will be transferred to expense. Correct? Understood? Only one question has been given in ICS study material for concessional loan to employ. Concessional loan to employ. So in that question it was adjusted with what? Prepaid EV expense. So therefore it will be also adjusted with what? Prepaid expense in the question whatever has been given in ICS study material. Understood? So this amount to be adjusted with expense or asset as the case may be. As the case may be means as per initial adjustment. As per initial adjustment. Understood is fine. And then can I say this will become your new carrying amount? This will become new carrying amount. This will become new carrying amount now. This amount will become new carrying amount. Now subsequent accounting will do subsequent recognition at amortized cost by applying what? By applying what? By applying what? EIR मार्केट रेट ऑफ इंटरेस्ट और कॉन्ट्रैक्चुअल रेट ऑफ इंटरेस्ट, विच ईयर, ओरिजिनल ईयर कि रीस्टेटेड ईयर, ओरिजिनल ईयर, करेक्ट, अंडरस्टूड. तो कैलकुलेट amortized cost of financial asset from the date of modification by using what? Original EIR. And then can you do it? Yes, we can do it. Same format, opening balance, interest at by using EIR, contractual cash inflow, closing balance, and then do it at that. This is the concept. Now for any question they are asking, the concept remains same. Question may change, information may change. तो information may change, concept remains same or not. तो concept is this much. तो हो सकता है if they ask this question, because they have given only one question IC static meter, so this time they may change the question. If they are changing the question, then also the concept remain same. Once again, can you repeat me? What is the step number 1? First find out carrying amount of financial asset on the date of modification by using amortized cost table, that we can do by as per previous concept. Then find out revised carrying amount. Revised carrying amount means revised amortized cost, that will be present value of modified cash flow for remaining period discounted by using original AIR. Then compare revised carrying amount with original carrying amount. Any difference will be adjusted with respective account as we have used in initial accounting. That we can do. And then prepare one amortized cost table by using original EIR. This is the concept. The one question whatever has been given by ICI is this question. Question number, this question already asked in exam. What they have given? Will Company Limited has a policy of providing subsidized loan to its employee for the purpose of buying or building houses. So it means employee concessional loan. Difference will be transferred to which account? Prepaid EV expense account. Mr. X, who is executive assistant to the CEO of Will Company Limited, took a loan from the company on the following term. Principal amount how much? 10 lakh. Interest rate 4% for the first 4 lakh, 7% for the next 6 lakh. But this 4%, 7% are which rate of interest? Contractual rate of interest. Start date 1st Jan 2001, tenure 5-year prepayment. Full or partial prepayment at the option of the employee. Means one option has been given to the employee. They can do some prepayment. But that we don't know right now, whether it will be paid on prior basis or not, correct? So this is an option given, but can I say that we don't know right now, whether they will avail this option or not, whether they will avail this option, that we don't know. So it means we need to estimate the contractual cash inflow. The principal amount of loan shall be recovered in 5 equal annual installment and will first apply to 7% interest bearing principal. But like as per the contract, if the prepayment option is not available, the entire amount will be paid in how many installment? 5 equal installment, means 10 lakh divided by 5, means 2 lakh, 2 lakh, 2 lakh, if prepayment option is not available. And first will be used for the payment of which interest, means first 7% and then what? 4%, means first 2 lakh, 2 lakh, 2 lakh, then this 2 lakh, 2 lakh. Understood? The accrued interest shall be paid on annual basis. Mr. X must remain in service till the term of loan ends. Means right now 5 years, so this should remain in the employment for 5 years. The market rate of interest of comparable loan is 12%. This 12% is what? Market rate of interest. But at market terms, at off market terms, it is at market terms, at off market terms, means there will be some difference. Difference will be transferred to which account? Prepaid EV expense. Following table is given. This following table is given. Even though not given, we can work out this. So I'll explain. Suppose this table is not given. Let us assume this table is not given. Okay, na? Got this point I'm saying? Now, once don't read this. Mr. S prepays rupees 2 lakh on 31st December 2002. On 31st December 2002 means at the end of, what was the initial date? It is 1st Jan 2001. 1st Jan 2001. Then 31st prepayment was done on 31st December 2002 at the end of first year, second year. Second year. So second year, that year end, second year end become the date of modification. Because prepayment was available, that was not known initially. So 2 lakh was paid on prepayment basis, reducing the outstanding principal as on that date 4 lakh, means 2 lakh was paid, then 2 lakh was paid, and extra 2 lakh was paid. So 10 lakh minus 6 lakh, 4 lakh is left. Correct. Following table show the actual cash flow given to Mr. X considering the prepayment. Now they have given actual cash flow, but can you say actual cash flow can be known only on actual payment? Actual cash flow can be known only on actual payment. Record journal entry in the books of Will Company Limited considering the requirement of IND AS 109. Means I have not read the table. Table I will read. But till now the question, have you understood? Question, I will show you the question with my way of solution, because if I read IC solution you'll be thoda sa confused. So I'll just give you my way of solution. So my solution is where? It is 36. Was question number what? 20? 29. You can see. So this is the question. I'll just try to explain what they have given. So this was the beginning of the contract. Now can you say on the beginning of the contract we don't know whether the prepayment option will be availed or not. It means we need to estimate the contractual cash inflow. And if you are estimating the contractual cash flow, so what assumption will take? That they will not avail the prepayment option. That is only the better assumption. So we'll assume that they will not avail any prepayment option. Means can I say it will pay 2 lakh, 2 lakh, 2 lakh, 2 lakh like this. So this become our estimated contractual cash inflow. So principal component become 2 lakh, 2 lakh, 2 lakh, 2 lakh and 2 lakh. Now in case we need to find out interest component. Interest component has to be based on two rate of interest, 7% and 4%. 7% will be used first, 6 lakh will be repaid first. So can you say first 6 lakh will use what? 7%. And the last 4 lakh we will use what? 4%. Correct? This only that. So first can I say here at the end of first year, can you say 10 lakh is outstanding? So first 6 lakh the interest rate will be 7%, and for the balance 4 lakh the interest rate will be 4%. This is a contractual payment. Contractual payment. So this will become 42,000 for 6 lakh. This will become 16,000 for 4 lakh. Now at the end of second year, can you say out of 10 lakh 2 lakh is repaid? Balance becomes what? 4 lakh 7% and 4 lakh 4%. So 4 lakh 7% and 4 lakh 4%. Then 2 lakh 7% and 4 lakh 4%. Then this becomes 0. Then this 4 lakh 4%. Then this becomes 0. This is 4 lakh 4%. Can you see this? You can identify by your own, even though not given the question. So it is quite possible in your exam question this table was not given. This table is only given in this particular question. This table is nothing but this. This is the estimated cash flow, expected cash flow. Can you say even though not given, we can work out or not? Even though not given, we can work out. So in your exam question, quite possible this is not given. This is not given. Then also we can work out. Understood? Have you understood? Now, once we have calculated expected cash flow, okay, so now we can find out fair value of financial asset. So fair value of financial asset with present value of expected contractual cash flow discounted by using market rate of interest. What is the market rate of interest? 12%. That we can do. So that only we have calculated. You can see what we have done. The calculation of fair value of loan. On 1/1/2001. This is the estimated contractual cash inflow. Whatever we have calculated, the sum total is this 2,58,000, 2,44,000, 2,30,000, 2,16,000, 2,08,000. This we have calculated. We have used 12%. We have find out fair value of loan and then compare with the transaction price paid. What is the transaction price paid? 10 lakh. The difference between this will be what? 1,56,000 change prepaid EB expense. Means what journal entry will do initially? Financial asset account debit this amount, prepaid EB expense account debit this amount, to bank 10 lakh. This is the initial journal entry. Now what is the modification date? At the end of 2 years. Means we'll find out carrying amount at year end 2. We'll find out amortized cost at year end 2. So next working note is what? Calculation of amortized cost as on 31/12/2002. That is on the date of modification. So you will prepare this table only for 2 years. If you are preparing for 5 years, you are wasting your time. You can prepare that also, but you are wasting your time because we don't require that. So year 1 and year 2 opening balance, interest by using what rate of interest? EIR. EIR will be equal to market rate of interest. Why? Because there is no transaction cost. There is no transaction cost. Correct? This of course you can do it. This is what 2,58,000. But in the second year, can you say we have received 2,44,000 plus what? Extra 2 lakh. Extra 2 lakh is received. So you will say 4,44,000. So based on actual, this amortized cost you are calculating based on actual receipt now, based on actual receipt. So this you receive 4,44,000 and this become carrying amount based on the original calculation. Understood? Now we need to find out revised carrying amount. Revised carrying amount on which date? On the date of modification. On the date of modification means what? On 31st December 2002. 31st December 2002. Now what will be the revised carrying amount that we need to understand? Now just try to understand on this date what happened. This was totally received and extra this 2 lakh was also received. So this becomes 4,44,000 we have received. Correct? It means now we need to again estimate our contractual cash inflow for the remaining 3 years. So can you say now this 2 lakh will be received यहाँ पर and this 2 lakh will be received यहाँ पर and here nil amount will be received. So our estimation will change or not? Our estimation will change. Now we'll estimate that this 2 lakh will be received at the end of third year. This 2 lakh will be received at the end of fourth year. Nothing will be received at the end of, and this 4 lakh represents 7% ki 4%? 4% because that is outstanding. So now you will calculate contractual interest payment based on 4%. So 4 lakh is outstanding. 4 lakh ka 4% how much? 28,000. Then at the end of last year it will 2 lakh ka 4%, that is 8,000 sorry. So 16,000 and 8,000 will be contractual interest payment. So this become what? Your contractual cash inflow, estimated contractual cash inflow on which date? On the date of modification. On the date of modification. Understood? This information was not given. They have given actual information which is equal to estimated information. So actually we are assuming that this is, if nothing has been given, so this will be only our estimated. This will be only our estimated cash inflow. Understood? Have you understood this point? Now can I say we can find out the present value of these on which date? On this date. Discounted by using what? Discounted by using what? Originally आया. What is originally आया? What is originally आया? 12%. 12% is the originally आया. Can't you calculate? We can calculate. Achha, why you have not used market rate of interest? Because not given. Suppose given market rate of interest on this date is equal to 15%. But now what you will use? 12%, 15%. Suppose in exam they have given on the date of modification market rate of interest is 15%. Now you will use 12% ki 15%? Huh? 12%, 15%? Why? No, because it is revised carrying amount. Revised amortized cost. We are not calculating fair value. We are calculating what? Revised amortized cost. We are calculating revised amortized cost. If we will calculate fair value, then we want what? Market rate of interest. So what we are calculating? We are calculating revised amortized cost, or revised carrying amount. That is based on EIR. That is based on EIR. Understood? So even though market rate of interest is given, ignore that. Ignore that. Now only one mistake which I have seen student do. This is also based on nature of student. Normally student do. I will ask you that question. Abhi we are calculating on 31st December 2002. Correct. So can you say this is year 3, this is year 4 and this is year 5. So year 3, year 4, year 5. What is the estimated modified estimated contractual cash flow? This is 2,16,000. This is 2,08,000. This is nil. Now present value factor you will calculate at what rate? 12%. Can you give me the discounting factor? Here normally student do mistake. Let me ask you, everyone. Everyone calculate. How much? 0.89 8929. 0.744. 71 whatever. 7 na. Okay. So I got 2 answers. देखो ना, I say ना doubt is there. So some student is doing correct and some student is doing wrong. Once again I am giving chance. I said na here normally student do mistake and we got 2 answers. Means someone is doing correct and someone is doing wrong. Once again I am giving chance. Change your answer if you want to change. How many are saying 8929? How many are saying 0.7? 711? 711. How many are saying? No one is saying. अरे ऐसे उठाओ रे. 711. You are not. This is not confident. Means in exam you are confused. You are taking more time. 10-minute question will take 30 minutes. How many are saying 711? So what balance are thinking? Balance. Jai Mata Di. Balance. What you are doing? Dekho, feel. 1 second. 1 second. Please. Please. I said if I will speak, no use of this class. You are coming. Again you will come. Next attempt. You want to come again? Bolo, you want to come again? I want to come again, but for different student, nah? Not for you. Not for you. I want to come again, but I don't want to see you. I don't want to see you in my class. You want to see me? Well, no, sir. We'll see as a CA. You'll become CA, I'll become CA, and then we'll compete. Then we'll compete, nah? Don't teach FR. Don't teach FR. There are many other subjects also. Correct? So we'll compete, nah? And if you become CA, I need to compete with you only, nah? Arre, bolna re. Even though you are my student, I need to compete with you. This is only CA. So you want to see me in classroom? So please answer. Please answer. Don't be silent. Don't be silent. 1 second. I said normally student do mistake. You need to identify, yes, you are doing mistake. You need to realize this, yes, I am doing mistake. I need to correct it before exam. 1 second. So I have got to 8929. Let me say, check it whether it is correct or not. Two answer I got. But how many are saying 8929? The confidence dekho. How many is saying 711? Confidence dekho. Even the wrong answer you should be confident, na? Wrong answer you should be confident. But I am happy that majority has gone correct answer. 8929 is correct. But those who have done 711, dekho PAP, you have done PAP before exam. This is PAP. If you have done 7114, exam maybe also you will do what? 7114. Why you have done mistake? You know, because I have written Y3. Because I have written Y3. This is Y3, but as on which date? 31st March 2012. This is Y1. For 31st 12 2002, it is Y1. Understood? Normally we do mistake because we think this is year 3, year 4, year 5, and in exam we do mistake. It should be 8929. So I am here to identify the mistake also. I am not here to give the concept. I know where you can do mistake in exam because I also gone through that phase only. Understood? And with my 20-year experience, I am saying you 20 years means including my student life also. Including my student life also. Okay, I passed in the year November 2005. Till after that I am what? Teaching only. Understood? So you can see we have taken what? Our is what? I have not written. It is written now. Dekho. 893 and 797. In class also I have mentioned danger. When I teach in regular class, this is my regular class, danger. Understood? Correct? So now you can find out this. Now you will compare this 3,58,664 with what? This carrying amount 3,25,671. The difference will come and this will be adjusted with what? 329. This amount will be adjusted with prepaid EB expense. So but you need to increase financial asset or decrease financial asset? Means this become this now. So it will increase or decrease? Increase. So what journal will do? Financial asset account debit to prepaid EB expense. Means prepaid expense will decrease and financial asset will increase. So prepaid expense will decrease. Now the balance of prepaid expense account will be amortized in remaining 2 years. Remaining 2 years because the life changes from 5 year to 4 year. Understood? 5 year to 4 year. So this will be amortized in the remaining 2 years. The balance you can do. This will be amortized by applying original year only. So once again, This is a new concept. I have not done. Means for this you can calculate what? Again, amortized cost table. Understood? Journal entry you can do it. Journal entry, see what? Solution. Got this point? Only one question, but the concept remains same. Now whatever questions come, the concept is this much only. So this was concept number 4. Concept 4 you have understood. Let us come to now financial liability. But before financial liability, I would like to take financial asset again for MCQ type of questions. For MCQ, so I have MCQs also in my mind. So as per थोड़ा सा रिवीजन करते हैं फाइनेंशियल एसेट. द फाइनेंशियल एसेट आर ऑफ 3 टाइप: amortized cost, FVTOCI, FVTPL. Now the classification depends upon whether it is a debt instrument or equity instrument or derivative instrument. You know derivative? Derivative you know? Of course you know. You have done AFM na, derivative, option, future, ठीक है ना. So classification depend upon whether it is a debt instrument, equity instrument or derivative instrument. Equity instrument means there is no contractual right to receive cash. There is no contractual right to receive cash. Debt instrument means there is a contractual right to receive cash. Derivative means derivative. Derivative means you know na derivative. Option, future, forward contract you know. ठीक है. So the classification depends upon whether it is a debt instrument means there is a contractual right to receive cash. Correct? Or it is based on equity instrument. Equity instrument of other entity will become my financial asset, but we do not have any contractual right to receive cash because they do not have contractual obligation to pay cash. Correct now? So that become our equity instrument. Understood? And the third is derivative instrument. So if it is debt instrument, the first will apply condition of contractual cash flow, means will identify whether we have some contractual cash flow. If answer is no, means it is held for the purpose of trading. Means it is held for the purpose of trading, and if it is held for the purpose of trading, this will be measured at what? FVTPL. If it is held for the purpose of trading, it will be measured at what? FVTPL. But if the answer is no, yes, there is some contractual cash flow. Contractual cash flow means there is some interest amount to be received, principal amount to be received. Correct? So we need to apply them business model test. What is the meaning of business model test? Model test means what is the purpose of that financial asset? Means why you have acquired that asset. So there can be two purposes. Either it can be hold to collect contractual cash flow till maturity. Means if it is hold to collect contractual cash flow till maturity, means you are holding till maturity, then it will measure at amortized cost. It will be always measured at amortized cost. But if you hold and sell whenever required, means you hold it, but you can sell it whenever required, then this become FVTOCI, fair value through OCI. But if neither condition 1 nor condition 2, then always what? FVTPL. So this type of question can be asked in MCQ. Still now to not asked because MCQ only one exam has been done. But I hope you thora you have understood. Correct. So debt instrument first will identify what? CCFC test, contractual cash flow test. If not satisfied, FVTPL. If satisfied, then apply business model test. Then identify whether it is hold to collect contractual cash flow till maturity. If yes, amortized cost. If no, means hold and sell whenever required, then FVTOCI. Correct? Understood? This much. Correct. This you have understood. Now if it is equity instrument, so there is no contractual cash flow. So that test cannot be applied to no contractual cash flow. So you need to ask one question whether it is held for the purpose of trading. Well, if it is held for the purpose of trading, it is always what? FVTPL. If no, then two options has been given. If no, then two options has been given, and that option is irrevocable. Irrevocable means once exercised, we cannot change it. You cannot change it. So what is that irrevocable option? Ki you may select FVTOCI. You may select FVTOCI. If the answer is no, the FVTOCI option selected, then it will become FVTOCI. Otherwise what? FVTPL. Means equity instrument cannot be measured at amortized cost because there is no contractual cash flow. So if there is no contractual cash flow, there cannot be any amortized cost. So equity instrument means investment in equity shares, etc. will be either FVTPL or FVTOCI. If question is silent, always FVTPL. If question is silent, always FVTPL. Question will inform you about what? FVTOCI. Then if it is derivative instrument, option, future, etc., it will be always held for the purpose of trading. So it is always what? FVTPL. Understood this point? This point have you understood? It means, can I say, just try to understand this FVTOCI, there is one special point. FVTOCI for debt instrument, it will be always with recycling. But for equity instrument, it will be without recycling. Now, do you know about OCI, recycling, not recycling? So OCI are of two types. OCI are of two types. OCI means what? Other comprehensive income. Other comprehensive income. Correct. OCI are of two types. Either it will be reclassified to PL, or it will not be reclassified to PL. If it is not reclassified to PL, at the end it will be transferred to retained earnings. So there are two types of OCI, either reclassified or not reclassified. That depend upon the IND AS, whether IND AS says reclassification is permitted or not permitted. Means we can't do by our own reclassification or not reclassification. That is as per the requirement of IND AS. So IND AS 109 says, don't ask me out a reason, this debt instrument FBTUCI will be always what? With recycling. And equity instrument FBTUCI will be always without recycling. Means can I say this, on derecognition, this will, the entire gain or loss which has been accumulated to separate component equity will be transferred to what? PL, from OCI to PL. But this will not be reclassified to PL. This will be transferred to what? Retained earnings. This is the concept. Means effectively there are four types of financial asset. One is AC. Can I say this will be always debt instrument? This will be always debt instrument now. Equity instrument cannot be amortized cost. This you understood. One is FBTUCI with recycling. This is also debt instrument. Correct. FBTUCI without recycling. This will be always equity instrument. And FBTPL, it can be debt instrument. It can be equity instrument. It can be derivative instrument. Now, initial recognition for AC, FBTUCI, with or without, will be done at fair value plus transaction cost, fair value plus transaction cost, fair value plus transaction cost. Now, you know transaction cost, huh? You know fair value also. Acha bata, if it is at market term, fair value will be equal to transaction price paid. But if it is not at market term, then fair value will be equal to present value of contractual cash inflow discounted at market rate. This already have informed. Now, no question of this nature. Good question has not been given. Lollipop question given. Good question not given. So, if they ask, if you know the concept, you can do by your own. If they ask, suppose good question, they ask for FBTUCI. If you know the concept, you can attempt it. But I can't do on that basis now. Then so I need to take what? Full class. Chalega? Understood what I am saying? So, can you say fair value now you have understood? Transaction cost you have understood, everything you know. So, initial recognition we done at fair value plus transaction cost. Fair value plus transaction cost. Fair value plus transaction cost. But FBTPL, it will be done at what? Fair value, and transaction cost will be charged to PL as an expense immediately. Be careful about what? This is MCQ based question. MCQ, 2 marks question, correct? So only at fair value and transaction cost will be charged to profit and loss account as an expense. Subsequent recognition AC, but it will be done at amortized cost by applying. Yeah, now you know amortized cost. Amortized cost. This all three will be done at fair value, fair value, fair value. Fair value will be given the question. If not given, what you do? Present value of remaining contractual cash flow discounted by using current market rate of interest. That you know, but it will be given. Don't worry, it will be given. So fair value, fair value, fair value. Can you say in this three category, because you have done subsequent recognition at what fair value, there will be some fair value gain or loss. This fair value gain or loss will be transferred to PL or OCI as the case may be. In this case, it will be transferred to what? In this case, it will be transferred to what? PL. So fair value gain or loss, in this case not applicable. In this case, it will transfer to OCI, PL. Can I say in this case it will be accumulated? We can open one account FBOCI reserve. FBOCI reserve account. So it will be accumulated to a separate component equity and we can name it FBOCI reserve account. FBOCI reserve account. Means suppose gain. So what you are going to do? Financial asset account debit to fair value gain, that will be transferred to what? OCI, and from OCI it will be transferred to one reserve. Reserve name is what? FBOCI reserve account. Understood? Loss, reverse entry. Means this reserve may have debit or credit balance. Reserve may have debit or credit balance. Chalega. Now interest and dividend, in this case can I say it will be calculated by applying EIR, calculated by applying EIR and transferred to what? PL. In this case, if it is debt instrument, so FBTOCI, in this case also interest will be calculated by applying EIR only. So by applying EIR, and that will be also transferred to PL. But can I say equity instrument, so there was no contractual cash inflow. Whenever it is received, it will become what? So in this case, whenever received, it become what? Income, and income will be transferred to PL. Income will be transferred to PL. I hope you have understood this also. For FBTPL, this point is actually not applicable, or you can say if received, it will be transferred to PL. However, not applicable for FBTPL. Correct? This type of question they will not ask only. But I hope you have understood interest also. Interest in dividend in case of AC will be calculated by applying EI. In case of FBTOCI debt instrument, EI. In case of FBTOCI equity instrument, whenever received, whatever received, that will be transferred to what? Profit and loss account. Gain or loss on derecognition, can I say in this case? So in this case, because can I say here, it is with recycling, this gain and loss will be transferred to what? PL. This is without recycling, this will be transferred to what? OCI. Because it is without recycling, it cannot be transferred to PL. In this case, it will be always transferred to PL. And on derecognition, this cumulative gain and loss in FBOCI reserve will be recycled from OCI to PL. This will not be recycled from OCI to PL. This will remain in equity and transferred to what? Retained earning. This become a special point, but till now no question of this nature has been given in ICS study material. But now with MCQ, they may ask this type of question of 2 marks, but we don't know what is their expectation because only one exam has been done. We don't know the expectation, we don't know the level of MCQs. We don't know the level of MCQs, what level they are going to ask. Chalega? Understood? But I hope you have understood this point. This is all I have explained with my that all concept. So with this, we have completed the financial asset also. Now come to financial liability. Financial liability, normally this type of question they don't ask. Why? Because they will ask compound financial instrument. Compound financial instrument is more important than this. Because compound financial instrument also there is a financial liability. So normally they will ask a question of what? Compound financial instrument. Understood what I am saying? Correct. But one time they have asked this question and that time students are confused. Because only one question has been given in ICS study material. We don't practice and we are confused. So one time they have asked also. And the same question which is given in ICS study material that was asked. Then also students have done mistake. Why mistake? Let me ask you. Now financial liability will be normally measured at what? Amortized cost. If question is silent, always measure at what? Amortized cost. Now in this also instrument are of two types, whether at market terms or at off market terms. Whether market terms or at off market terms. Market terms means what? Contractual rate of interest will be equal to market rate of interest. Means market rate of interest will be equal to contractual rate of interest. Means if market rate of interest is not given, means it is at market terms. If the market rate of interest is not given, means it is at market terms. Understood? But if it is off market terms, means the question has given market rate of interest. Correct now? Means can I say it is just like compound financial instrument, then so it become compound financial instrument now. So can I say whenever financial liability is not at market terms, it means it is a question of what? Compound financial instrument. Bola yes or no? Already we have done. So whenever it is at off market terms, whenever financial liability, whatever instrument has been given, that is off market term, so there is some equity and there is some liability component. So it is actually a question of what? Compound financial instrument. So go to concept number 1. Means if they want a question only of financial liability, they will ask what? This point. Understood? Means they want only a question of financial liability without any compound terms, without any equity component. This will be always at market terms. This will be always at market terms. So only one question has been given. So just try to understand. Suppose they are given 12% contractual rate of interest and market rate of interest is not given. But the market rate of interest will be equal to what? It is not given. Then market rate of interest will be equal to contractual rate of interest. In that case, fair value of financial liability will be equal to what? Transaction price paid or received? Finance, it is my financial liability. I will receive, initially I am receiving the amount now. So transaction price received. So I am the issuer. So if I have issued convertible debenture, I am receiving or I am paying initially? I am receiving the consideration. So transaction price received. Transaction price received. In case of financial asset, it is transaction price paid. Transaction price paid. So it is nothing but this is concept number 5 at market terms. At market terms. Understood? This point. Doing this, it become very easy. Step number 1, identify contractual rate of interest and then calculate contractual cash outflow. This you can do. Then calculate fair value of financial liability. Can you say this will be equal to transaction price received? You are wasting your time by calculating what? Fair value. If you are calculating also same amount will come. So you are wasting your time. If you are not conceptually correct, then you will calculate. Otherwise you will not calculate. So because it is always at market terms, the fair value of financial liability will be equal to what? Transaction price received. Then identify transaction cost. In this question, they will give transaction cost because they will give masala na. Masala is what? Transaction cost. To identify transaction cost, if any, if initial recognition will be done at fair value minus transaction cost. Fair value minus transaction cost. So initial recognition will be done at fair value minus transaction cost. So what journal entry we are doing? Bank account debit to financial liability with the net proceed. With the net proceed. So if the transaction cost is given, deduct from what? Fair value, and initial recognition will be done at what? Net proceed. So what journal entry you are doing? Bank account debit to financial liability at that net amount, with that net amount. Understood? Now because transaction cost is given, so EIR will be not equal to market rate of interest. Now we need to identify EIR. So ask one question: is transaction cost given? If not, then what? EIR will be equal to market rate of interest. In this concept, market rate of interest is equal to contractual rate of interest. So in this case, EIR will be equal to market rate of interest, which is equal to what? Contractual rate of interest in this particular concept. Concept number 5 I am saying. But if it is given, then EIR will not be equal to market rate of interest, which is not equal to contractual rate of interest. Means you need to calculate or given in the question. Either calculate or given in the question. Normally it will be given in the question. Normally it will be given the question. So EIR will be given the question separately, but if not given, use the IRR concept to calculate what? EIR. Understood? So all question we are doing that only. 3 rate of interest. Concept number 1 to concept 5 we are doing that only. Chalega. Then step number 5, calculate interest expense and amortized cost by applying what? EIR. By applying EIR. So EIR based on a transaction cost given or not given. So opening balance, interest by applying EIR, contractual cash flow, closing balance. This to in every question we are doing. Then pass subsequent journal entry. Then pass subsequent journal entry. That also we can do. Only one question has been given. That question I have not given in my expected list. Given or not given? I think I have not given. But do by your own. In my expected list, because super lollipop question. But difficult in exam when you are not conceptually strong. That question I have not taken, but only one question. That question has been already asked in exam. Already asked in exam. So that question you can do by your own. Understood? Chalega. Have you understood? So concept number 5 also done. Come to concept number 6. This is super important. Means if from financial liability they will ask, now they will ask modification. If they are asking a question of financial liability, this is more important. This is more important. So next point is modification in financial liability. Actually, the concept is derecognition of financial liability. Now, when a financial liability is recognized, whether it is paid, if paid means what? Financial liability accountable to bank. No, my help is not required. Or if cancel means what? Financial liability accountable to PL. Then also my help is not required. Third is what? Due to modification. This is important. Due to modification. Understood? So modification is important, which requires thoda sa concept. Now what IND AS says that this modification in financial liability can be of 2 types. Can be of 2 types. Either the modification can be substantially different from original terms, or it may not be substantially different from original terms. So what they say, if it is substantially different from original term, then follow extinguishment accounting. Now what is extinguishment accounting? I will explain. But if it is not substantially different from original term, then follow modification accounting. So they have given how many accounting in this? How many accounting they have given? 2 accounting. Extinguishment accounting and modification accounting. Now I need to explain what is extinguishment, what is modification. However, from exam point of view, extinguishment accounting is more important than modification accounting. But can I say, we need to first find out whether the modified terms are substantially different or not substantially different from original term. Normally IND AS, in all IND AS, whatever we have done till now, this substantial word is not defined and it is a matter of judgment. It is a matter of judgment. But for this particular, only for this particular concept, they have defined what? Substantial. And they say if this equation is satisfied, what is the equation given? A minus B is more than equal to what? 10% of B. If this equation satisfied, means it is substantial, otherwise not substantial. Now what is A, what is B, that I need to explain. What is A and B? Have you noticed? What is the equation? Equation is what? A minus B is more than equal to 10% of B. A minus B is more than equal to 10% B. If satisfied, then, if not satisfied, then modification. Concept you understood? So in this follow what? Extinguishment. In this follow modification. Now what is A, what is B, that I need to explain. So A means what? Present value of modified contractual cash outflow. That will be given in the question. That will be given. Modified contract. So contract will be given in the question. The present value of modified contractual cash outflow and any legal fee paid on modification date. Any legal fee paid on modification date. Legal drafting cost, whatever. Legal fee paid discounted by using what? Original EIR. Discounted by using original EIR. This become A. A means what? Batao. Present value of modified contractual cash outflow plus legal fee paid discounted by using original EIR. Okay. B is nothing but carrying amount. Carrying amount of original liability. Means amortized cost. Find out amortized cost on the date of modification. Or you can say present value of remaining contractual cash outflow under original term discounted by using what? Both will be same now. Either use amortized cost table or present value technique. Both will give same answer. Either do discounting or do compounding. Both will give same amount now. Correct. So either you can use amortized cost table or you can use present value technique of remaining contractual cash outflow discounted by using original. Yeah. So this become A, this become B. Have you understood A? Have you understood B? In both we are discounting by using which? Original EIR. Correct. Now A minus B, if you compare A minus B, this amount you calculate, this A minus B, then compare with 10% of B, this amount. If this is greater than this, then it is what? Which accounting? Extinguishment. If this is not satisfied, then which accounting? Now I need to explain what is extinguishment accounting and what is modification accounting. Means can I say any question of modification given, first you need to find out this. First you do this now. Even though you know it is a question of extinguishment accounting, but you can't ignore this. You can't ignore this. So first you need to prove it. Yes, it is substantially different, and then do what? Extinguishment accounting. So extinguishment accounting means what? De-recognition of original liability. And we need to recognize a new liability at fair value. New liability at fair value. To recognize new liability at and de-recognize old liability at carrying amount. All liability at carrying amount. To recognize new liability at and de-recognize old liability at carrying amount means amortized cost. Amortized cost means point number B. Amortized cost means point number B na. So this to already you calculated. Amortized cost you already calculated. So you know what is the de-recognition amount of that liability that is at carrying amount. Now what is A? A is what is the new liability at fair value? So new liability at fair value. So what will be this? Present value of Sunna. Present value of modified contractual cash outflow discounted by using which rate? Discounted by using what rate? First the full concentration. Sorry. First the full concentration. Don't judge yourself with others. This all others is your competitor. Understood? Living me. These all others are your competitor. So don't change your answer based on the answer given by your competitor. Think, do whatever you are doing based on your understanding. Whenever we do any competition, whether we'll make our rule based on others, we'll make our own rule. Understood? One second. What I am asking, A, B you have understood? A, B you understood. A is what? Present value of modified contractual cash flow and legal fee paid discounted by using original EIR. B is what? Present value of remaining contractual cash outflow under original term discounted by original EIR or amortized cost on the date of modification. Now we are following extinguishment accounting. After analysis, we are following what? Extinguishment accounting. What extinguishment accounting says? De-recognize original liability at carrying amount. Carrying amount is what? B only. Carrying amount is B. Carrying amount is B. Now, in this case, we need to recognize new liability at fair value. New liability at fair value. So this will be equal to present value of modified contractual cash outflow discounted by using what? Discounted by using what? Anyone saying effective rate of interest? Because I have not, that is not came in my ears. So everyone is saying what? Now correct. Now 100% correct. Have you seen that? It is written here. Have you seen that? No, now. Means you have applied the concept. Fair value means what? Market rate of interest. Fair value means what? Market rate of interest. This is the concept. This is the concept. I will not give you answer. You need to give your own answer because in exam I am not there with you. Understood? Chalega? Yes, sir. So calculate fair value of new liability. Fair value of new liability will be present value of modified contracts or cash outflow discounted at current market rate of interest, that is on the modification date. Now one doubt will come. This though you have understood. But doubt will come, so why here we have used what? Now in exam you will take what? This market rate of interest. This mistake will happen now. Now just try to understand. Suppose I am a chartered accountant and you will also become chartered accountant this attempt. Yes sir, na? You will also become CA in this attempt. Means I remember the day when I become CA. Correct now? When I got the result, I said okay. Okay. But I understood I became CA when I went to my office, articleship office. I understood what is the change here. Means for the first time my principal, I can't say any, chal theek hai, but the principal who has never respected me, who has never asked me to sit down, who have never give a appreciation point, even though I have done a lot of work, yes, congrats. Huh? Believe me, that time I understood what is the importance of CA. That time I understood for the first time. Student life we don't understand. CA means CA you think. Once you will become CA now, the entire society will start respecting you. Entire. Even though your relative who is saying what you will do, you can't do anything. There's mama, chacha, bhua, pupa. Parents what? Parents will always respect you, will always love you. But it's all relatives will start respecting you. They will say, Arey, come baba. So that is the power of this stuff. Correct? So you are going to become CA. You are going to become CA. I want thoda sa loud energy. Okay? So can you say, when I am comparing me with you, once you become CA, so when you will become CA? In this attempt you are going to become CA, correct now? Can we compare? You are also CA, I am also CA, can we compare? No, either you need to come to my age or I need to come to your age, then only it is comparable na. So batao, if this is at which rate? Can we calculate this at market rate of interest? No, because we are comparing what? Here we are comparing A with B. Can we compare A and B with different terms? No. So if this is what? This is already calculated. This was at which rate of interest? So this should be at which rate of interest? So this we are not calculating fair value. This we are doing comparison for analysis of substantial or not substantial. Understood this point? So this we are not calculating fair value of new liability. This we are doing comparison. So either do comparison at both market rate of interest. You can do at market rate of interest also. But that is not as per ICA submission. Don't do that. But that is also correct. You can also use this also market rate of interest, this also market rate of interest. That is also correct. But don't do that. Use what? Original EI, because you need to match with ICI solution. Understood what I am saying? So this is for comparison purpose, and now you are calculating fair value of new liability. So fair value of new liability will be present value of modified contracts or cash flow, not legal fee paid, because that is already paid. Legal fee is already paid. Now it is not a liability. So don't add legal fee paid here. Present value of modified contracts or cash outflow discounted at current market rate of interest, that is on modification. Understood now? Have you understood now? Correct. But be with the concept. If I am asking fair value means what? Market rate of interest. Understood this point? Now I am asking one question. So now, the original contractual rate of interest was 10%. Original contractual rate of interest. Correct. And market rate of interest was not given originally. Not given. But the original contract, what is the market rate of interest? Have you understood the question? Originally, initially, the contract was at 10% and the market rate of interest was not given. तो बताओ what is the market rate of interest? Means it is at market terms. Is at market terms. So will you calculate fair value? Means fair value will be equal to what? Transaction price received. But they have given transaction cost. But the ER will be equal to what? They have given transaction cost. Some amount has been given. So ER will be equal to, will be not equal to. So in this we need to find out, that will be given. This is original. Correct? Now what happened? This was modified. Modified contractual rate of interest given. Suppose 15%. This is modification. So 10% was modified to 10% is modified now. Will modify original contract rate to new contract rate. So 10% was modified to 15%. So that become modified contractual rate of interest. So we'll calculate modified contractual cash flow based on what? Modified contractual rate of interest. Okay. Now this is modified. Now market rate of interest is given 12%. Suppose. But the fair value will be calculated by using what? Fair value of new liability will be calculated by using what? By using 12%. But suppose this is not given, then what? Then we will assume what? Modified contract is at market terms. And then this will be equal to 15%, or you will assume 10%. That is not correct, huh? So it means you will assume modified contract is at market terms. Modified contract is at market terms. And so whatever question they have asked in exam, in that this rate of interest was not given. It means modified contract is at market terms. But can I say any question done, if you know the concept, whatever I have said, all questions can be done. All questions can be done. Correct? Now, one more doubt. Whatever legal fee paid, this legal fee paid. Legal fee paid. But this is a transaction cost, it is not a transaction cost. This legal fee paid on the date of modification is a transaction cost, it is not a transaction cost. Well, is a transaction cost, is not a transaction cost. Not a transaction cost. Pakka? Correct only. But confidence was not there. Means right now whatever you have said, that was tukka. Quite possible. In exam most of the students do wrong. Can I say any amount paid on transaction date become what? Transaction cost. This is not transaction date, this is modification date. So this is not transaction cost. This is not transaction cost. So if legal fee paid given, whether suppose legal fee paid given 1 lakh. But what is EIR? Understood what I am saying? Legal fee paid, this is not a transaction cost. Legal fee paid given, what is EIR? EIR will be equal to what? Market rate of interest only, because this is not a transaction cost. This is not a transaction cost. If transaction cost given initially, then EIR will change. Then EIR will change. This is the crux of entire concept. Now you can do any question what they have given. If market rate of interest on modification date is not given, it will be assumed that modified contract is at market terms, that is market rate of interest is modified contractual rate of interest. Now can you say you can calculate fair value of new liability? Fair value of new liability. Now on the date of modification, you need to find out gain or loss on derecognition of existing liability. That will be fair value of new liability. Then plus legal fee paid, because that is also paid. So again, this is the total amount paid or payable. The total amount paid or payable as per modification. Now compare with the carrying amount. If you are paying more as per modification, that become what? Loss. If you are paying less as per modification, that become what? Gain. So this become total amount paid or payable due to modification. Compare with your original carrying amount. This will be gain or loss on derecognition of existing liability. So we will pass one journal entry. Existing liability at what? Carrying amount. New liability at what? And to bank. To bank is what? Legal fee paid. You can see I have not done fair value plus yahan par minus yahan par. So new liability is recognized at fair value. And to bank what? Legal fee paid. And the difference will be gain or loss. Now this new liability will calculate amortized cost and will calculate interest expense by applying what? EIR, that is equal to always what? Market rate of interest. Means that is applying EIR, but that EIR will be always equal to what? market rate of interest on modification date. This is the concept. Understood? Beautiful concept and therefore very important. One second, can we repeat whatever we have done? So we are doing modification in financial liability. First we'll find out whether the terms are substantially different or not substantially different. Therefore, with that we have one equation. Equation is what? A minus B is more than equal to 10% of B. If equation satisfied, then if equation not satisfied, then modification accounting. So first we are doing only extinguishment accounting. So what was the A? A is equal to what? Present value of modified contractual cash flow plus legal fee paid discounted by using original year. B is equal to what? Present value of remaining contractual cash flow under original term discounted by using original year or simply carrying amount of existing liability. Use amortized cost table. Extinguishment accounting, then we'll, if the equation satisfied, will follow extinguishment accounting. First we'll calculate fair value of new liability. Fair value of new liability will be present value of modified contractual cash flow discounted by using current market rate of interest. If not given, then use modified contractual rate of interest, assuming that modified contract is at market terms. Correct? Then you need to find out gain or loss on derecognition. We'll compare fair value of new liability plus legal fee paid minus carrying amount of existing liability. This will be gain or loss on modification. That gain or loss on derecognition will be transferred to profit and loss account. Then we'll pass this journal entry, and then for this new liability prepare amortized cost table by using ER. That ER will be equal to market rate of interest on modification date. And only one question. 1 second. There are 2 questions given. I am taking good question, and that good question was asked in exam. Simple question was not asked in exam. I am taking good question. Chalega? Bolo. This is the question. 49. Will company limited Will company limited borrowed how much? It is 50 crore na. I have specs in my eyes. You have. So be careful. Huh? In exam 50 crore become 5 crore and 5 crore become 50 lakh. 1 0 difference, 0 marks. So be careful. These are dangerous. One of the students asked me that, sir, in AFM exam, instead of 10,000, he has written 1,000. And entire answer is correct as per 1,000. He has been allotted 0 marks. He asked me, sir, any concessional marks will be given? I will say, come next attempt, then they will give. The entire process was correct, and because of that one question, he has not got exemption. Only because of that one question, he has not got exemption. It was 58 marks or 57 marks he got. Understood what happened? And these are actually worst thing if you are doing this type of mistake. Okay, so it is 50 crore na. The original terms of loan, original terms is given. Interest is what? 11%. This 11% is what? Bolo. Contractual rate of interest. Repayment of principal in 5 equal installment. Means how much? 10, 10, 10, 10, 10. Okay. Then payment of interest annually on accrual basis. Okay. Upfront processing fee. This is what? Transaction cost given. So, what is contractual rate of interest? What is market rate of interest? Confidence coming. 11% not given. So, it will be equal to what? Contractual rate of interest. Means this is at market terms. And what is EIR? It is given 11.50. So whenever transaction cost EIR will be given. This was the original terms. Can you see you can apply and you can calculate amortized cost on the date of modification? For the initial, without calculation, what is the initial recognized amount of financial liability? Give me the amount. Means what will be the opening balance of financial liability without calculation, without calculating present value? How much? What is the opening balance of financial liability? Bolo. Yes. Can you say because it is market and fair value will be equal to what? Transaction price received. What is the transaction price received? 50 crore minus what? Transaction cost. Transaction cost is this. So fair value minus transaction cost. What amount is coming? 49. 49. अरे भाई बोलना, my calculator is not working. 50 crore minus 5870096 is 49, 41, 29, 904. Acha, now one doubt will come. Sir, can we do rounding off? Can we write down 49.41 crore? There are many smart students. How many are smart? How many write down 49.41? Arey bolo na. How many write down? How many of you convert this into 49.41? No one will convert. No one is smart. Means you are CA student if you are not converting. And believe me, if you convert, they will not give you full marks. Because there are many students who is doing by this. And you are making the solution easy by doing what? Rounding off. So don't round off. If they have given question in full amount, do at full amount only. If the question has given crore, do in crore. If the question has given 1000, do in 1000. Correct? This is the rule. Whether they will give or they will not give mark, that is a subjective term. Depends upon who is checking your paper. There is no rule. But if I am checking, just try to understand. Suppose Mr. A has done full amount and full correct. So I'll give 14 out of 40. Now Mr. B 49.41. I said, Acha, chalu. And if I have taken 5 attempts in my CA journey, whether I'll give marks? Badla lenge na? Badla? Yes or no? Yes. Because I have also taken 5 attempts na? I have not taken. But just try to. If suppose I have taken 5 attempts, so whether I'll give free marks? No. I'll give what? 8 marks. Do whatever you want. Do fight. No mercy. This is CA exam. If you want to fight, your next attempt will be again what? In a bad condition. There is no rule of giving marks. There is no rule. It is subjective term. And correct also. I am also correct. He has used full amount. I'll give full amount. But you have used half. So I'll give half marks. Correct now. So I am also correct in giving marks. And there is no subjective here. However, your answer might be correct as per your understanding. So don't play with ICI emotion. Don't play with ICI emotions. Correct? Now, it might happen some student might be getting full marks also. That depends upon who is checking your paper. But I am just given this point. Ki don't change. But suppose time does not permit. You have only 5 minutes left. Be smart. Be smart. In that case, you can use that. So I will say you take decision as per your time availability. So be smart. If you can't score 40 marks, score 8 marks na. What is good? 0 marks or 8 marks? 8 marks. Smart work. But marks will be deducted. How much I don't know. How much I don't know because I am not checking the paper. But if I'll check, I'll give full marks. Because I am CA now. I can understand you because I am a teacher. I am a teacher. I can understand the emotions of student. Now this much you can do. Am I right or not? This much you can do. Now on 31st December 2002, Will Company Limited approached the bank citing liquidity issue in meeting the cash flow requirement for immediate installment and renegotiated terms of loan with the bank as follows. Interest rate is 15%. This interest rate 15% is what? Modified contractual rate of interest. Very good. Repayment of outstanding principal in 10 equal installments starting from 31st December 2003. Payment of interest on annual basis. Record journal entry. But whether they have given market rate of interest on the date of modification. So what do you assume? 15%. But in your exam question they may give. Now don't assume as per this question it will be always equal to 15%. Because only one question of this nature has been given. Suppose in your exam they have given market rate of interest is 17% or 14%, then you need to use that market rate of interest. In this question we have assumed that market rate of interest is equal to what? Modified contractual rate of interest, because the contract is at market terms. Now because there is no transaction cost, ER will be also equal to what? 15%. ER will be also equal to 15%. Now this is a question I like to show with the my solution, because I see a solution I don't like. You like? This is the question. Yes. So you can see I have first I have done the analysis. The proceed is 50 lakh, transaction cost is this much. So your initial liability will be 49 lakh, 49 crore, 41,000, 29,000, whatever. Contractual rate of interest 11%, market rate of interest 11%, ER is equal to 11.5%. On the date of modification, this is given, this is not given, this is not given. So this will be always equal to modified contractual rate of interest, because not given 15%. Now original contractual cash flow, because they have given principal amount, will be repaid originally in 5 equal installment. So 50 crore become 10 crore, 10 crore, 10 crore, 10 crore, 10 crore. And the contractual interest payment will be based on this principal amount. The first 50 crore into what? 11%, into 11%, 5.5. Then 40 crore into 11%, 4.4. Then 30 crore, 3.3. Then 2.2. Then 1.1. This becomes the original contractual cash outflow. Original contractual cash outflow. Correct? Understood. Then first we'll do analysis of modified terms. Abhi we have not done modification. In this question only one doubt is there. Just try to understand. On this date modification happened. Now on this date modification happened. Why? Because they were finding difficult to pay the amount. Now question is that whether this 4.4 interest has been paid or not paid. Means this principal amount and interest amount has been paid or not paid. Means this is to paid na. Modification happened at the end of year 2. At the end of year 2. Correct? Now why modification happened? Because they were finding some liquidity issue. Because they were not able to repay the amount. The question arises, this principal amount is to not paid. The doubt will come for interest amount, whether paid or not paid. Paid or not paid? Not paid. Prima facie this answer will come. Means even though I am saying, I will also say what? Not paid. But we will read the information given in the question. Correct? So I will write the prima facie. If I say, everyone will say not paid, because we have liquidity issue. We have a liquidity issue now. So prima facie this is correct answer. But we need to go as per the information given in the question. Let's see what is the information given. What is given? You can see this sentence. What is the modified term? Repayment of outstanding principal. Oh, in 10 equal installment, it means, can you say principal amount is not paid, but interest amount has been paid. Because they have written outstanding principal only. Principal means principal. It means on the date of modification, what is paid? Interest component has been paid. Means if suppose they have written repayment of outstanding amount, the amount is inclusive of what? Interest. But they have written outstanding principal. The outstanding principal means at the end of second year, what is paid? Interest component has been paid. Here also you can do mistake. If you will not read the question carefully, it means this is paid, this is paid, this is paid. So what is the outstanding principal amount? 40 crore. And this 40 crore will be now paid in how many installment? 10 equal installment, means 4 crore, 4 crore, 4 crore, like this. Correct? Now we'll do analysis of modified terms. So analysis of modified term, what is A? A is what? Present value of modified contractual cash flow and legal fee paid. In this question, legal fee paid is what? 0. 0. On the date of modification, nothing was paid. So legal fee paid in this question is 0. In your exam question, there may be some legal fee paid. Correct? So modified contractual cash flow and legal fee paid, if any, discounted at original EIR. Original EIR. What is original EIR? 11.50%. 11.50%. Now we need to find out year 1 to 10 modified contractual cash flow. What is the principal? Principal will become 40 It is 40 crore divided by 10. So 4 crore, 4 crore, 4 crore, everything. Okay. Plus interest. Interest will be calculated which amount? Interest will be calculated which amount? You don't have question. Interest will be calculated by which amount? Which rate of interest? 15%. Modified rate of interest. That is 15%. 15% of 40 crore, how much? So first 6 lakh. Then it will be diminishing balance. So 40 crore minus what? 4. Balance is what? 36. 36 crore into 15%, how much? 5.4. Then what? 4.8, 4.2 you can calculate. You can calculate. Understood? This become modified contractual cash flow. Modified contractual cash flow. Most of the students will do mistake here. Most of the students. And if you have done correctly, believe me, balance question is very easy. So they targeted you initially only. This was only the main point in this question, because most of the students will do mistake here. They will not be able to identify what? Modified contractual cash flow. You might be saying, sir, easy only, but in class easy. In exam, difficult. Because exam 3 hours and mind does not work. Understood? 1 second. Have you understood this point? Can you calculate in exam? Yes, sir. Then present value at what rate? Bolo, at what rate? 11.5%. Present value you can calculate, you can find out this, and there is no legal fee paid, 0. So this become A. This become A. Now B is what? Amortized cost. We can calculate amortized cost by using amortized cost table. So year, opening liability, interest at 11.5%. This is original year, na? Original year, contractual cash outflow, closing liability. We do for how many years? 2 years. Because modification happened at the end of 2 years. So year 1, what was the opening liability? Fair value minus transaction cost. Interest at what rate? 11.5%. What was the original contractual cash outflow? It was 10 crore plus 5 crore 50 lakh. Means it is 15 crore 50 lakh. 15 crore 50 lakh. Then this become closing liability of first year. Then this will become opening liability of second year. Then once again interest at 11.5%. Then this is how much? Only interest part. Why? Because principal part is not paid. So what was the only interest part? 4 crore 40 lakh. But 10 crore was not paid. Understood? So 4 crore 40 lakh you have deducted. Why you have deducted only interest? Because principal was not paid. Interest was paid as per the information given in the question. So this become your closing liability. This become amortized cost at year end 2. Understood? Now A minus B you can find out. Compare with 10% B you can do. Of course A minus B is more than this. Therefore you follow what? Extinguishment accounting. Therefore you follow extinguishment accounting. This is only analysis. Now we'll come to extinguishment accounting. Now it become very easy. Means what I want to say, just try to understand. Suppose this is not correct also, but this will be correct now. Because if suppose any time, even the calculation mistake you have done, but can I say always most of the question A minus B will be more than what equal to 10%. Are you getting what I am saying? So even though suppose some calculation mistake you have done, so this B part, the second part of this question is not based on what first part. So your second part will be correct. Then also you are getting some marks now. You are getting some marks. Therefore don't leave it. Don't leave it. Understood? Correct. Now extinguishment accounting. First we'll find out fair value of new liability. The fair value of new liability will be what? Present value of modified contractual cash flow. Means modified contractual cash flow is this. Discounted at what? Market rate of interest. What is the market rate of interest? In this question 15%. What will be this amount without calculation? Because this you have calculated which rate of interest? 15% now. So if you do discounting at 15%, what amount will come? 40 crore will come. So there is no need to calculate only. Are you able to understand what I am saying? 1 second. Just try to understand what I am saying. Okay, this is what? This we have done what? Compounding. Compounding at 15%. Discounting at 15%. Same principal amount only. So there is no need to calculate. Understood what I am saying? So that only I have said. Ki fair value new liability will be present value of modified contractual cash flow discounted at current market rate of interest. That is 15%. That will be equal to 40 lakh only. 40 crore only. If you apply your common sense, you can do it. There is no need to calculate. Chalega. Now, understood? Then we'll find out calculation of gain or loss on derecognition. Fair value new liability 40 crore. Carrying amount already be calculated in point number B. This will, there is no legal fee paid. This will become loss. Loss will be transferred to PL. Correct. Then we can find out amortized cost of this 40 crore. Of this 40 crore calculated by which interest rate? 15% only. So you can see 6 crore will be interest and the payment is what? 10 crore. As per what? This will become your carrying amount and you can do it for all the years. This is only one good question I will say. But from my point of view, if they will ask now any question, they will modify the question. But the concept will remain same. In this particular point, from my point of view, they will modify the question. They will modify what? They will give a market rate of interest. They will give some market rate of interest. They may modify like this. Entire question will remain same. Only the information might change. I think if you have understood, you can attempt. Correct. One more thing. When I say attempt, I always say attempt it. I don't say you do correct or wrong. Attempt, you need to attempt because for passing only 50% is required. Means perfection is not required only. We are not here to become perfect. Means any chartered accountant, you ask me, 90% are at what limit? 90% CA will be from 50% to 55%. 90% CA in India. 50% to 55%. Are you getting? Rank holders are how? We can count rank holders. And we don't want to become rank holder, right? We don't want rank. You want, then prepare, okay. If you want rank, but I don't want rank. I want only 50%. Perfection not required, na? Perfection required. So for getting 50%, only you need to attempt. Whether correct or wrong, they will decide. Attempt, you will get 50%. Attempt, na? They will bound to give 50% mark because you attempted. So when you are not attempting or you are doing some initial blunder mistake, then marks become 0. So avoid that blunder mistake, what you are doing initially, and attempt it. Some calculation mistake everyone do. We are human being. Are you getting what I am saying? So for that 50% marks to aa jata. So what I am saying, attempt is more important. Chalega? This also you have understood. It does not mean when you are thinking about rank, don't think about rank. Think about rank only, okay? Because we are here to score good marks, good marks. Okay? But if you think that we can't achieve 50%, that is not correct. Because for 50% the perfection not required. And I always say if you can pass CA Inter, so definitely you can pass CA final also. CA Inter was easy exam, complicated exam? CA Inter was easy or difficult? Arey bol do yaar. CA Inter was easy. Who is saying easy? I will say Pranam Bhava. Anyone saying CA Inter easy exam? Everyone passed CA Inter, na? Anyone who came jumping CA Inter? So everyone passed one of the difficult exam, na? So if you can pass that exam, you can pass CA final exam also. This is the only rule. Rule is that. Okay? Chalo. This is also done. Now let us come to next point. Lunch break you required what time? Bolo. Require at what time? Don't require. At 2 or at 1:30? 1:32. Right now. Right now you want. Are bolo 1 or 1:30 or 2? 1. Chalo, neither you nor me. 1:30. I was thinking 2. So 1:30 I will give. Okay. 1:30. Chalega. Bolna yes or no? 1:30. Because 2 to 5 so you should not eat only. 2 to 5 is what? Your exam time. And that time don't sleep also. How many you sleep at 2 to 5? Anyone who sleep at 2 to 5? Don't sleep at that time. That is the time where the most sleep will come. Your brain will not work because you take heavy lunch yahan tak. Once you take heavy lunch yahan tak, you will sleep. So don't sleep at 2 to 5. Institute also play with you. Intensely they have given 2 to 5. Because sleeping time na. After lunch, maja aa raha. So if you are sleeping at 2 to 5, don't sleep. Chalo. One more concept will take. Modification. Now, this is not yet completed. Now, modification accounting. This is not so much important. But you don't know ICI. Not so much important, but you don't know ICI. This time they will give this question only. Then now modification accounting means when the equation is not satisfied, means the modified terms are not substantially different from original term. So we use modification accounting. But IND AS 109 is silent regarding accounting treatment. Therefore, ICI has given two alternative accounting treatment. ICI has suggested two alternative accounting treatment. So because we are giving ICI exam, we will follow what? ICI suggestion. When you will become CA, you give your own suggestion. But in exam, so you will follow what? ICI suggestion. So approach one is what? Approach one is simple. Entire gain and loss will be transferred to PL immediately. Means whatever gain and loss occur, it will be transferred to PL immediately. That is approach one. In approach one, whatever legal fee paid, that will be charged to PL as an expense immediately. Approach one we are doing. So legal fee paid on the modification date will be recognized as an expense on a modification date. What journal entry will do? Modification expense account debit to bank. Simple. Then we need to restate the liability. Restate the liability means we need to find out revised liability. Revised liability will be equal to, not revised liability, but by using market rate of interest or EIR. If you calculate revised liability, you will use what? Revised liability means revised amortized cost. You will use market rate of interest or effective rate of interest. Effective rate of interest. My help is not required now. So in this case, the revised carrying amount will be what? Present value of modified contractual cash flow discounted by using original EIR. Discounted by using original EIR. So you can find out revised carrying amount. Then revised carrying amount compare with the original carrying amount. There will be either increase in liability or decrease in liability, that will be transferred to PL as a gain or loss on modification. Gain or loss on modification. Means compare revised carrying amount with original carrying amount. Any difference will be gain or loss. This gain or loss will be transferred to PL. This is simple one. Then based on this, calculate amortized cost for the remaining liability. You can do that. This is what approach one. Approach one is more simple than approach two. Okay. But approach two is more fair. Means I will say approach two is better accounting. Approach two is better accounting. What is approach two? Legal fee, whatever you have paid, that will be deducted from liability, original liability. So whatever legal expenses paid, that will be not recognized as an expense, that will be deducted from original liability, as if this is amount paid for the liability. So we'll pass one journal financial liability account debit to bank. Therefore, can you see your liability will change? So that is known as adjusted liability. Adjusted liability will be equal to carrying amount minus legal fee paid. That become adjusted liability. Now in this, now we need to calculate revised EIR. We'll find out revised EIR. Revised EIR will be the rate of interest at which present value of modified contractual cash flow will be equal to what? Adjusted liability. Will be equal to adjusted liability. Means you need to calculate revised EIR. However, from my point of view, revised EIR might be given in the question. If not given, you need to calculate it. Of course, you can calculate it. So this is the rate of interest at which present value of modified contractual cash flow will be equal to adjusted liability after point number A. Correct. It means, can I say in this, so you have not recognized any gain or loss. An entire gain or loss will be automatically adjusted with interest expense during the lifetime of the financial liability, remaining life. Correct. So prepare amortized cost table by applying revised EIR. So on this adjusted liability, apply revised EIR to find out interest expense and amortized cost. This is approach number 2. What you will follow? Approach 1 ki approach 2. If suppose question came, you can follow either of these, either approach 1 or approach 2. From my point of view, approach 1 is easier than approach 2. But instituting one of the illustration, only one illustration given, question is not given. Illustration given. In that they have used what? Approach 2, because that is better accounting. But from my point of view, even though they have used approach 2, you can follow either approach 1 or approach 2. But for margin of safety, because ICI has used what? Approach 2, I think that you should go for what? Approach 2, because don't play with ICI. Chalega? Understood? But less chances. But can I say, if they ask, you can do it? You can ask, if ask, you can attempt now. One illustration has been given that you can do by your own. Correct. With this, we completed all the question before derivative accounting. Abhi the chapter is not over. Now, once this is over, then we can come to derivative accounting. Derivative accounting is very simple because only 2-3 questions has been given and they will ask that question only. I know. So up to this is the major part of this chapter. Major part means good question they will create from this only. If you have understood this, then balance part, of course, that is also important. Last time they have asked question from derivative only, embedded derivative they have asked one question. So last time they have already asked one question from embedded derivative. So whatever balance part, that is also important. I am not saying it is not important. This become good quality of questions where students normally do mistake. Correct. Have you understood all the part? I hope you have understood. Now, can I proceed for half an hour? I can proceed now. You can sit, I can sit. I can sit 8 hours without eating. Because we are habituated of that. Correct? I can sit without eating for 8 hours. You can sit 3 hours? Yes, 3 hours to pakka because 3 hours is exam time. 3 hours no break, no emergency break, no biological break. No break 3 hours. That much the potential you should have. Because if you take biological break, your 10-20 minutes wasted na. You should control yourself for how many hours? 3 hours. And 2 to 5, basically that. Okay? Chalo. Now, let us come to some other part of this chapter. So you can see we have done up to this. Acha. One topic is reclassification of financial asset. No good question has been given on this. No good question. Reclassification of financial asset. So normally we see that if the question is not there, they will not ask. This is a trend. However, MCQ question can be asked. Reclassification of financial asset. So this is what for 2 marks. Reclassification of financial asset. Now, can the financial asset is equity instrument, debt instrument, or derivative instrument? Derivative instrument is always FVTPL. So no scope of what? Reclassification. So reclassification concept is not applicable for derivative instrument. Equity instrument can be either FVTPL or OCI, and OCI option is irrevocable. Means it can, once applied it cannot be changed. So here also reclassification is not permissible. So reclassification is not permissible for equity instrument also. Only it is permissible for what? Debt instrument. Means this concept is only applicable for debt instrument. It is not applicable for equity instrument and derivative instrument. Means can I say debt instrument means either it can be AC, it can be FVTOCI, or it can be FVTPL. So reclassification means it can be reclassified to either FVTPL or OCI, or this can be reclassified to AC or FVTPL, or this can be reclassified to AC or FVTOCI. Means there are 6 possibilities. There are 6 possibilities. Understood? Now, whenever reclassification question comes, so there are 3 points which you need to understand. Okay, reclassification will be done at what amount? So, in all possibility, reclassification will be done at fair value on reclassification date. On fair value on reclassification date. First point is very clear. So, find out fair value on reclassification date. That will be given in the question. If not given, you know how to calculate. How to calculate present value of remaining contractual cash flow discounted at current market rate of interest, if not given, but 99% they will give. Correct. So you can see all possibility: fair value, fair value, fair value, fair value, fair value, fair value. Correct. First point done. Second point, due to reclassification or due to remeasurement, there will be some gain or loss. That gain and loss will be transferred to PL or OCI. Either it will be transferred to PL or it will be transferred to OCI. So if it is AC to PL and to OCI, so this will be transferred to PL and OCI. Understood point? I think no doubt. If it is FVTPL to AC to OCI, so this will be transferred to PL and PL, because this is what? FVTPL. No doubt. Now, if it is FVTOCI, it becomes AC and FVTPL. It will, because it is OCI, it will be transferred to OCI and OCI. Now one doubt will come. Doubt is what? Ki sir, this is PL, this is OCI. You are transferring to PL and OCI. But this is OCI, you are transferring where? PL. This doubt will come. Doubt you understood? In exam you will be confused. Right now, you are saying yes, sir, yes. Right now, whatever you are saying, you are actually not understanding. In exam, actually, you apply what? Mind. And exam, mind become 0. Mind will not work, na? Bolna re. So right now only we should think. Actually, this is actually correct. FBTPL, AC, OCI. So this is FBTPL. So this is transferred to what? PL. If this is FBTOCI, this will be transferred to OCI. So I think in this no doubt. Doubt will come in this. Now whenever reclassification is there, so reclassification is done on prospective basis or retrospective basis? Prospective. Means from the data, reclassification. Just try to understand what is the actual rule. Rule is what? Rule is what? Just try to understand. Suppose this was FBTPL and now it become FBTOCI. Correct. So during this period it was FBTPL ke OCI. So therefore gain or loss will be transferred to what? PL. From this date it will be transferred to what? OCI, because we are doing prospective accounting. Understood? Now if it is FBTOCI and become FBTPL, you say this gain or loss will be transferred to what? OCI. In this, so no doubt is coming. Doubt is coming when it is AC. Now just try to understand. If it is AC and now it become FBTPL, so during this period it was AC or FBTPL? But for AC, so there is no fair value gain or loss only. So it means you are calculating gain or loss on which date? In this date now. Now it become what? FBTPL, and therefore gain or loss is transferred to what? PL. And if it become FBTOCI, then OCI. Understood what I am saying? Correct. Because it was initially AC, there was no fair value gain, there was no fair value loss. So on this date, we are doing prospective accounting only. On this date, it become FBTPL, so that gain or loss will be transferred to what? PL. On this date, it become FBTOCI, the gain or loss will be transferred to what? OCI. But high chance of the mistake, 2 marks, you will do mistake. So thoda sa be careful about this point. Now third point is what? Measurement of EIR. Means what EIR? Whether EIR require changes. Correct. Now just try. Once it become FBTPL, whether you require EIR. For FBTPL, whether you require EIR? No. Because for FBTPL, there is no amortized cost. There is no interest calculation. There is no interest calculation. So you can see once it become FBTPL, EIR is not applicable. Once it become FBTPL, EIR is not applicable. Understood? It means it become AC or FBTOCI, then EIR is required. Then EIR is required. So once it become AC to FBTOCI, so for AC there was EIR. Now for FBTOCI also you require EIR. So no adjustment required. You use original EIR. Means whatever you are using for AC, same EIR will be used. You can see no adjustment due to reclassification. It remains use original EIR. Once it become FBTOCI to AC, so for FBTOCI using original EIR, for AC also you will use same original EIR. Correct? So no adjustment due to reclassification. It means use original EIR. Doubt will come कि once it was FBTPL, now it become AC and FBTOCI. So for FBTPL, so there was no EIR, but for FBTOCI and AC you require EIR. So you need to calculate EIR. You need to calculate EIR. So can calculate EIR means what? Calculate EIR on the date of reclassification. It will be present value of means the rate of interest at which the remaining contractual cash, present value of remaining contractual cash flow will be equal to what? Fair value on reclassification date. Fair value on reclassification date. However, that EIR will be given in the question. EIR will be given in the question. So this is calculate EIR based on fair value on reclassification date. Calculate EIR based on fair value on reclassification date. This is the total understanding. Have you understood? So I think this type of question can be asked. If you have understood, you can do it. 2 marks question, but we don't know the level of MCQs right now. Last time it was basic question they have asked. We don't know in this attempt they are increasing the level or they are asking the basic question only. Chalega? Yes, sir. Then financial liability we have done. Derecognition, modification we have done. Coming to impairment of financial asset. Impairment of financial asset. Impairment of financial asset. Just try to understand. Impairment of financial asset. However, this total discussion is thoda sa very extended topic. But if I stick to examination point of view, whatever question they have given. So what you should do? First step is what? Calculate carrying amount of financial asset on the date of modification. This you can find out amortized cost by applying what? EIR. By applying EIR. Understood? This you can find out now on the date of impairment. Impairment means what? There is some expected credit loss. Expected credit loss means some amount might not be received. Some amount might not be received due to some indicator, whatever you have got the information from market. Then you find out the present value of contractual cash inflow which are expected to be received, by using original EIR only. Means you are calculating revised carrying amount. Revised carrying amount by using what? Original EIR. The present value of contractual cash inflow which are expected to be received. This information will be given what amount is expected to be received. We can't estimate now. So that information will be given, this amount is expected to receive and this amount is not expected to receive. That will be given in the question. To find out present value of contractual cash inflow which are expected to be received. Suppose this was 10 lakh and this is 9 lakh. So 1 lakh become your loss. This is known as expected credit loss. We call it what? Expected credit loss. Expected credit loss. Understood? So what do you mean by expected credit loss? First find out what? Carrying amount of financial asset based on amortized cost table, whatever is given. Means by using original EIR. Then find out present value of contractual cash inflow, remaining contractual cash inflow which are expected to be received. That information will be given by using original EIR because you are calculating revised carrying amount on the date of impairment. So this was 10 lakh, this is 9 lakh. So how much you are not receiving? 1 lakh. That become your expected credit loss. Now you need to find out whether it is 12-month ECL or lifetime ECL. 12-month ECL normally used for good debtor and lifetime ECL we use for doubtful and bad debtor. However, till now they have not asked any question of 12-month ECL or lifetime ECL, giving that information. Correct. But I am just giving, suppose they have given 12 months, they will inform you 12-month ECL, lifetime ECL. Because we cannot identify in exam by our own whether it is 12-month ECL or lifetime ECL. So they will inform you. If it is 12-month ECL, your allowance means impairment loss, you can add impairment loss will be equal to ECL multiplied by probability of default in 12 months, in next 12 months. That probability of default will be given in the question. Understand what I am saying? That probability of default will be given in the question. In this case, impairment loss will be equal to ECL. ECL means this amount. ECL means expected credit loss. Multiply by probability of default in lifetime. In lifetime. Correct. Normally question remains silent about what? 12 month and lifetime. So we assume what? Lifetime only. And if the probability of default is not given, we'll assume 100%. Means we'll assume it is bad debt. If nothing has been given. If nothing is given, we'll apply this formula and we'll apply probability default is 100%. Normally two good questions has been given. In both good questions, they have not given the probability of default. So we have assumed what? 100%. This is the entire concept. Now any question come, you can do it. Any question comes, you can do it. So what is the point? But first you will calculate what? Carrying amount of financial asset. That you can do simple amortized cost you need to calculate. Then find out present value of contractual cash inflow discounted by original EIR for remaining contractual cash inflow by using original EIR. The contractual cash inflow which you are expected to receive. The difference between these two will be ECL, expected credit loss. Then find out from the question whether it is 12-month ECL or lifetime ECL. That they will provide the information. If they have given 12-month ECL, you need to find out probability of default in 12 months, next 12 months. That information will be also given. Correct. Then your impairment loss will be ECL multiplied by probability default in the next 12 months. If it is lifetime ECL, then the formula remains same, but you need to find out probability default in lifetime, which may happen in lifetime. You only say probability default in 12 months will be more, ki probability default in lifetime will be more. In the next 12 months will be more, ki in lifetime will be more. Lifetime, and therefore for bad and doubtful data, we use lifetime ECL. For good data, we don't use what? Lifetime ECL. Understood? Correct. This much have you understood? Now, if you know this, you can do anything. But this impairment loss, this concept is not applicable to FBTPL. Means any financial asset which is measured at FBTPL, this impairment loss concept is not applicable. Why? Because this is already measured at fair value. Correct. This is also not applicable to FBTOCI, equity instrument. Because again, this is also measured at fair value. So for these, this impairment loss concept is not applicable. Means this is applicable only for debt instrument which is measured at FBTOCI and debt instrument which is measured at amortized cost, and also lease receivable. Lease receivable means IND AS 116. IND AS 116 says the impairment will be done as per IND AS 109. So they may ask 2 marks question, ki impairment loss is applicable for what? So impairment loss is applicable for what? Debt instrument, FBTOCI, debt instrument, amortized cost, and lease receivable. Understood? However, it is not applicable for what? FBTPL, any FBTPL. It is also not applicable for equity instrument which has been measured at FBTOCI. So this concept is not applicable for this because these are already measured what? Fair value. Understood? And there is no contractual cash flow that. That is also one of the reasons. But I hope you have understood. One question, good question is there. Let me take that question. 56. On 1st April 2001, entity granted an interest-free loan of rupees 5 lakh to an employee for a period of 3 years. Interest-free means contractual rate of interest is what? 0%. The market rate of interest of similar loan is what? 5%. But it is what? At market term, off market terms? Off market terms. So market rate of interest is how much? 5%. So of course, fair value will not be equal to transaction price paid. Fair value will be equal to present value of contractual cash inflow discounted at market rate of interest. So there will be some difference. The difference will be transferred to which account? Prepaid EV expense account. Prepaid EV expense account. This much so you can do. This much so you can do now. Then on 31st March 2003, something happened. Means after how many years? 2 years. At year end 2. Because of financial difficulty, the employee asked to extend the interest-free loan for further 3 years. For further 3 years. Means initially it was how many years? 3 years. And how many years expired? 2 years. So what is the extended period? 1 plus 3 means remaining year will be 4 years. So they have done what? Some changes. But due to financial difficulty, whenever there is a financial difficulty means it is a question of what? Impairment. It is not a question of modification. Modification means without financial difficulty. And due to financial difficulty means it is a question of what? Impairment. It is a question of impairment. Understood the difference? So whenever you are doing modification, that is not due to financial difficulty. Then it is a question of modification. Chalega. The entity agreed under the restructured term, repayment will take place on 31st March 2007, means after 4 years. However, entity only expect to receive a payment of 2,50,000 given the financial difficulty implied. Means now they will not receive 5 lakh, they will receive only 2,50,000. So they have given what is the amount expected to receive, 2,50,000. Explain the accounting treatment they have asked. So first you will find out what fair value of financial asset on which date, initial date. So that will be present value of 5 lakh discounted by using 5%. That you can calculate. So that will come 4,32,000. Means you will do 5 lakh multiplied by, can you give me the annuity present value factor? Because interest, contractual interest is 0. Contractual interest is 0. So how much? At what rate of interest? 5%. Can you give me annuity factor? Present value factor? Present value factor? Calculate. 0.838. How much it is coming? 4,32,000 approximately. Okay. Minus this is coming 68,000. So this will be financial asset account debit, prepaid EB expense account debit to bank. Now for this you can calculate amortized cost. We want amortized cost at year end 2. So at year end 2, this will be the amortized cost. This you can find out. Now. So this become amortized cost at year end 2. Correct. So this become 4,76,280 is what? Amortized cost carrying amount. Now I'll find out the present value of expected cash flow to be received discounted by using original EIR. So what is the expected amount? 2,50,000. But that will be received after how many years? 4 years. Using which rate of interest? Original EIR. So can you give me annuity factor? Present value factor at what rate? 5%. For how many years? 4 years. Can you give me? .8227. How much amount is coming? 2,05,675. What is the difference? Four 2706 04. So this is the amount of what expected credit loss, because they have not given any probability default. They have not given any 12-month measurement or lifetime measurement. So ignore that. Probability default will be 100%. Multiply by 100%. This will be the allowance for bad and doubtful debt. Means this is the amount of impairment loss. So you will create this much impairment loss. What journal entry do? Impairment loss account debit to financial asset with this amount. That journal entry only done. Check karo. 2 lakh. Dekho, exactly same. There is some difference coming because of discounting factor approximation. Chalega. So same amount is coming. What journal entry they have done? Impairment loss to financial asset. This amount reduced from financial asset. Now financial asset will be coming at which amount? This amount it will come 2,05,000. 2,05,675. Now you can do again amortized cost for remaining 4 years by using original EIR. That only I think they have done. They have done that only. This is one of the expected question. Good question. Means good question of I will say 6 to 8 marks. Which can be asked. There are some simple question given that you can do by your own. However, whatever question I am not doing, that can be also asked. Okay. So do some question by your own also, which is given in ICI study material. Okay. Now this done. So impairment loss examination point of view done. However, this is a detailed discussion. That much is not required from exam point of view. I hope you have understood this much. Coming to derivative accounting. So before break, now we'll do only derivative accounting. Then after break, we'll do the balance. Now derivative accounting means, can you say we are doing about option and future? Option and future means forward contract. One question of this nature has been given and they will ask that question only. Now, whenever derivative accounting, so either it is held for the purpose of trading or it is held for the purpose of hedging. There are two viewpoints. Either it is held for the purpose of trading or it is held for the purpose of hedging. You know hedging. Hedging you all know, after AFM to hedging you know. AFM, correct. Held for the purpose of trading, so it will be simple accounting FBTPL.
Means initial recognition will be done at what? Fair value. Subsequent recognition will be done at what? Fair value. Any gain or loss will be transferred to what? PL. And if it is held for the purpose of hedging, so there is a separate accounting known as hedge accounting. Now what is hedge accounting? That is a separate discussion. Hedge accounting only they have given one question. In this also they have given one question. So from exam point of view, two questions, that concept is over. And both questions are important from exam point of view. Till now this point has not been asked in exam. They have asked this point in exam. Okay, let me take one question to explain this. This is only one question. On 1st Jan 2001, SAM Company Limited agreed to purchase $20,000 from JT Bank in future. In future means forward contract. On 31st December 2001 for a rate equal to 68 per US dollar. This 68 is what? Forward rate. Forward rate means you can say strike price or exercise price, whatever you want to say. Same company did not pay any amount upon entering into the contract. So on entering into that contract, nothing has been paid. It means the fair value of forward contract is 0. Nothing has been paid. It means the fair value of forward contract, initial fair value is what? Nil. Initial fair value is nil. Then same company is a listed company in India and prepare financial statement on a quarterly basis. So because they are preparing quarterly basis, there are four reporting date as per interim financial report. So we will do subsequent accounting for 4 reporting date. There are 4 subsequent accounting. Follow the principle and recognition of IND AS 109. They said to record the entry for each quarter till the date of actual purchase. Actual purchase means they want to purchase US dollar. This forward contract can be of 2 types. Either they will go for physical settlement or they will go for net settling cash. So because the question they have already said actual purchase means they want to do physical settlement. They want to actually purchase the US dollar. For the purpose of accounting, please use the following information representing mark to market fair value of forward contract. Means they have given fair value of forward contract at each quarter date. Means what is the fair value? It is negative. Means it is unfavorable for the party and therefore it becomes negative. Negative means there is an obligation to pay. It is a liability. It is a liability. So whenever it is unfavorable, there is an obligation to pay. So whenever any derivative contract is unfavorable, it means there is an obligation to pay. Favorable means there is a right to receive. And that obligation to pay will become financial liability and right to receive will become what? Financial asset. Means depending upon the information given question, we need to find out whether unfavorable or favorable. So whenever they have a negative amount, means there is an obligation to pay. So it becomes liability. Here also negative means unfavorable, means liability. Here it become positive, means become what? Favorable. It become asset. It become asset. Understood what I am saying? And last spot rate they have given on 31st December 2001. So we need to find out at the settlement date it is favorable or unfavorable. That we need to find out. So just try to understand. We have done one contract to purchase 20,000 US dollars at 68. That was our contract. But the market price becomes 66. Means actually we need to pay as per the contract 68. Even though the market price become whether favorable, unfavorable. Unfavorable. So can you say here it will be liability? What will be liability? 20,000 into what? 2. So 40,000 become liability. So last may it become 40,000 liability because it is a unfavorable situation. Unfavorable situation. Means just try to understand. Initially on the date, initially the fair value was nil. Initially the fair value was nil. Then it become liability how much? 25,000. Then it become liability how much? 15,000. Then become asset how much? 12,000. Then it become what? Liability how much? 40,000. This is the question. Means initial journal entry what? On the date of contract what journal entry? Because fair value 0, nothing, no journal entry. Then on this date your loss is how much? 25,000. So you will pass one journal entry. What journal entry? Fair value loss. Yeah, PL account debit to derivative financial liability with 25,000. PL account debit to derivative financial liability with 25,000. Then your liability decreases. From 25,000 it becomes 15,000. So there is a gain or loss. So that become gain. So you need to decrease your liability by what amount? 10,000. So what journal entry will do? Derivative financial liability to fair value gain, and that gain will be transferred to PL account. But with what amount? 10,000. Normally here student do mistake, they will do journal entry with what? 15,000. I mean, class में you understand, but exam में you will do this mistake. Then your liability 15,000 become what? 12,000 positive, means it become asset. So there is a gain of how much? There is a gain of 15 or 12? There is a gain of what? 27,000. So once again gain of 27,000 means de-recognize 15,000 liability and recognize financial asset of how much? 12,000. So you will pass one journal entry derivative financial liability account debit how much? 15,000. Derivative financial asset account debit how much? 12,000. To fair value gain how much? 27,000. Then again 12,000 become 40,000 liability. So there is a loss of how much? 52,000. So once again positive amount become negative amount. So your loss become what? 52,000. What journal entry? Fair value loss 52,000. To derivative financial asset de-recognized 12,000. To derivative financial liability how much? 40,000. So on the date of settlement, what is your liability? 40,000. Your liability is 40,000. Now what will be the settlement journal entry? Settlement journal entry. Now if it is settling cash, suppose it is settling cash, net settling cash, then your journal entry will what? Derivative financial account debit to cash or bank 40,000. Simple journal entry. So if it is net settling cash, then your journal entry by receiving or paying the amount. Receiving means asset, paying means liability. But if it is physically settled, so it means, can you say, you need to recognize the underlying asset. Underlying asset, you know. What was the underlying asset? Underlying asset was dollar. So it means you need to recognize dollar. So you will pass one journal entry, bank, dollar, account debit. But it will be recognized at what amount? $20,000 into what? 68 or 66? 68. Here only we do mistake. 68 or 66? Huh? 68 or 66? 68. You are saying 68. How many are saying 68? How many are saying 66? 6 is correct. Because this will be valued at current fair value. What is the current price? What is the current fair value? Because you are recognizing a financial asset now. So financial asset we always recognize initially at fair value only. Correct. So this is how much coming? 20,000 into 66? Bolo? $13,20,000. It means underlying asset will recognize at what fair value? Current fair value. To how much you will pay? Okay, the payment will be done in rupees. So it will be 20,000 contract price was 68. So payment has been done in rupees. You purchase dollar, you are paying rupees. So dollar will come in and rupees will go out. Debit what comes in, credit what goes out. Bachpan. Yaad aaya? So this is what 13 lakh. And the difference is what? That 40,000 was liability already recognized. Now that liability will be closed. That liability will be closed. You say derivative financial liability account debit 40,000. This journal entry. In your exam, it can be favorable situation at the end. So there will be derivative asset then. If there is a derivative asset, then what journal entry in this case? Bank account debit to derivative financial asset. What journal entry in this case? Then derivative asset will be credited. Means this will be more than this amount then. That is a favorable situation. Favorable situation. And so this is only one question. I don't know why they are not creating question on this. We should expect good question on this because we have in AFM a derivative chapter. One full chapter we have. But ICA is not asking because they know that they don't want to kill you in exam. Means ICA is good only. They have not created till now any good question on this. So we expect that they will not go beyond this. What is the trend? Trend is what? 95%. 5% chance is that a new question is created on exam only. But 95% they will first give the new question in RTP MTP. And then they will ask new question in exam. 95% chance is that. First they will create new question by giving in RTP or MTP. And then they will ask where? In exam. 5% chance is that they directly ask new question where? In exam. So if you have done some PAP in your pichle janam, in your previous birth, then that situation arises. So 95% normally the question of RTP, MTP exam questions only come. And even new question is for everyone. So do whatever you have understood. Correct. So this was also done. This is only what for derivative financial instrument. Correct. Now hedge accounting. One hedge accounting is left. What is left here? One hedge accounting, one question I will take because one question is given. Then there is one embedded derivative concept. There were two type of question, but one has been already asked in last attempt. We don't expect that type, but it may be asked. So if you want, I will do both the two questions. Okay. Then there is one more important concept, financial guarantee. Financial guarantee, which is also expected in exam. So these three topics are left. If you complete these three topics, all practical type of questions will be covered. MCQ though we don't know from where they are asking. So for MCQ though you need to go through the entire chapter. Basically, from my point of view, first 4-5 attempts now, they will not increase the level of MCQs. From my assumption, this is my assumption. Correct? So they will ask only what simple MCQs only, whatever we know. Then they will increase the level of MCQs. That is my expectation. Okay. So these three topics is left. So these three topics we'll do after break. So after break we are here up to 6. We can't go beyond 6. Okay? We are here up to 6 only. So we are meeting at what time? 2. 2 chalega? 30 minutes or 45 minutes? You always want more, na? You always want more? Correct? Acha. So now I am asking, you said 2. I will give you what? 45 minutes. Chalo, ठीक है, 45 minutes. But you want to score 60 or 85? Chalo, 85. 90 तो चलो ठीक है तो okay. 85 score. So we are here to score 85. Chalo. So we'll meet after 45 minutes. 45 minutes we are meeting. Okay. Can we start again, everyone? Ready? Lunch taken? Feeling sleepy? Yes or no, sir? If you are feeling, then this is a exam time, 2 to 5. Full concentration is required. Okay? So before 2, don't eat anything in exam time. Okay? Eat at 12 p.m. only. Before that, then once you come back from your exam, then you eat. Okay. Now we were taking financial instrument chapter. Financial instrument we have done up to derivative accounting. Now there is one important concept about hedge accounting. So hedge accounting means whenever we use derivative for hedging purpose, then what will be the accounting treatment for derivative instrument, that we are going to understand. Now normally, can I say, whenever there is a hedging, so there will be one hedged item which is exposed to some risk. There is some hedged item which will be exposed to some risk, and to offset that risk, we'll take the help of hedging instrument. That hedging instrument will be derivative instrument. Correct? Now that hedged item can be of 3 types. It can be either recognized assets or liability. Recognized asset or liability means which is already recognized in the books of account. It can be any asset, it can be any liability. Means it can be financial asset, it can be non-financial asset also. Correct? Or it can be an unrecognized firm commitment. Firm commitment means a commitment has been given to purchase but till now not recognized. In simple word, I will say executory contract. Means you have done a commitment to purchase machinery, but you will purchase after 5 years. So that is known as unrecognized firm commitment. A third, it can be highly probable forecasted transaction. Highly probable means no commitment has been given, but the transaction is highly probable. Means it is going to be done in the future, but it is not committed. No commitment has been given. For example, I will announce my next batch. That is highly probable transaction, but no commitment. Till now, no announcement done, no commitment is there. So that is highly probable forecasted transaction. This can be possible as item. And if we are exposed to some risk on this hedged item, we'll take the help of hedging instrument. So hedging instrument is a derivative instrument. Understood? So there must be hedged item, there must be hedging instrument. Then only we can come to what? Hedging accounting, hedge accounting. Understood? Means the loss of these will be offset by this hedging instrument. Whatever loss, so there can be 2 types of loss. One is known as fair value loss, one is cash flow loss. Fair value loss means increase in the value of liability or decrease in the value of asset. Either there will be increase in the value, fair value of liability. So if the fair value liability increases means loss, and asset decreases means loss. So we are here right now to think about expected loss. So gain to will not do any hedging. If there is an expected loss, then only we will think about hedging. So can I say, in case of recognized asset or liability, there can be some fair value loss. So for this we use fair value hedge. There are 2 types of hedging. One is known as fair value hedging, second is known as cash flow hedging. So whenever there is a recognized asset or liability, we use the concept of fair value hedging. Because we are expecting some fair value loss. And when there is a highly probable forecasted transaction, for example, we are expecting to purchase a machinery in dollar, but dollar rate might increase, so my cash outflow is more. If dollar rate will increase, so it is highly probable forecasted transaction and we are expecting some loss. So in this case, there is a fair value loss or cash flow loss. Cash flow, we are going to pay more cash, that is the risk. Suppose we are expecting to do some foreign sales, means sales in foreign currency. Expecting, we will do some contract in foreign currency and we are expected to receive some amount in foreign currency. Now if the dollar rate or foreign currency rate decreases, so there is an expected loss. Now, so it means my cash inflow will decrease. So it means we have some cash flow loss. So it means we'll do what? Cash flow hedge accounting. So there are 2 types of accounting. One is known as what? Fair value loss, fair value hedge accounting. Second is known as what? Cash flow hedge accounting. So for recognized asset liability, we do which accounting? Fair value hedge accounting. For highly probable forecasted transaction, we do which accounting? Cash flow hedge accounting. But for unrecognized firm commitment, IND AS 109 has given two options. Either do fair value hedge accounting or do cash flow hedge accounting. This type of question can be asked in MCQs. Correct? So if there is a recognized asset liability, which accounting? Fair value hedge accounting. If there is a highly probable forecasted transaction, then cash flow hedge accounting. If there is a firm commitment, then what? Either fair value or cash flow hedge accounting. Correct? Now no question has been given for fair value hedge accounting. Only one question has been given for cash flow hedge accounting. Correct? So I need to only give the concept of fair value hedge accounting. What is the concept of fair value hedge accounting? Try to understand. There is one hedge item and there is one hedge instrument. Both are HI. But first is what? Hedged item. Second is what? Hedging instrument. So when I am saying about hedging instrument, this is derivative instrument. And these are what? Recognized asset liability. It can be machinery, it can be inventory, it can be any liability which are exposed to this fair value loss. We are expecting some loss. Suppose you purchase a machinery at rupees 1 lakh. Now you are expecting that fair value of this machinery may decline in future. So there is a fair value loss. Or you may purchase inventory and you are expecting the price may decline. Or you purchase gold. You are expecting the price of gold may decline. Or you purchase some investment in equity shares and now you are expecting that price may decline. It can be non-financial asset, it can be financial asset. It can be non-financial liability, it can be financial liability. Any asset, any liability. What is the rule? If it is financial asset, so it can be AC, it can be FBTPL, it can be FBTOCI. Correct now? Understood? Debt instrument and FBTOCI, equity instrument. Or it can be non-financial asset or liability. Rule is what? Any gain or loss of hedging instrument, hedged item and hedging instrument. Are you able to understand what I am saying? That will be transferred to PL or OCI. That we need to understand. Means they may ask a MCQ based question in this. This is hedging instrument. Instrument means derivative instrument. So in this case, both will be transferred to PL. In this case, both will be transferred to PL. In this case, both will be transferred to PL. In this case, both will be transferred to PL. But there is one exception. In this case, both will be transferred to OCI. Why? Because this is without recycling. This is the rule. Only this much. Accounting you can do. Because can I say actual loss happens, that loss will be transferred where? To PL. So any loss in this will be gain here. So this loss will be offset by this gain. If there is a gain in this, so the loss will be in this. So both gain and loss in both item and instrument will be transferred to what? PL. Only one exception is what? Keep the financial asset is what? FBTOCI equity instrument. Then both gain and loss will be transferred to what? OCI. If you have understood this much, MCQ question you can do. And if suppose practical question they ask, you can attempt. We don't know what type of question they will create, but you can attempt or not. You can attempt. Correct? This much you have understood. Can I come to cash flow hedge accounting? Now cash flow hedge accounting is very simple. Cash flow hedge. Well, if the cash flow hedge is ineffective, what is ineffective? I will explain. Then entire gain or loss on hedging instrument will be transferred to PL. Because can you say highly probable transaction? So this transaction has not been entered till now. So there cannot be any gain or loss right now. So gain or loss will arise only when you have entered into that transaction. So right now we have only gain or loss in derivative instrument. So if that hedging is effective, if the hedging is ineffective, then entire gain or loss and hedging instrument will be transferred to PL. But if the hedging is effective, when it will become effective, that I will explain. Correct? Then any gain or loss in hedging instrument will be not transferred to PL, will be transferred to OCI and accumulated in a separate component equity known as cash flow hedge reserve. cash flow hedge reserve. So we need to open one account, cash flow hedge reserve account. So any gain or loss will be transferred to OCI and accumulated in a separate component equity known as what? Cash flow hedge reserve account. Correct. And once the transaction is entered, that probable transaction actually entered, then what will be the accounting treatment of that we need to understand. What is the accounting treatment of cash flow hedge reserve? So what they want to say, if that transaction resulted in a non-financial asset and non-financial liability, means whatever transaction we have entered, that highly probable transaction, suppose the transaction of purchase of machinery, so machinery is a financial or non-financial asset? Machinery is a financial or non-financial asset? Non-financial asset. So it might result in a financial asset or non-financial asset. For example, the expected transaction was sale, so it will be trade debtor or bank. So debtor is what? Financial asset. So if the transaction has resulted in non-financial asset or non-financial liability, understood? Then this cash flow reserve account will be closed and will be adjusted with the carrying amount of non-financial asset or non-financial liability. Means will be adjusted with the carrying amount of non-financial asset or non-financial liability. Understood? But if that resulted in a financial asset or financial liability, means debtor, creditor, whatever, then this cash flow hedge reserve account will be reclassified from OCI to what? PL. Means then it will be reclassified to PL. Otherwise, it will be adjusted with non-financial asset or non-financial liability. Only one question of this nature has been given. This nature, one transaction has been given. Understood? Let me take that question. When we will do that question, some idea will come to what type of question they may ask. Very good question. Interesting question. Means when this question was created, then I said now ICI will ask this type of question. But till now this question was not asked. Means this was created in May 2021. So I was expecting in what? November 23 exam, not came. May 24 exam, not came. November 24 came now. I don't know whether it will be asked or not. But it was a good quality of question which was created by ICF for the first time for this particular concept. But till now not asked. So highly probable in your exam, the cash flow hedging is required. Correct? Na? Highly probable na? But highly probable means it may or may not come. That we need to understand. That we'll understand only in exam whether it has been asked or not. But good question. Let me explain this. Beside construction activity, Building and Company Limited is also engaged in trading of copper. So they are engaged in trading of copper. On 1st April 2001, it had 100 kg of copper costing rupees 70 per kg, totaling rupees 7,000. So they have already purchased some copper, 100 kg, cost price is 7,000. So this is inventory for them. It is inventory. Correct. The company has scheduled delivery of these 100 kg of copper to its customer on 38 September 2001 at a rate of $100 on that date. So they have scheduled delivery. Means it is a firm commitment. Already committed now. Committed. It is a firm committed. Means one commitment has been given to sell 100 kg of copper to its customer on which date? On 38 September. Right now what is the date? 1st April 2001. Means after how many months? 6 months. So can you see it is a commitment given to the customer that will sell 100 kg at rupees what? $100. At rupees, sorry, at $100. So this is firm commitment. Now for firm commitment there are two options available. Either fair value hedge accounting or cash flow hedge accounting. That will depend upon the information given in the question. In the question it will mention cash flow hedge accounting. Therefore we'll do what? Cash flow hedge accounting. However, it can be also mentioned what? Fair value hedge accounting also. Correct? But in this question they have already mentioned what? Cash flow hedge accounting. Therefore we'll go for what? Cash flow hedge accounting. Understood? Have you understood this point? Concept you have understood why we are using cash flow hedge accounting? Because option is available. Option is available means as per the information given in the question. If nothing is given, so you can apply either fair value hedge or cash flow hedge as per your choice. As per your choice. Now, what was the commitment given that 100 kg will be sold at $100? So $100 is receivable or payable? Receivable. So what is the risk in this? Dollar rate will increase or decrease. So risk is that dollar rate might decrease. This is the risk. Understood? First you need to identify the risk. You have understood this? To protect itself from decline. They could decline. Decline is the risk, na? So to protect itself from decline in the currency exchange rate, US dollar to rupees, the entity hedges to the position by entering into currency future contract. Means they have entered into forward contract. Future contract means forward contract. This become a derivative instrument. This become a derivative instrument. Okay. For equivalent currency unit at 76 per US dollar. Now, whenever there is a forward contract, there can be two type of contract, either to buy dollar or to sell dollar. Now, in this, because you have done AFM, so you might be understanding this whatever I am saying. So, but right now we are expecting that dollar rate will decline. So, we will enter into a forward contract to sell dollar or to buy dollar. We will enter because we are expecting the dollar rate may decline. So, we will enter into a contract to buy dollar to sell dollar. Huh? I am giving chance to you. To buy dollar, sell dollar. Everyone saying buy dollar. बोलना रे. Anyone saying sell dollar? बोल दो. Everyone is wrong. Everyone is wrong. This is AFM concept, na? I am not AFM teacher. I just try to understand when the price is declining. So it means you are expected that price will decline. So always right now you will enter into sell dollar at current market price. I mean right now the dollar rate might be what? 70 suppose. And you are expecting the price will decline. It will become 64. So right now you will enter into sale at 70 now. Buy at 70, then it will decline, so it will be loss. What is your expectation? It will decline. It will decline. So you will try to sell dollar at 70 rupees now. Are bolna re? Not able to understand. Suppose 70 is this and you are expecting the price will increase. Let me change the question. You are expecting the price will increase and it will become 75. Correct now. So you will try to buy at 70 now. You will enter in forward contract to buy or to sell? To buy. Right now what is the expectation? The price will decline. So you will enter into sell contract or buy contract? Sell contract. You will try to sell your underlying asset. This is a concept. This is AFM, not my job. Are bolna rahi? Derivative is actually a chapter of what? AFM. We do only a small part accounting. Accounting is only one class will give, but in AFM we will take 10 class. Means I will give only one class, but your AFM teacher will give 10 class. So you will totally understand this chapter where? In AFM. Means in our class, so it is a byproduct. We'll teach just like a byproduct, na? Are bolna re? So one second, if you are conceptually weak, then you will not be able to understand question. If you are not able to understand a question, how the answer will come? So first think about concept, then think about solution. Got this point? One second. One rule is there. Rule is very simple. When your expectation is the price will decline, always enter into sell contract. Whenever your expectation price will increase, always enter into buy contract. This is the formula. Formula is this much only. Correct? So when your expectation is the price will decrease, then you will enter into sell contract. So here what is your expectation? Dollar rate will decline. You will enter into sell. Sell what? To sell what? Dollar. To sell dollar. So it means even though nothing has been given the question, nothing has been given. So it means you need to understand by your own. They have only written that they have entered into forward contract, but they have not written to buy dollar or to sell dollar. It means you need to understand by your own. So it means in this case, we have entered into sell $100 at what? Rupees 76 per US dollar. So we have entered into a forward contract to sell $100 at rupees 76 per US dollar. This 76 per US dollar is a forward rate or a spot rate? Forward rate. This is the forward rate. Okay. The future contract mature on 30th September. This is the maturity date, settlement date. The management perform an assessment of hedge effectiveness and concluded that hedging relation qualify for what? Cash flow hedge accounting law. Now can you use fair value hedge accounting? No. Means only one question of this nature has been given. The entity determine that and document that, change that. Now these all points are not relevant. If you want to read. In the fair value of currency, future contract will be highly effective. It is highly effective given the question in offsetting the variability in cash flow of currency exchange on 30th September 2001. entity closes its currency future contract, means they will settle the future contract. On the same day, it also sell the inventory of copper at US dollar when the spot rate is 72 per US dollar. So what is the spot rate on settlement date? 72 per US dollar. You are required to prepare detailed working and pass the journal entry for sale of copper. Sale of copper was what? Commitment. Sale of copper was commitment, correct? And the corresponding hedge instrument taken by the company, pass the journal entry as on initial date, means the contract date. First quarter end is 30th June, and the date of sale of copper and settlement of forward contract is settlement 30th September. Now they have given date 1st April, 30th June, 30th September. They have given future price. Future price means forward rate. Forward rate they have given 76 on this date, 74 on this date, 71 on this date. Means this is the forward rate for 6 months. This is forward rate for 3 months. This is forward rate for 0 month. On settlement date, your forward rate will be for 0 month now, because on settlement date it will be settled. Understood? So this 6 month forward rate, this is 3 month forward rate, this is 0 month forward rate. This is all our AFM terminology. AFM, you have done all these things, correct? Yes, sir. Now they have given also one more point. Assume the exchange rate as follow and the yield at 6% per annum. Why they have given 6% per annum? Because we need to find out fair value of forward contract. In the last question, fair value of forward contract was given. You remember? Yeah. In the last question it was given now 25,000 negative, then 15,000 negative, then 12,000 positive, then 40,000 we calculated negative. That was given. In this we need to calculate. In this we need to calculate. However, the fair value of forward contract is actually a concept of AFM. In our class we will do accounting now. So valuation is a part of AFM. Accounting is a part of FR. So we should do only accounting. So we should be given fair value. But in this question fair value was not given. Means we need to calculate. It means we need to calculate. So first in this question we need to find out a fair value of forward contract. First let me explain the question. This is what 1st April 2001, then 30th June 2001, then 30th September 2001. What was the forward rate initially? 76. Then forward rate how much? Then what? Spot rate, it is not given here. How much? 72. Normally on settlement date now these two will be always same. Practically it means question is not correct. It means question is not correct. But can you change the question? Do you have a right to change the question? So we'll do as per this. Correct? Means in most of the question you'll find this will be always same. Forward rate on settlement date and spot rate on settlement date will be same only now, because this is on settlement date only. So there is no forward rate. Spot rate only become what? Forward rate. Understood? So sometime in question they will not give you forward rate, they will give only spot rate. Means this will be equal to what? This. Correct? So suppose they have not given forward rate, so it means spot rate, forward rate is equal to what? Spot rate. But in this question, because both are given, so we'll take as per the information given in the question. This you have understood? Now, first we need to find out fair value of forward contract. Can I say initial fair value will be always nil, because nothing has been paid. Now, subsequent fair value will depend upon favorable or unfavorable situation. We have entered into sale $100 at 76. Now the price becomes 74. But the favorable, unfavorable. Favorable, unfavorable. Hat nalayak. How unfavorable? You have entered into sale at 76. And now the price becomes 74. Then also you can sell at what? Think like logical. Now. Don't do any formula. If you think about formula, now you will be stuck. You have done one contract to sell dollar at what? 76. Now the price becomes 74. Then also you can sell at what? Favorable, unfavorable. Favorable now. Positive, negative. Positive. What is the gain? 2. So can you say 2 into 100 become what? 200. This becomes fair value of forward contract without discounting. But they have given discounting also. Without discounting. Understood? Now once again, on settlement date, you have done one contract at 76. But now becomes 71. Favorable, unfavorable? Favorable. So what is the fair value? 5 rupees per dollar. So 5 into 100 means 500. 500 is the fair value without discounting. correct. Now this is the forward rate, means this amount, this 0, in this case so 0 na. This is receivable after how many months? 6 months. This is receivable after how many months? 3 months. This is receivable after how many months? 0 months. Understood? This point have you understood? Correct? So now we need to use discounting. So whenever discount rate is given, means the time value of money is material. So in question, if discount rate is given, means we need to find out the present value of fair value. Means we need to find out present value of this amount. So how to find out that? So this is what on 1st April 2001, 30th June 2001, 30th September 2001. Nominal value, if you say this is 0, this is 200, this is what? 500. We need to find out present value factor at what rate? 6% per annum. 6% per annum, but we want per quarter. So 6 by 4, how much coming? 1.5% per quarter. 1.5% per quarter. Be careful. This is also dangerous. Correct? So can you say now we need to find a discounting factor based on 1.5% per quarter? Can you give me the discounting factor? Point for which date? 30th June. This is 0.985. Then this is 97971. And this is 1 na. Bolo. September will be what? 1. This will be what? 0. This is 0. Which one is correct? Option number 1. This is option number 1. This is option number 2. Which one is correct? Option number 1 is not correct. We know everything, but then also we are doing mistake. This only we need to cross verify. I have already explained. Means I have already give hint. I just want to inform you that after informing you, then also you are doing mistake. Means there is something that we are not able to understand the current situation. This is receivable after how many months? 6 months. This is receivable after how many months? This is receivable after how many months? 0 months. So this is actually Y0. This is Y1. This is Y2 now. What you do in AFM? Means Q0, Q1 and Q2. So this become 1. This become 985. This become 971. Understood? So if you have done this mistake, initial mistake, now 0 marks. Now whatever you are doing. Normally we do mistake initially only. Correct? Now we can find out. This is 0. This is how much? 200 into how much it is coming? 190, 197. Then this is coming how much? 500. Okay. So this is the fair value of forward contract. Now what is the fair value gain or loss? Initially no gain. Here gain is what? 197. Here gain is what? 303. This become gain or loss. So we do journal entry with fair value gain or loss. We do journal entry with fair value gain or loss. Now in the last question this was given. This we have calculated. In this question this is also not given. So we need to find out it. Understood? Now let us come to the accounting. Now apply your common sense. Will not go for whatever is given in ICS studimetry. One thing we have understood that if the cash flow hedge is effective, then entire gain or loss will be transferred to OCI and accumulated in which reserve? Cash flow hedge reserve. This I have already said. Now based on that understanding, you will give accounting. But on 1/4/2001, what will be journal entry? No entry. Why? Because the fair value is nil. Okay. Then on 30th June 2001, what will be journal entry? There is a gain and there is an asset. Favorable means asset. But what journal entry? Derivative financial asset account debit to OCI accumulated where? In cash flow has reserve. What is the amount? 197. 197. Understood this journal entry? If there is a liability, reverse journal entry. Then journal entry is OCI cash flow has reserve to derivative financial liability. Correct? Then again there is a gain. An asset remain asset on 30th September 2001. Again was journal entry derivative financial asset account debit to OCI. Cash flow has reserved how much amount? No. Gain 303 because 303 plus 197 will become 500. Already you have recognized an asset of how much? So now you need to recognize balance asset na. So don't do with 500. 303 with gain or loss. So we do journal entry with gain or loss. We don't just do journal entry with fair value. Understood? This you have understood? This much you understood? Now we'll came to settlement date. Now in settlement date, can this derivative asset will be settled separately? So there is a receivable or payable? Receivable. What journal entry will do? Bank account debit to derivative financial asset. How much? So you receive 500, settle. This account is closed. This derivative financial asset account closed. Now you'll sell the copper. What is journal entry for sale of copper? Copper is inventory. Bachpan wala entry. What journal entry for sale of copper? Bank account debit to? Bank account debit to sales. Or let us assume it is the credit sales. You can also write on bank. But trade receivable, account debit to sales na. Or you can write on revenue. Revenue. At what dollar? $100 into spot rate. Spot rate is what? Practically both will be same. This is 71, so this will be also 71. But we need to go as per the information given the question. Spot rate they have given 72. So we'll do with 72. So this transaction will be done with spot rate. So into 72. So what is the receivable amount? 7,200. 7,200. This also done. Correct. So this transaction settled, this transaction done. Then if you want to receive, you receive bank account debit trade receivable. That journal entry you can do. Now only one account remain still existing, that cash flow has reserve account. So if the transaction has resulted in a financial asset of financial liability, so this will be transferred from OCI to PL as a reclassification adjustment. But the trade receivable of bank is a financial asset or non-financial asset? Financial asset. Therefore, this cash flow has reserve account will be closed by reclassification toward PL. So what journal entry will do? Batao. OCI. Cash flow has reserve account debit 500 to revenue. And revenue is transferred to what? PL. This journal entry will do. This is the last journal entry. This is reclassification from OCI to PL. If suppose this is not a financial asset, this is non-financial asset. For example, machinery account debit to bank. Suppose you purchase machinery. So machinery is what? Non-financial asset. Then this 400 will be adjusted with what? Carrying amount of machinery account. Carrying amount of machinery account. This is the simplest part. Means if they modify the question also, the concept remains this only na. Suppose they have given purchase of machinery instead of sale of copper. So the concept remains this only. Now what type of question they want to ask, that we don't. Because only one question of this nature has been given, and how many questions we will practice. The concept you will understood, it means you can attempt. You can attempt. Now what do you mean by effective? Just try to understand. On 30th September 2001, suppose it become unfavorable. Suppose it become unfavorable. And suppose now they decided that they are not going to sell the copper. Quite possible. In unfavorable situation, we may now think we will not sell the copper. So if we have now decided that we are not expecting to sell copper, then whatever hedging instrument you have taken that become ineffective, then entire gain or loss will be transferred to what? PL. So once the hedging become ineffective, means whatever you are expecting, now you are saying no, we are not expecting anything, then it means whatever hedging instrument you have taken, that is gain or loss will be transferred immediately to what? PL. Then you will not accumulate it to what? Cash flow has reserve account. But in question, normally if question is silent, always will assume it is effective only. If question is silent, always assume hedging is effective and do the corresponding journal entry. This is the cash flow has reserve, and I think I have explained the concept. If you come to the concept, this is only given in ICI, in IND AS 109. What is the concept? You can see this. So cash flow hedge, if ineffective, the gain or loss on hedging instrument will be recognized in PL. Understood? If ineffective. Effective, gain or loss on hedging instrument shall be recognized in OCI and accumulated in cash flow hedge reserve. If the hedge forecasted transaction result in a non-financial asset or non-financial liability, the entity shall remove that amount from cash flow hedge reserve and include it directly in the carrying amount of that asset or liability, adjusted with the carrying amount of non-financial asset or non-financial liability. In other case, means when it results in financial asset or financial liability, the amount shall be reclassified from cash flow hedge reserve to PL as a reclassification adjustment. Understood? So from my point of view, they will ask this question only. So must revise this question before exam. And whenever they have not yet asked, it becomes highly expected. In one attempt, they are going to ask, we don't know which attempt. We don't know which attempt. Correct. Now, this also done. Now, there are some miscellaneous topic from which also question will come. There are two topics. One is embedded derivative from questions point of view. And last one is financial guarantee. First, I will take financial guarantee. Because now this is more important. Financial guarantee is more important from exam point of view. Financial guarantee. However, this case also one new question was created. There was initially no question on this. One new question was created in RTP, and then after one attempt, the same question was asked in exam. Same question was asked in exam. Financial guarantee. Now, what do you mean financial guarantee? Let me first explain you what is this topic. Suppose there is one parent company, one subsidiary company, and subsidiary company has taken a loan. Correct? So of course bank is there to give loan. Now if no guarantee was given on behalf of subsidiary company, so suppose the rate of interest was 13%. Understood? But bank says that if parent company give guarantee on behalf of you, if the parent company will give guarantee on behalf of you, then the rate of interest will make it 11%. Understood? And suppose parent company has given guarantee on behalf of subsidiary company. So this guarantee is known as financial guarantee. This guarantee is known as financial guarantee. It can be related party, it can be unrelated party. Means it can be entity A and entity B which are not related. But can you see, we are not into relationship, I will not give guarantee on behalf of unrelated party. Practically, I will say rare situation. Because normally we give guarantee on behalf of what? Related party. I don't know you, will I give you guarantee on behalf of you? But if I know you, I trust you, then only I can give guarantee on behalf of you. Means for my son, so I will definitely give guarantee. For my parent, I will give guarantee. But for any other person, I will not give guarantee now. So normally it is between what? Related party. But you can't say this is not possible. This is also possible. I may give guarantee on behalf of unrelated party also. Yes or no? Correct? Understood. Now just try to understand. If I am giving guarantee on behalf of unrelated party, so I will charge that for that or not? Ki I'll give free mein. Nothing is free in India, na? If I am giving, suppose you are my unrelated party, correct? And I am giving some guarantee on behalf of you. So I will demand some compensation, na? Bolna yes or no? I will demand some compensation from you. I need to pay that. Then only I will give guarantee. So in case of unrelated party, some compensation is always paid by B to what? A. For guarantee given on behalf of B. So who will receive that compensation? Who will pay that compensation? B. Understood? And can I say we need to pass journal entry with that amount only? So in the books of A, in the books of B, what journal entry will be done? Batao. Can I say they have received bank or receivable? Or the amount is receivable now? To what? To financial guarantee obligation. So one financial liability will be created. Why? Because if B will not pay, who need to pay? To bank A. So we'll pass one journal entry, bank account debit to financial guarantee obligation. Correct now? So this journal entry will be done in the books of A. But suppose they are related party. They are related party. So you say, suppose I have given guarantee on behalf of my son, whether I will demand compensation. If I am demanding compensation, then he is not my son only. Or I don't have trust on him. You pay Baba. Correct now? Are you getting? Means when I started my coaching class, so I have taken loan from my father. I have taken 5 lakh loan. Understood now? So I have taken 5 lakh loan from my father. My father say interest free loan. And you pay me after 5 years. I have never paid. He has never demanded. Because relationship is there now. I have given more than that, but that loan amount is unsettled. I have given more than that, but that loan amount is still existing in our account. Are you getting? Because that is a relationship. That is a relationship. Understood? So can I say, normally can I say S will never compensate P and P will never demand from S? Correct? But can I say the guarantee has some fair value or not? Guarantee has some fair value. So one journal entry will pass because in the books of P, can I say there will be one financial guarantee obligation? But no compensation is receivable. So which account will be debited? That we need to understand. Correct. First we need to find out what is the fair value of that guarantee. Fair value of guarantee. So what our IND AS says, I hope you are understanding. If the guarantee was not given, then what was the rate of interest? If the guarantee was given, then what is the rate of interest? So the differential amount is benefit for whom? Subsidiary company. So if you find out present value of the differential cash flow, that will become fair value of guarantee. Now I'll ask one question. Means first find out differential cash flow. You can find out differential cash flow. 13% and suppose loan amount is 10 lakh. So here it become 1 lakh 30,000. Here become 1 lakh 10,000. Difference is 20,000, 20,000, 20,000, 20,000, 20,000 for 5 years. So we can find out present value of that 20,000 for 5 years. At which rate of interest? Means present value will be calculated. Means we are finding fair value of guarantee. Fair value of guarantee. So we'll discount by which rate of interest? Market rate of interest. Acha, we are calculating right now from whose point of view? From P or S? Who is paying? Who is getting that benefit? Who is getting benefit? So we are finding the present value of differential cash flow, na? Correct. It means from S point of view we are calculating. Now, the market rate of interest is 11% or 13%. Market rate of interest from S point of view is 13 or 11. 13 or 11. 13 or 11. 13. 13 is correct. Concept, no ratification. Means one thing you have understood market rate of interest. Now from whose point of view? That we need to understand. So from S point of view. If the loan would have not been given, if the guarantee would have not been given, then the market rate of interest for S point of view was 13% only. So this is actually not a market rate of interest for S. Market rate of interest was what? 13%. Therefore, we'll find out present value of differential cash flow at 13%. That become what? Fair value of guarantee. Understood? Now, what is journal entry? Now that compensation is not receivable. Means it is one type of permanent investment in the books of what? Subsidiary company. Therefore, journal entry become investment account debit to financial guarantee obligation. So journal entry become investment in subsidiary to financial guarantee obligation with fair value of guarantee. Can you see? Very easy. But subsequent accounting of this is very interesting. Subsequent accounting. Now what IND AS say? The subsequent accounting is subsequent measurement at each year end. At each year end. Subsequent measurement will be higher of point number A, amortized cost. Amortized cost you can calculate. At which rate of interest? 13% or 11%? 13% or 11%? Transaction cost is not there. If there is no transaction cost, then ER will be equal to market rate of interest. What is the market rate of interest? Once again, the concept remains same. Concept remain same. So 13%. Can I say you can easily calculate amortized cost? You can easily calculate amortized cost. B, loss allowance. Loss allowance, whichever is higher. Now loss allowance means impairment loss wala concept. Impairment loss means find out ECL multiplied by probability of default. And can I say any increase or decrease in this financial liability will be transferred to what? PL. Any increase is a loss, decrease is gain. Both will be transferred to profit and loss account. One question, let us do it because one question was there and similar question was asked in exam. I will not say exactly same, but similar question. This was the question which was given in RTP, then given in MTP. 3 times they are given MTP, then asked in exam. Means this is the warning we are going to ask. On 1st April 2001, Sun Limited guarantee 10 lakh loan of a subsidiary Moon Limited, which bank STDK has provided to Moon Limited for 3 years at 8%. Means this is the contractual rate of interest. 8% is what? Contractual rate of interest. Correct? Interest payment are made at the end of each year and principal is repaid at the end of loan term. If Sun Limited had not issued a guarantee, bank would have charged Moon Limited an interest rate of, this is what? Market rate of interest. From which company point of view? Sun ki Moon? Moon, subsidiary company point of view. Sun Limited does not charge Moon Limited for providing the guarantee, means no compensation is receivable. On 31st March 2002, there is 1% probability. They have given probability of default. Probability of default. That Moon Limited may default on the loan in the next 12 months. This is 12-month ECL. I said either it will be 12 month or lifetime. 12 month means good debtor. Lifetime is bad and doubtful debtor. Okay? If Moon Limited default on the loan, Sun Limited does not expect to recover any amount from Moon Limited. Okay. On 31st March 2003, there is a 3% probability. Now probability increases. From 1% become 3%. That Moon Limited may default on the loan in the next 12 months. If the Moon Limited default, nothing is receivable. Okay. Provide an accounting treatment. They have asked only up to 31st March 2003. This is the question. So first what you will do, you will find out differential. 8%, 11% is how much difference? 3%. 10 lakh ka 3% how much? Are calculator is not required. Bhai. You are using calculator. 10 lakh ka 3% how much? Calculator why you are using? 30,000 na? So 30,000 for how many years? 3 years. 3 years is given the question. So you can see 30,000, 30,000, 30,000. Present value factor at what rate? What rate? 8%, 11%. 11%. So at 11% you can calculate. You have calculated, you can calculate this become the total. Total is what? Fair value of guarantee. So what is the first journal entry you will do? Investment account debit to financial liability or financial guarantee liability, whatever they use, right? There will be investment account debit to financial guarantee liability, this amount. Correct. Understood. Now second point is calculate amortized cost. Working note. One working note is required. So we'll prepare one amortized cost table. Opening balance, ER and benefit provided. Benefit provided is 30, 30, 30. Every year 30, 30, 30. So opening was 73320. Interest will be at what rate? 11% minus 30,000. This will be amortized cost of first year. Then opening balance, this is the amortized cost of second year. Then last year. Understood this much? Got this point? Yes, sir. Yeah, this you have understood. Now first year we need to find out what will be the subsequent recognized amount. First year means 31st March 2002. 2002 na? 31st March 2002. First year. First year end. Okay. So what is the amortized cost? And what is the loss allowance? That you need to find out. So if the subsidy default, what is the amount they are supposed to pay? 10 lakh. 10 lakh is the principal amount na? It means Sun Limited will pay how much to the bank? 10 lakh. So 10 lakh is the outstanding amount. What is the probability default? 1%. This become what? 10,000. Whichever is higher. So we'll take this amount. It means now your liability will become from this to this. So liability increases or decreases? Decreases. Means initial amount was what? 73,320. Subsequent amount is what? 51,385. So it decreases by what amount? Batao. By what amount? So liability decreases. It become gain ki loss? Gain. What journal entry? financial guarantee obligation account debit to profit and loss account. So they have done that journal entry, check karo. Understood? Journal entry done. Now let us come to next year, 31st March 2003. What is the amortized cost? 27037. Now loss allowance. What is the outstanding amount? 10 lakh. What is the probability of default? 3%. Means how much? Whichever is higher. Now it become higher. So this become now subsequent account amount. Now initial liability was what? 51,385. Opening liability was 51,385. Closing liability will become how much? 30,000. So how much increase? How much decrease? Sorry. How much decrease? 21,385. Decrease means gain ki loss. Liability decreases. Gain ki loss. Gain. What journal entry? Financial guarantee liability account debit to PL. And that gain will be transferred to PL. Same journal entry is given this. They have asked up to this. But suppose they ask on 31st March 2004 also. So two situations may arise. Either they will default or they will not default. If they will not default, the liability will become 0. If they will not default, the liability will become 0. Then was one more journal entry, financial liability account debit to PL, and entire will become gain. If they default, the liability will become 10 lakh. So 30,000 will become 10 lakh. So you need to pass one journal entry, PL account debit to financial liability, and the increase will be what? 9 lakh 70,000. And then if they are paying, we'll pass one more journal entry, financial liability account debit to bank, 10 lakh, 10 lakh. That will be journal entry. But till now, the last settlement entry they have not asked in exam. But if they ask, we can do it. Understood? This is financial guarantee wala question. And they will ask, so they will ask same to same similar question. Only they what they will do? They will change the rate of interest. They will change the loan amount. Only they will change that. Unrelated party, then they will give you the fair value of guarantee, because that will be the amount of compensation receivable. Then that is journal entry bank account debit to fair value of financial guarantee obligation. But they will not ask that type of question, I know. Understood? Correct. Last point from my point of view, means from revision point of view, is what? Embedded derivative. That was 100% expected, but they have already asked what? In the last exam. Means we used to say it will be asked, till now not asked and asked. Means embedded derivative question was asked for the first time in exam. Whether they can ask again? Huh? Bolna re? Yes, we can expect now. So why to leave? Now what do you mean by embedded derivative? Embedded derivative means what? Means any derivative contract which is inserted in a principal host contract, that become embedded derivative. Means suppose we have a debenture. Debenture is a non-derivative contract. Debenture is a non-derivative contract. Correct. Now if we insert one derivative contract in that, that will become embedded derivative. Means if I say callable debenture, the call option has been inserted. A call option has been inserted. So callable debenture become what? A question of embedded derivative. Means whenever embedded derivative is inserted in a principal या host non-derivative contract, then it is a question of this particular topic. So it means a embedded derivative is a component of a hybrid contract that also include a non-derivative host contract, with the effect that some of the cash flow of the combined instrument vary in a way similar to standalone derivative. Understood? Now, first thing, can I say when I am saying example is the callable debenture. If I take example of callable debenture, correct? Now, there will be one entity who is the issuer, and there will be one party holder. But in the books of holder, this derivative means host contract is an asset or liability. In the books of holder, the debenture is a financial asset or financial liability? Financial asset. In the books of issuer, it will be what? Either equity or financial liability or compound financial instrument. But we do splitting in the books of holder ki issuer. Issuer. Therefore, no separation required. But in the books of holder, no separation. So this concept is actually not applicable in the books of holder. So what IND AS 109 say that if the host contract is a financial asset, no separation required. Then apply concept whatever we have done for financial asset. Whatever you wish to do, that only you do. But if it is the books of issuer, means if the host contract is the equity or financial liability or compound financial instrument, then we should separate call option with what? Debenture. If three conditions are satisfied. If three conditions are satisfied, but that condition is not so much important from exam point of view, because if exam say separate, to will separate, even though we don't know condition. And in exam they will say separate, to will separate. Yes or no? Are you getting what I am saying? But one of the most important conditions which may be asked in your MCQs, if the entire instrument is measured at FBTPL, then can I say separation is not required? Because derivative is also measured at what? FBTPL. And debenture, if you are measuring at FBTPL, then why you are separating? There is no need to separate now. So what they want to say, the entire hybrid instrument is measured at FBTPL, then no separation required. Because both are accounted at FBTPL, gain or loss will be transferred to PL, ultimate effect remains same. But one is at AC, one is at FBTPL, then separation required now. And normally derivative instrument will be at what? FBTPL. Debenture may be at amortized cost, debenture may be at FBTOCI, debenture may be at FBTPL. So if the derivative debenture is, if you are recognizing an amortized cost and derivative at FBTPL, then separation is required. Then separation is required. So one of the important condition is what? If the entire hybrid contract is not measured at FBTPL, then separation is required. However, in exam, whenever they say separate, this much you understood. Now just try to understand. If this is, I will ask one question. You know about call option, put option. Anyone who don't know about call option, put option? Call option means right to buy. Put option means right to sell. This much you know. Now I am asking one question. Think, apply AFM concept. Entity and holder. Entity has issued convertible debenture. This too you know, you have done compound financial instrument. Compulsory or optionally convertible debenture. If they have given only compulsory or only optionally convertible debenture, you can apply concept number 1 today what we have done. Correct. But they have not given compulsory convertible or optionally convertible debenture. They have given callable compulsory convertible debenture. What is the question you understood? Callable compulsory convertible debenture. The call option is inserted. Call option is inserted now. That requires separation. So my question to you all, this call option, for this compulsory convertible debenture, this person is holder and this person is issuer. My question to you all, this call option, who will have right to buy? Entity or holder? Means I will name it A limited or B limited. A limited will be what? Holder of, they will have right now. So they will have a right to buy. So they will become the holder of call option. And who will be the writer of call option? B limited. I am assuming that you know holder, you know writer. That I can assume now. Bol do yes. Because after FR there is AFM also. It is not in group 2. So it means you have done in this group only. Correct? So can I conclude in this way? Ki who will be the holder of call option? Issuer of this particular instrument. And who will be the writer of this call option? Debenture holder. Understood? Means who will pay consideration to whom? Who will pay premium? You say premium. Call option is premium will be paid now. There is some premium amount. Who will pay premium? Holder will pay premium or writer will pay premium? Holder. So who will pay premium? Holder. Who is the holder? Means just try it. अब समझ गए. थोड़ा बहुत समझ में आया. Now just try to understand. My question कि for compulsory convertible debenture, only for compulsory convertible debenture, this entity is receiving consideration or paying consideration? Receiving consideration. But for call option, they will pay consideration कि they will receive consideration. Means entire, suppose you receive 10 lakh for callable compulsory convertible debenture. So can you see this is X minus Y? X minus Y is equal to 10 lakh now. x minus y is equal to 10 lakh. Not able to understand. Not able to understand? Able to understand, not able to understand? 1 second. Till you understand, till smile will not come, I will repeat. You need to smile. Okay? Even though you are not understanding, smile. Otherwise, I will teach. 1 second. 1 second. First, I need to take some assumption that you know call option, you know put option. You know writer, you know holder. Because I can't start from basics. Okay? 1 second. Achha, this must you know now holder will pay premium to writer in call option and put option. Chalo, 1 second. What I say? Ki suppose A Limited issued callable compulsory convertible debenture to whom? To B Limited at rupees 10 lakh. 10 lakh is the entire proceed received for what? Entire instrument na. So we receive 10 lakh for the callable compulsory convertible debenture. So we receive 10 lakh. Okay. Now for convertible debenture, only for convertible, compulsory convertible debenture, but who will pay to whom? So means B will pay to A, means some amount is received for which instrument? Only for compulsory convertible debenture. Now for call option, who will pay to whom? So it will be paid now. So this amount will be paid by A Limited to B Limited. It means can I say x minus y is equal to what? 10 lakh or not? This is the formula. Means x minus y is the net proceed which is received by A Limited. Means can I say this is nothing but x is fair value of what? Compound financial instrument. And this is what? Fair value of call option is equal to what? 10 lakh. This fair value of call option will be always given in the question. This is nothing but amount of premium. That is you do in AFM. How to calculate fair value of call option, that is based on option pricing model, that is binomial pricing model or Black and Scholes model, that you have done where? In AFM. That is not my job. Therefore, that fair value will be given in the question in FR exam. So this will be given. Now suppose they are given 20,000. It means we need to find out this. Yes or no? Now this equal to what? Fair value of liability component plus fair value of equity component minus 20,000 is equal to 10 lakh. Now fair value liability component you can find out because they will give what? Market rate of interest. You know contractual cash outflow. Present value of contractual cash outflow discounted at market rate of interest will be this amount. Once you have calculated this amount, can you calculate this? This is the splitting part. Till now this question has been not asked, given in ICS statement, but till now not asked. 100% expected. But when I don't know. 100% expected. Now let me take one question. Now you will be able to understand whatever is given. I have given time. Why I have given time? Because I know it is expected. 61. D Limited issued callable preference shares. Oh, callable preference shares. Callable na? Call option is inserted. Only one question of this nature. So they will ask this, or they will thoda sa modify. Thoda sa modify. For a consideration of what? This is a proceed received or paid? Receive, because issuer will receive only. The holder has an option to convert these preference shares to the fixed number of equity instrument of issuer at any time up to a period of 3 years. Means the holder has an option, but optionally or compulsory. This conversion option is optionally or compulsory convertible. These preference shares are convertible, optionally convertible, compulsory convertible. Because option has been given now. Holder has been given option to convert, so this become optionally convertible preference shares at a fixed number of equity shares. Whenever optionally, principal amount will be classified as financial liability, key equity. If fixed, then also what? Financial liability. This is concept number 1. Today only we have done. Understood what I am saying? Correct. Yes, sir. So it means you have understood this. Up to this they have given for optionally convertible preference shares. If the option is not exercised by the holder, the preference shares are redeemed at the end of 3 years. The preference shares carry a coupon rate of RBI base rate plus 1%. This RBI base rate plus 1% is what? RBI base rate they have given 9%. So this 10% is what? The preference share carry a coupon This is what? Market rate of interest or contractual rate of interest? Huh? Contractual rate of interest. Chalega? Correct. The prevailing market rate of similar preference shares without conversion features and without issuer redemption option. Issuer redemption option is right to buy. Right to buy means right to redeem. Right to buy back means what? Right to redeem. So that becomes issuer redemption option. So that is call option. That is call option. Means who is the holder of call option? D Limited. Correct. Is RBI base rate plus 4%. So this becomes 13%. But the 13% is what? Market. Likha hua market rate of similar. This becomes market rate of interest. That is also given. On the date of contract, RBI base rate is 9. That already I read. The fair value of call option as determined by using Black and Scholes model for option pricing is 29,165. This is what? Fair value of call option. So fair value of call option is given. Now what is the formula? Formula batao. If you have understood. Formula is what? Fair value of liability component plus fair value of equity component minus fair value of call option is equal to what? 10 lakh. This is the formula. Can we solve it? Fair value of liability component plus fair value of equity component. This is given 29,000. So we'll say 10 lakh 21,965. We can write down in this way now. This will become plus na yahan par. So if I transfer this to this will become plus na. So 10 lakh 29,065. Now you can calculate this. We can easily calculate. So what is the contractual rate of interest? 11, 9 plus 1, 10%. 10% is the contractual rate of interest. So we can find out contractual interest. What is the 10% of 10 lakh? Nominal value is 10 lakh. So 1 lakh for how many years? So present value factor at 10% for 5 years, na? 3 years. I forgot it. For how many years? 3 years. So 3 years. Understood? Then what is the redemption amount? Because principal amount is also financial liability. It is redeemable at par. Redeemable at par. So you should tell redeemable at par or premium. It is if not exercise, preference redeem at the end of 3rd year. So redeemable at par only. So 10 lakh. So 10 lakh into present value factor 10% for 3 years. This is annuity factor, na? But 1 lakh into how much? 2 point, not 2 point. How much? %, 3 years, 0.9098. You are given entire amount. Can you give me annuity factor? 2.36 plus 10 lakh multiplied by 0.75 na? 751 na? 10% 3 years is 6. 751 na? 751. Oh, I have done mistake, sorry. My mind is not working. My mistake. 13%, my mistake. So 1 lakh into what? 13% at a rate of 13%. 2.36. This was correct means. Plus 10 lakh into what? 0.693. Can you solve it? 929, 921 na? 160, 929, 160. So if you put this amount, you can find out balancing figure what? Fair value of equity component. This is the question. Understood? Correct? They have done in this way only. If you read the solution, they have exactly calculated, means this plus this is coming how much? As per their solution, it is coming 9,21,965. Means they have done approximation and they have calculated this. Correct. So if you deduct with 10,21,965, it will come exactly what? 1 lakh difference. Therefore, equity component will become 1 lakh. This is the question. From my point of view, super expected, but I don't know when it will be asked. Now, do you want me to do the last exam question which had been asked? Embedded derivative. That was super expected, asked in exam, therefore I deleted from expected question. Asked in last exam only now. So my probability is that it will not be asked again. That is my probability. But your probability, yes, it can be asked. You want me to do? So I will take that question. But now I have completed this chapter. From my point of view, I will take that question. Now let me take one question only to inform you that what type of question they asked. This question was asked. Suppose this question came in your exam. This question was asked in May 2023 for 14 marks. 14 marks is free marks or not? If you know everything, let's see whether you can do it or not. Everyone will apply. I mean, we don't know from which concept it has been asked. It can be any concept. Let us read. You will read, I will read. Both will read, but I will not explain. I will only read on your behalf. When this question was asked, now most of the students have done some mistake. Most of the students have done some mistake. Means they were not able to score 14 out of 14. What mistake they have done, I don't know. Correct? Yes. Autumn Limited has a policy of providing subsidized loan which imply for their personal purpose. Mr. Jamabai, a senior HR manager in the company, took a loan of 12 lakh on the following terms. Okay, sir. Interest at a rate of 4%. In exam now, we should not be in hurry in reading the question, because question is only live, and we normally do hurry in reading the question only, and solution will become very maja aa raha hai. No, question be aram, because question you understood, then only you can write answer. So 4% is what? This is the loan amount. Always circle all the information given. 4% is what? Contractual rate of interest. Loan disbursement date is 1st April 2019. Okay, sir. The principal amount of loan shall be recovered in 4 equal annual installment. Equal annual means 4. It is 3, 3 and 3 and 3. The accumulated interest computing on reducing balance method is the simple interest is collected in 3 equal installment after collecting the principal amount. Oh my God, this was a new point added. Till now, no question has been given of this nature. A new point was added in the exam. But can we expect as a teacher that this question they are going to ask? Can we teach you before exam? We don't know na what question they are creating. They have created new question. You ask me, I can create 100 questions right now. Give me a chance. 100 different type of question I can create, but they are not giving me a chance now. Are you getting what I am saying? So anyone created, you need to only understand and do it. Okay. So what they have said, accumulated interest computed on reducing balance at simple interest is collected in 3 equal annual installment after collection of principal amount. One thing is clear that no, I will not explain. I am not going to explain. Okay? Because if I will explain, then what you will do? Mr. Jamabai must remain in service till the principal and interest are paid. Oh, acha. Okay. The market rate of comparable loan is 9%. Okay. Market rate of interest is given. The present value of ₹1 at 9% is as follows. Thank you very much. They have given present value, means this you can't change. This you can't change. Under assumption that no probable future economic benefit expect the return of loan has been guaranteed by the employee, you are required to provide journal entry at a time of initial recognition and prepare ledger account. Only if you understood this point. And if you do not understand this point, then question is complicated. Means game is based on concept or question now? Question. First you need to understand how to understand question, then understand the concept, then do the solution. Now, means concept will work only when you have understood the question. And normally what we do, we understand question with solution. No, that is not a correct method. Don't understand question from solution, because in exam we don't have solution. So first understand question by your own in detail, then try to solve it. Now batao, have you understood this? I think you will be able to understand. Anyone who can do? Because you have only two options in exam, do or do. You have only two options now, either do correct or do wrong, but do it. You don't know whether you are doing correct or wrong now. Whether you know. So right now say na. It may be correct, it may be wrong, I will decide. Bolo. Answer is given. I'll give you only 5 minutes, not more than that. Because I want you only answer, then only you will understand that whether you are able to do in exam or not. Do it. And don't read solution. Huh? You have the solution. Don't read solution. Huh? If you have the solution, don't read, please. Then the interest lost. You can understand any, means I say always that a CA final student can understand any solution. A CA final student can understand any solution, but cannot understand question. The solution you can understand by your own, but can you understand question by your own? That is a challenge. Chalega? Explain. 5 minutes is with you. Only this point you need to explain, huh? Only this point. Because once you understood this point, but balance you can do. Live student, you can also reply. Anyone who can say? You can say. Say. Means you say कि will apply contractual rate of interest 4% on balance amount. No, not correct. No, one by one. I am coming to you. This is not correct interpretation. Means one thing, you know the concept, but you have not understood the information, and because of that reason, your answer will be wrong now. Correct? Means question is important or solution is important? Question means in exam we need to understand question first. Solution given, believe me, if you read solution, or I can do it. So you should create an ability to understand the question first. Now who want to say? Only this point. I want this point. If you understood this point, means you understood the entire question. This point. हाँ हाँ बोलो बोलो. This is also not correct. This is also not correct. Don't be demotivated, but not correct. Don't be demotivated, na? Don't be demotivated. Please, 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 please. हाँ, can you calculate the interest amount? One lakh. Then per year how much? No, your answer. What was it? Your answer was 40,000. Acha, you were correct. You were correct. Actually, you were correct. You were correct. I misunderstood your fact. So one answer I got correct. Now let us understand what they want to say. The principal amount, what they have said, the accumulated interest computed on reducing balance method. Means first you need to calculate on reducing balance method. The first year it was how much? 12 lakh. 12 lakh ka 4% how much? 40. The first year it was 48,000. Second year it will be how much? One minute. 48,000, then 48,000, then 30, then this. So I think this was the meaning of this. Always whenever you read any information which is new, to break it and read. They have written accumulated interest computed on reducing balance at simple interest. So this is the simple interest calculation done. Then collected in 3 equal installment after collection of principal amount. What is the total interest? This plus this plus this plus this. How much? 1,30,000. It will be collected in how many installment? So divide by 1,20,000. 1,20,000 divide by 3. So 40,000 each. And this 40,000 will be at year end 5, year end 6, year end 7. Means your contractual payment become what? This is your contractual payment. कि contractual cash out of first year 3 lakh, second year 3 lakh, third year 3 lakh, then 3 lakh, then 40,000, then 40,000, then 40,000. If this is correct, then you can do the entire question. Means step number 1, what was my, or step number 1? Identify contractual rate of interest and contractual cash flow as per the information given in the question. As per the contract, na? So as per the information given in the question, if this is correct, then 14 out of 40. And most of the students have wrongly calculated this. I don't know what they have done, but most of the students have done wrong. Can you say after this you can find out this, then you can do accordingly. Prepaid EV expense with differential amount, correct now? Means this is the 10,43,000. What is the amount? 12 lakh. 12 lakh minus this. The differential amount will be what? Prepaid EV expense. So question, ab batao. If you have, once you have understood this point, before understanding it was difficult, but once you have understood this point, this is a simple or difficult question? Simple. Means question was simple, only we are not able to understand the information. Now this information can be different in your exam, that I don't know which information they are going to ask, correct? One more question was given. Let's see whether you can do it or not. This was a 15 marks. How many marks? 15 marks. This, so I think everyone can do it. Weak Limited, which is fully owned subsidiary company of Strong Limited. Strong Limited is what? Parent. Weak Limited is what? Approach Strong Limited for interest-free loan for mitigation of its financial difficulty. Means Weak Limited approach Strong Limited. Means who will give loan to whom? Strong Limited. Holding company will give loan to subsidiary company. Strong Limited provided. Nature of loan interest free. What is the contractual rate of interest? Amount of loan 60 lakh. Date of disbursement. Loan period 3 years. Loan repayable on 31st March. Market rate of interest 8%. Both for holding and subsidiary. PV factor they have given this. Assume that there is no transaction cost. Look, they have given no transaction cost. You are required to pass. There is an entry. Batao. First, what you will do? You will find out contractual cash outflow. What is the, sorry, you are doing from Weak Limited point of view now. So it is, you need to find out what is the, because for Weak Limited is a financial liability or financial asset. They have taken loan, so it is a financial liability. Understood? So you will find out contractual cash outflow from Weak Limited point of view. They have asked from Weak Limited point of view. Correct? So batao, what is the contractual cash outflow calculated by using which rate of interest? 0%. So 0% is nothing. Only you need to pay what? 60 lakh. So fair value of financial liability will be present value of 60 lakh. Present value of 60 lakh. Payable after how many years? 3 years. So can you 60 lakh multiplied by this is how much? 47 lakhs. The difference amount will be what? The difference amount will be what? This is loan, concessional loan given by holding company to subsidiary company. Correct now? This will be what? Oh, correct only. It will be investment account in the books of parent company, but we are doing in the books of subsidiary company. So their investment will be a capital contribution. Means this will be equity. Correct. Understood. This was also a new question created because in ICS 30-minute question was asked from holding company point of view. In exam they asked from subsidiary company point of view, but it remains same now. Then after that you can do it. For this question they have given 15 marks. What do you expect now? You should not expect more than this in ICI exam. 15 marks lollipop question. If you have done correct calculation. With this I will wind up this chapter. So we need to take one question of that last exam. Let me take that question also. That is a beautiful concept, but already asked in exam. Therefore, I have not given in my expected list. Suppose they ask again. This is the question. The question is what? Try to understand concept. The last concept of this is suppose A and B has entered into a contract to buy or sell any non-financial asset. Buy or sell non-financial asset means property, plant and equipment or inventory, etc. If the functional currency of both will be rupees and the transaction has been entered into rupees, then it is a genuine transaction, no embedded derivative. If suppose functional currency is rupees and dollar and the transaction has been done in dollar, then also genuine transaction. But if it is rupees and this dollar, means this transaction has been entered into what? Dollar. So it means they have entered into this transaction to earn some speculative profit from forward exchange contract. And therefore it will include some embedded derivative. Understood? So how to account for this embedded derivative, that we need to understand. Now just try to understand. For A, suppose A Limited has entered into buy machinery. Means what they want to say, there are two contracts. One is host contract and one is embedded derivative. Correct? What is the host contract? To buy machinery in rupees. To buy machinery in rupees. This is the host contract. Even the contract has been denominated in what? Dollar. Suppose the contract was 10 lakh dollar. 10 lakh dollar. Then also host contract is what? To buy machinery in rupees. And embedded derivative was they have entered into forward contract to sell dollar. How many dollar? 10 lakh dollar at some forward rate. Just try to understand. Suppose if I am buying machinery, so I will pay dollar. So if I am paying dollar, it means I am selling dollar, I am buying dollar. Not able to understand. Suppose this is calculator. Samajhna. Correct? I purchase this calculator from you and I am giving dollar to you. So I am selling dollar or I am buying dollar? Selling dollar. Means my principal contract is what? To buy calculator. And I have entered into forward contract to sell dollar. From your point of view, what is the principal contract? To sell contract and to buy dollar. To buy dollar. Means for B Limited, there will be two contracts. Host contract will be to sell machinery at rupees and to forward contract to buy 10 lakh dollar at some forward rate. So first we need to identify these two contract. Understood? Now do accounting. So first you need to understand they have asked in whose books. They may ask in A limited books or B limited books. Depending upon that you need to pass journal entry. Now let me take one question. You will be able to understand with that question. Company A, an Indian company whose functional currency is rupees, and intend to contract to purchase machinery from unrelated local supplier company B. The functional currency of company B is also rupees. Both functional currency is rupees. However, the contract is denominated in dollar since the machinery is sourced by company B from a US based supplier. Means they have entered into contract to buy machinery at dollar. It means there is some embedded derivative. Payment is due to the company on delivery of the machine. Payment is due to the company B on delivery of machine. Means it is an executory contract. It is an executory contract. Means it is a forward contract to buy machinery. Because delivery will be received, then only payment will be done. So it become an executory contract. Key terms of contract. Contract date is given 9 September. Delivery date is given 31st December. Purchase price given 10 lakh dollar. They have given US dollar to rupees forward rate on 9 September is 67.8. Then US dollar to rupees spot rate on 9 September 66.4. Then US dollar to rupees forward rate on 30th September. 30th September will be one reporting date 67.5. Then 31st December they have given 67. Company is required to analyze if the contract for purchase of machinery, a capital asset from B contain embedded derivative. You write on yes, it contain an embedded derivative. Whether this should be separately accounted for on the basis of guidance. Yes, it's separately accounted. Also give journal entry. So you need to give journal entry. This question was asked for 10 marks. 5 journal entry, 10 marks. Write down something about embedded derivative. That if you write down some the definition of embedded derivative, then accounting part you will get the marks. Correct? Now, what is the question? The contract was done on which date? 9 September. Here it was 38 September. And here it was 31st 12. 3 dates are there. Now, they have asked from which company point of view? They have asked from company's A's point of view. They have not asked from company's B's point of view. So first identify from company A. So you need to find out two contracts. One is host contract to buy machinery at rupees now. So we need to find out how much rupees. Correct. Then what is the forward contract? To what? Batao. To sell 10 lakh dollar at forward rate. We need to find out forward rate. Now they have given forward rate and spot rate. What is given? Check karo. Forward rate is given on 9 September 67.8. So this they have given 67.8. And spot rate is given how much? 66.4. They have given 66.4. Then on 30th September they have given forward rate. How much they given? 67.5. So they have given 67.5. And then spot rate is given on 31st December 67. They have given 67. And I have said on settlement date, forward rate and spot rate are always same. Always same. Even though not given, always same. My question to you all, to sell 10 lakh dollar at which rate? You only say. Apply common sense. At this rate, or at this rate? Bolo. The contract was done on 9 September. Bolo. At which rate? 67 point. Because on this date, this information is not known. This is the future rate now. We don't know right now. So this will be 67.8. I think in this to no doubt. Correct. Now to buy machinery in rupees, the rupees will be 10 lakh dollar multiplied by exchange rate. Now my question to you, I'll just give some hint. We are expecting to purchase machinery on which date? 31st 12. Correct. It means we will pay on 9 September ki 31st 12. 9 September ki 31st 12? 31st 12. But we have done contract on which date? 9 September. And we are doing accounting treatment on 9 September initial contract. But can you see on this date 9 September, this is not known. This is not known. This will be known on that date. Forward rate of 30th September will be known on 30th September now. Right now we don't know. We are right now standing at which point of time? 9 September. So we don't know what is the spot rate on 31st 12. Right now we don't know on 9 September, we don't know what is the spot rate on 30th September. Correct? So my question to you all, this 10 lakhs should be multiplied by either this rate or this rate. Think conceptually. 67.8 or 66.4? Huh? 66 point? No, Ray, it is a forward transaction. We are expecting to buy on which date? 31st 12. For 31st 12, what is the rate? 67.8. That is only forward rate now. Spot rate, you are not doing transaction right now. We are expecting to pay on which date? On 31st 12. For that, what is the rate? 67.8. It means it will be 67.8. It means it will be 678 lakhs now. 678 lakhs. Understood. So it means there are two contracts. To buy machinery at rupees how much? 678 lakh. And to sell $10 lakh at what? At 67.8. Now we'll do the accounting treatment. If you have understood this much. Means simple speaking, if you want to memorize it, both multiply what? By forward rate. Both will be recorded what? Initially at forward rate. On the date of contract. On the date of contract. Now let us do the journal entry. But on 9 September, but any journal entry for expectation for purchase. You are expecting to purchase a machinery after what? Some month. So any journal entry for that? No journal entry. No journal entry. Now on 9 September you have entered into forward contract to sell $10 lakh. Any journal entry? Okay, the fair value of forward contract at this point of time is nil. Fair value of forward contract at this point of time is nil now because no consideration paid for this. Correct. Now you have entered into forward contract to sell $10 lakh at 67.8. Now it becomes 67.5. Favorable, unfavorable. This is favorable, unfavorable derivative contract. Bolo. Everyone is not saying. You enter into a contract to sell $10 lakh at 67.8. Now the price becomes 67.5. Favorable, unfavorable? Huh? 1 second. You can sell at what? 67.8. Even though price becomes 67.5. Now say. Now change karo na. Think in this way. You have done contract to sell at what? Means even the price decline you can sell at what? It is favorable, unfavorable? Favorable, na? Favorable. Is favorable. But a favorable by what amount? 0.3 into 10 lakh. So what is the fair value? 3 lakh is the fair value. But the asset or liability? It is favorable to receivable or payable. So it becomes derivative financial asset. Okay. Now come to this. You have done one contract to sell at 67.8 and now it becomes 67. Then also you can sell at what? 67.8. Favorable, unfavorable? So now it becomes 0.8 into 10 lakh. How much? 8 lakh. This is also what? Financial asset. Correct. Now bata. On 9 September no journal entry. But on 30th September there is a financial asset will pass derivative financial asset account debit to PL. How much? 3 lakhs. 3 lakh na. Then again on 31st 12 there is a gain how much? 5 lakh. Very good. 5 lakh is the gain. Very good. To what PL? How much? 5 lakh. Total financial asset become how much? 8 lakh. Understood? Now you will purchase machinery on 9 September. 31st December. You will pass one journal entry machinery account debit to payable. And you have entered into contract to pay at what? 67.8 means 678 lakhs. So you will say 678 lakhs. 678 lakhs. But can I say there is one payable and there is one receivable also from the same party? Because this is payable to B and this is receivable from B only. So this amount will be adjusted with this amount or not. So we will pass one adjustment entry. What will be adjustment entry? Batao. Ki payable will decrease to derivative financial asset. How much? 8 lakh and 8 lakh. So actual payable is what? Actual payable is 670. And what was the spot rate? 67 into 10 lakh is what? 670. So actual payment is done on spot rate only. But you need to separate what? Derivative instrument. That is separation, and because of that reason we have done this much entry. This question was asked in the last exam. Similar question was asked. One doubt came for the first time in life. First 3 year 3 lakh. The interest to be computed normally. Acha, the solution is coming for the last question. That already we have done. Understood? We have completed financial instrument chapter. Big chapter. Lot of concepts are there. In this, if you can reconcile all the concept before exam, calculation from my point of view is easy because you have calculator. Only conceptual understanding, when contractual rate of interest, when market rate of interest, when effective rate of interest, what is fair value, what is contractual cash inflow outflow. If you understand this, you can compile this thing. This chapter is easy from exam point of view. And understanding the question. If you have wrongly understood a question, then whatever you are doing, that is wrong. Chalega? Yes. So we'll take again a break of 10 minutes. Break of 10 minutes. And then we'll start consolidation. Today, can you catch consolidation? You will start share-based payment. New day with new concept. Na consolidation, I think today nahi jayega. Jayega? Bolo. Share based payment. Share based payment. We will do share based payment better. We'll do simple chapter share based payment. Okay. So after 10 minute break, we'll do share based. Now, everyone, can we start once again, everyone? So now we'll take share-based payment. Okay. Now, share-based payment chapter is very simple from examination point of view. Why? Once again, it is based on calculation. If you are good in calculation, and question will be easy only, means question they will not trouble you much. थोड़ा सा conceptual knowledge if you don't have, so you might do mistake. So I am here to remove your conceptual doubt. Calculation from my point of view, you will not do any mistake in this chapter. Correct? Now, share-based payment, there are actually three topics. One is employee share-based payment, then non-employee share-based payment, and then group share-based payment. Group means parent and subsidiary. Group share-based payment, non-employee share-based payment, and employee share-based payment. These two are very small concept. We don't expect a question from these two topics. However, now with MCQ, this can be important. This is also important for MCQs, correct? Because of MCQ introduction. Basically, if they ask practical question, so we expect question from employee share-based payment. It does not mean they can't ask from these two topics. Of course, they can be changed in trend. Now, this employee share-based payment, there are three topics. One is known as equity settled, one is known as cash settled, and one is known as SBP with cash alternative. With cash alternative means it will be option given, either you can demand cash or you can convert in equity shares. It is as simple as compound financial instrument, as simple as with cash alternative. So it will be either equity settle. When I say equity settle, it is nothing but ESOP. ESOP means employee stock option plan. Good point is that in your CA Inter there was ESOP. It is similar to that only. But now in CA Inter that chapter has been deleted. Now, cash settle means it is nothing but stock appreciation right. We call it stock appreciation right. Understood? Stock appreciation right. SAR means what? Stock appreciation right. So whenever they say question is of a SAR, it means it is cash settlement. Whenever they will say question is of ESOP, it is equity settlement. This is what cash alternative. So with the question you will understand it is a question of SBP with cash alternative. Then once you have understood these all three, then there are some more points. One is modification, modification in plan, and then cancellation of plan. These are two separate topics, modification and cancellation. So you can see 1, 2, 3, 4, 5, 6, 7. There's, I think in overall 7 concepts. 7 concepts one by one. Correct? This is 1, 2, 3, 4, 5, 6, 7. 7 concepts. Chalega. So we'll start with equity settlement. Now equity settlement is nothing but what? ESOP. Means question is of ESOP. Now, I am assuming that you know about ESOP, plan, everything. Entity will provide an option to whom? Employee. That they can purchase the equity shares, certain number of equity shares, after some condition is satisfied. That condition will be known as vesting condition. Vesting condition. Means if I say in this way, so this is known as grant date. Grant date means when the option is granted. And this will be vesting period. Vesting period means when the condition need to be fulfilled. And the last day will be known as vesting day when condition is satisfied. Now suppose this is 3 year. Suppose this is 3 year. So this is Y0, Y1, Y2, Y3. And they will provide one extra period for exercising the option. So once the condition is satisfied, we call it option become vested. Means on this date option become vested. Once the option become vested, the employee has the right to exercise the option. So they will exercise only after vesting day. They will exercise their right only after the vesting day. So this is known as exercise period. Exercise period. So it may be Y4. It may be Y4. Means exercise period can be more than 1 year. It can be less than 1 year. It can be 1 year depending upon the question. See, vesting period can be more than 1 year. It can be less than 1 year. It can be 1 year depending upon question. Normally they ask this type of question, 3 year and 1 year. Therefore I have given 3 year and 1 year. Normally, but this is not the always. Understood? Correct? Now let us assume that initially there was 1000 employee. 1000 employee. Option given per employee was 200. They will give you this type of questions. Correct? Understood? They will give you market price of shares on grant date is rupees, suppose 50. Market price of shares. Okay. Then they will give you exercise price will be, let us assume 20. Correct? So 50 minus 20 is what? 30. So this is known as intrinsic value of option. We call it what? Intrinsic value of option. This 50 is what? Market price of share. Everyone, whatever I'm asking you to repeat with me, okay? Because this chapter, if I am only saying you are not listening, then you are wasting your time. I say go home and revise financial instrument chapter. Because this chapter, from my point of view, students are at comfort zone. Means you can do it. You can do it. But if you are not listening, you are wasting your time now. Then better you go home, sleep 2 hours. That is more important. Correct? If you are not listening, it is wastage of time. I know that morning heavy chapter ho gaya, at 2 hours, balance 2 hours, you will not be able to concentrate. But this is the life. This is only challenging situation. You need to give maximum output in challenging situation only. In the last 1 hour of exam, your output should be at highest level of efficiency. Because last 1 hour, you will do maximum sums. In first 1 hour, you are doing only MCQs. Correct now? In last 1 hour, that you need to give maximum output, highest level of efficiency. The last 2 hours of the class, maximum efficiency. Okay? So concentrate. Because I am also teaching now, I am also tired. I am also human being now. I am elder than you now. 20-year difference hoga. Not so. I will not say my age, but on an average 20-year difference. So 20-year difference hai. Am I right or not? You are, I think, 23, 24, 22. No, you will calculate my age. Chalo. Now, so this is intrinsic value of what? Intrinsic value of what? Huh? Very good. Intrinsic value of option. This is market price of what? So market price of shares and intrinsic value of option are two different things. Okay? Understood. But what is the formula to calculate intrinsic value of option? Market price of shares on grant day minus exercise price. That become intrinsic value. But intrinsic value is not the correct value of the option, because this right will be exercised on which date? On this date. So what our IND AS 102 say that you need to first find out expected intrinsic value. Expected intrinsic value on this date. Expected intrinsic value become estimated market price on which date? Exercise day. Because right now we don't know the market price of shares. Suppose we estimated market price of share is 500 on this date. And exercise price remains same. Exercise price was how much? 20. So it means expected intrinsic value of option is how much? Expected intrinsic value of option is what? 420, 480. Now if you calculate present value of these, this become what? Fair value of option. Fair value of option on this date. Fair value of option. However, don't worry, this fair value of option is calculated as per binomial pricing model or Black and Scholes model as per your AFM faculty. Means this will, the valuation works where? in AFM, in our syllabus, the fair value of option will be given. But whether you want intrinsic value of option on grant day or fair value of option? Fair value of option. So suppose fair value of option is 35. Suppose, don't think about expected. Suppose the fair value of option on grant date is given. So for accounting, you'll use fair value or intrinsic value. First preference will be given to fair value. If not given, then what? And it will be always given. In this chapter, this fair value of option will be always given. Till now, whatever question they have created, always they have given. If not given, then you don't have any other option. Then use what? Intrinsic value of option. Understood? So fair value of option will be given in the question, but it is calculated by using which model? Binomial pricing model or Black and Scholes model as per IND AS 102 only. Means wherever we have used the term fair value in any IND AS, suppose revaluation model under IND AS 16. So we find out fair value of PP, property, plant, and equipment, that fair value is calculated as per IND AS 113. Means wherever fair value is given, fair value is measured as per IND AS 113, but this fair value is calculated as per IND AS 102. This fair value is calculated as per which IND AS? IND AS 102. Means for fair value measurement will not go to IND AS 113. We need to stick to this chapter only. So that is only concept. I hope this much you understood. Now, suppose actual employee left 50 यहाँ पर. Understood? So can you say we need to, what is the concept? कि the fair value of option should be recognized as an expense during which period? Vesting period. Because the entity is receiving benefit during which period? Vesting period. Therefore, it will be recognized as an expense during vesting period on SLM basis. But can I say it should be based on the actual number of employees who are able to perform the condition? But we don't know how many employees will perform the condition right now. Means we need to estimate the number of employees. We need to estimate the number of employees who are able to perform the condition. Suppose in the question they have given at year end 1, we are estimating that year end 2, year end 3, means year end 2, 3% employee may leave, and year end 3, also 3% employee may leave. So we can find out estimated number of employees who are able to perform the condition. How you will calculate? You will say 1000 minus 50 into what? 97% into 97%, or minus 3%, both are same. So how many employees coming? How many employees? Minus 50 into 97%, 93.85. Can we write down this type of employee? This is not correct. So we should approximate it 894 employee. 894 employee. So this become number of employee who are expected to vest the option on vesting day. Then similar information will be given. Now they have given employee actually left is 20. But they will give you in the question कि we are expecting that at year 3, 7% employee may leave. Now the estimation may change. Means for year 3, what will be your number of employee? 1000 minus 50 minus 20 into what? 93%. How much? 865. And then once again actual number of employee given, employee left is actually 80. But how many actual number of employee who vest the condition? Actual number of employee 1000 minus 50 minus 20 minus 80, 850. So this number of employee you want. Can you see if you have wrongly calculated number of employee, game is over. That calculation mistake you need to avoid. However, if you have calculator, you can do mistake only when you are not concentrating. Means high level of efficiency concentration required in exam hall. One mistake, 0 marks. Because after this, whatever you will do, that is wrong now. Correct. Now, you need to do calculation of EB expense. So for year 1, for year 2, for year 3. So first year, how many employee? 894. What is number of option given as per my question? 200. What is the fair value of option? 35 into, because this is the expense of how many year? 3 years, but we want expense of 1 year. We'll do on SLM basis, 1 by 3. We call it cumulative expense. Cumulative expense how much? 20 lakh 86,000. So expense will be this only because this is for 1 year. This becomes the first year expense. Second year, 1 second we'll do reassessment. Now our number of employee will change. Now what is our number of employee? 865. Our fair value option remain 200. Fair value of option remain 35. Into what? 2 by 3. 2 by 3. 40 lakh 36,667 minus this 19 lakh. Means you can do it now because everyone is saying me so confident you are. When everyone is saying me this calculation is lollipop. But I will ask some conceptual question after this. Okay? Then next point we'll take actual number of employee. Actual number of employees what? 850 into what? Into what? Into what? 3 by 3. How much? How much? 1%. 59 lakh. Exactly. But minus this. Can you see this? You can easily calculate. Now, what will be our first journal entry? Batao. Year end 1. EB expense. Account debit to what? SBP. Reserve na. Reserve. By what amount? 20 lakh 86,000. This amount. Second year same journal entry. Third year same journal entry. Amount will change. This you can do. Now we'll come to exercise period Y4. Now what is given the question? Ki out of 850 employee, 800 employee exercise the option and 50 employee are nalayak. They have not exercised the option. Correct. So we need to pass journal entry for exercise and then cancellation journal entry. So what will be journal entry for exercise? We'll say bank account. Can you say we receive exercise money for how many employee? For how many options? What is the exercise price? I have given exercise price 20. So this much cash will be received. How much? 32 lakhs. Then we'll say SBP reserve account debit 800 employee into 200 into what? 35 only. 35 na? Fair value of option was 35. How much? 56 lakh. And 2 equity share capital, 2 securities premium. I have not given nominal value. Suppose nominal value given 10 rupees. So this will be 800 into 200 into 10. This you can write down. And this will be 800 into 200 into what? This minus 10, 45. This you can find out. This will be your exercise generator. Super easy. Super easy. Then one more journal entry, 50 employee has not paid, they have not exercised, we'll cancel it. We'll pass journal entry SBP reserve account debit to what? Retained earning. Retained earning. How many? 50 employee into what? 35. 35. What is the amount coming? How much? 3 lakh 50,000. Means this plus this should be equal to what? This. Correct? This is simplest question. What is the simplest question? Therefore, they don't ask this type of question. Simplest question. Correct. Now, my question to you all. Suppose I will change the question. You need to say what changes we need to do. Now, they may play with your mind. All information are saved. But what they have given? They have given initially fair value of option 35. Now they have given 36, 37, 38 and 40 at the end of each year. At the end of each year. Means fair value of option granted is what? 35. At year end 1 is what? At year end 2 is what? At year end 3 is what? At year end 4 is what? My question to you all, what will be the year end 1 expense? Everyone saying same. Year end 2? Year end 3? Everyone saying same. Everyone not saying. Bolo. Same. Chalo, thank you very much. But why? Equity. Because SBP reserve is what? Equity. And for equity, we never do subsequent measurement. So this is only point where you can do mistake if you are not reading the question carefully. Correct. Understood. Now same question was asked for SAR. SAR means what? Cash settlement. Now SAR means liability. Cash settlement is liability. So liability means what? At the fair value at the end of each year. So your entire calculation will change. Now batao, first year, same question, only the fair value of option has been given at the end of each year. For the year 1 expense will be what? How many employee? 894 employee into what? 200 into what? I have given how much? We'll take 35 to 36. 35, 36. 36. 36. Very good, means you have understood. This is the very simplest point. We'll do 1 by 3. Here we'll take 37 into 1 by 2 by 3. Then we'll take what? 38 into 3 by 3. 3 by 3. Correct? Understood. Means this will be how much? 865 into 200 into 37 into 2 by 3. Then 8, 50, 200, 38. My question to you, ki whether on exercise day will do reassessment. 38 become 40. Yes, because now payment will be done based on what? 40. Can you say on exercise date, fair value of option is nothing but intrinsic value of option? And payment is done based on intrinsic value of option. Intrinsic value is nothing but market price on this date minus what? Exercise price. So whatever the excess amount is there, that is paid in cash. That is paid in cash. So on exercise date, fair value of option will be always equal to what? Intrinsic value of option. As I have said for forward contract, he always forward rate and spot rate will be always same. Here also fair value and intrinsic value will be always same. But during this period, fair value and intrinsic value will be different. Intrinsic value will be different. Understood? So I think you can do it. So on year 4, it will be how many employee? 800 employee into 200 into what? 40 into what? Because in this case now all employee will exercise. So it will be 850 employee only. All employee will exercise. Correct? Because cash will be paid now in this case. So 850 employee into 200 into 40 into 3 by 3 only. And the difference of this will be also transferred to what? PL or retained earning? PL. So this will be EB expense transferred to profit and loss account only. Correct? This is two concepts. I think you have understood SAR and equity. This you have understood. Now they can only change the information given in the question. Let me take one good question for ESOP. Ankita Holding Incorporation grant 100 shares to each of the 500 employee at 1st Jan 2001, provided the employee remain in service during the vesting period. The shares will vest at the end of first year if the company earning is more than what? 12%. Means what they are saying, the vesting period will be 1 year if the company earning is more than 12%. Second year if the company earning is more than 20%. Third year if the entity earning increases by more than 22%. Means they have given variable vesting period. Means vesting period is not fixed. It may change depending upon condition. It may change depending upon condition. So this is the contract. Now actual information will be given. What is given? The fair value of 1 shares at a grant date is 122. So they have given fair value of 1 share. This is option ki share. Share. But we want fair value of option. But can you see if exercise price is 0, then fair value of shares and fair value of option will be same. So in this question, why? Because exercise price is not given. So it means exercise price becomes 0. So fair value of shares and fair value of option will be same. But if exercise price is given, the fair value of shares and fair value of options are different. Understood what I am saying? Correct. So in this, because exercise price is 0, therefore fair value of shares and fair value of option will be same. This point have you understood? Correct. In 2001, earning was 10% and 29 employees left the organization. So earning was only 10%, means condition was not satisfied. First condition was not satisfied. The company expected earning will continue at a similar rate in 2002 and expected share will vest at the end of 2002. Means they are expecting that condition may be satisfied in second year. So for first year, what is the vesting period? So for first year, the vesting period will be 2 years. That is an estimated vesting period. And how many employees left? 29 employees left. The company also expect that additional 31 employees will leave the organization in 2002 and that 440 employees will receive the shares at the end of year 2002. Means what is the estimated number of employees? 440 employees. Means you can say 500 minus 29 minus 31 is how much? 500 minus 29 minus 31 how much? 440 only. So they have given estimated number of employees. So what will be year 1 expense? You only say. Year 1 expense will be how much? How many employees? 440. What is the fair value of option? What is the fair value of option? 122. Correct. And what is the total number of option given? 500 employee, 100 shares. Into 100. Into what? 1 by 2. 1 by 2 because estimated vesting period is 2. This is for year 1. You can calculate what is the amount coming. 20 lakh, 26 lakh, 84,000. First year done. Chalega? Yes, sir. Now let us come to second year. At the end of 2002, company earning was 18%. Means once again condition not satisfied. Means vesting period cannot be 2 years. Means either vesting period will be 3 years or it will be 0 only. Means it will be withdrawn. Therefore, shares did not vest. Only 29 employees left the organization. Now, in year 2, how many employees left? 29 actual employees left the organization. Company believes that additional 23 employees may leave the organization and earning will further increase so that performance target will be achieved in 2003. Now, they are expecting that the performance target will be achieved in third year. Means vesting period will be 3 years. Estimated vesting period. Now, how many employees? Employee will be what? 500 minus what? 29. Then how many left? 29 left. Then how many expected to leave? 23. So how many employees are there? 419. 419 employee. So 419 employee. But year 2 what will do? 419 employee into what? 100. Into what? 122. Into what? 2 by 3. 2 by 3. How much it is coming? 34 lakh 7,867. Let us come last what they have given. At the end of the year 2000, only 21 employee leave. Means what is the actual number of employee? 500 minus 29 minus 29 minus 21. How many employee? 421. And have left the organization. Assume the company earning increase to desired level. Means condition has been satisfied. Means actual vesting period is what? 3 years only. If suppose condition not satisfied, the actual vesting period will be 0 and entire option will be withdrawn. Means it will be cancelled. It will be cancelled means entire SBP reserve will transfer to retained earning. So it means year 3 it is what? 421 employee into what? 100 into 122 into what? 3 by 3. How much? 51 200. You can find out expense you can find out and can do journal. This type of question can be asked to trouble you. Means if you are not reading the question carefully, one employee you have taken wrong number of employee, you are doing mistake. And if you are doing initial mistake, your expense is wrong, journal entry will be wrong. So be careful, I am saying. However, it is very simple question. This type of question, I don't think so any trouble. Now for SAR, there are two good questions which I like personally. One is question number 6, which I like personally. And this question number 6 not yet asked in exam, so can be asked. Okay, but good question. An entity which follows financial year as per the calendar year grant 1000 share appreciation right to each of the 40 management employees on 1st Jan 2005. The SAR provide the employee with the right to receive at the date when the rights are exercised cash equal to the appreciation in the entity shares. Okay sir, okay. All the right vest on 31st December 2006. Means what is the vesting period? 2 years is the vesting period. From 1st Jan 2005 to 31st December 2006. So 2 years is vesting period, and they can be exercised during 2007-2008. Means 2 years is exercise period. Management estimate that on grant date the fair value of each SAR is 11. On grant date is what? 11. And estimate that overall 10% employee will leave during the 2-year period. So their estimation was that overall 10% employee may leave. So what is the expected number of employee? 40 minus 10% means 4. So 36 employee may vest the option. That was their expectation. The fair value of SAR at the end of each year are given below. At the end of year 1, year 2, year 3, year 4, they have given fair value of option. Fair value of option. Chalega? Yes sir. Then 10% employee left before the end of 2006. Means what was the expectation? 10%, and actual also 10%. Means 36 employee only remain. Means 4 employee only left the job. So actual and estimated information are same. Okay. Understood. On 31st December 2007, when the intrinsic value of SAR was 10, 6 employee exercised their option. So how many employee exercised in 2007? Out of 36 employees, 6 employee exercised in 2007. And the remaining 30 employee exercised their option at the end of 2008 when the intrinsic value of each SAR was equal to the fair value, that is 12. Correct. How much expense and liability will be recognized? Means, let me explain you. They have given how many years? 4 years. Initially, how many employee? 40. They are expecting that how many employee will vest the option? 36. And actual vesting is what? 36. Actual vesting is also 36. Then they have given fair value of option. Initially on grant date how much? 11. Then at the end of each year how much given? It is 12, 8, 13, 12. 12, 8, 13, 12. And they have given intrinsic value also. At this point of time it is 10. At this point of time is 12. Intrinsic value of option. Intrinsic value means actual value on that day. Fair value means expected value on exercise day. This is the difference. This is the vesting period, this is the exercise period. They said out of this 36, 6 employee exercise yahan par and 30 employee exercise yahan par. We have to find out the expense of each year. So year 1, year 2, year 3, year 4. But the year 1, how many employee? 36. Into how many option? What is the option per employee? It is 1000. 1000 option per employee. Into 1000, into what? Into 11 ki 12? 12 na? Into what? 1 by 2. Why? Because vesting period is 2. How much it is coming? 2,16,000. So expense will be also 2 lakh and liability will be also what? 2 lakh, because they have asked you to find out expense and liability. Then second year how many employee? Actual number of employees is 36. Now this is actual number of employee. This was estimated number of employee. Into what? Again 1000. Again what? 8. Into what? 2 by 2 is equal to how much? 2 lakh 8. 88,000. 2 lakh 88,000. What is the expense? This minus this. What is your liability? 2 lakh 88,000. Liability will be this now, because nothing has been paid. Now in third year what happened? Out of 36 employees, 6 employees have exercised. So 6 into 1000 into what? Into what? 13 ki 10. 13 ki 10. So payment will be always based on intrinsic value. correct, and liability will be calculated based on fair value. Payment will be always done based on intrinsic value. If intrinsic value is not given, we will assume fair value and intrinsic value are same. That will be our assumption. That will be our assumption if intrinsic value is not given. Got this point? Yes. So into what? 10 plus 30 employee, they have not exercised, so 30 employee into 1000 into what? 30. Their measurement will be done at 30. So what is the total amount? Total amount 4,50,000. So what is your expense? This minus this. 1 lakh. But your liability will be only this, because 6 employees we have paid. So your liability is only for 30 employees. Your liability is only for 30 employees. That will come how much? 3 lakh? 3,90,000. So your liability is 3,90,000. Correct. Got this point? Last, can I say, I have already said on the settlement date, fair value, intrinsic value will be always same. That is only given in the question. So 30 employee exercise. So 30 employee into 1000 into 12 we will do. 12, how much? 3,60,000. But can I say you will compare with this 3,90,000 now? Because this will be compared with this. So there is what? Less payment, more payment. Less payment. It means it become gain. Gain will be transferred to PL account in case of SAR. So what is the gain? 30,000 become gain, so negative, and liability will become nil because this is already paid. Jana entry, of course you can do. Jana entry is very simple. EB expense account debit to SBP liability first. Then EB expense account debit to SBP liability. Then again EB expense account debit to SBP liability. But now paid how much? This much paid. So SBP liability account debit back. Then EB यहाँ पर reverse करेंगे. SBP liability to EB expense. SBP liability account debit to EB expense 30,000. Then entire amount paid. SBP liability account debit to bank. Jana entry is very simple for liability. चलेगा. But can you see entire jana entry is based on this calculation? So even though simple, but in exam, high chance of mistake when you are not concentrating. So I will a simple question, give more time because full marks will be there. So when a simple question, be careful. Complicated question तो ऐसे भी नहीं मिलने वाला. ऐसे भी you are not getting full marks ना. In complicated question, whether you are getting full marks, you are not getting full marks. But in simple question, try to get full marks. So don't do simple mistake in that. चलेगा. Now one good question, one more good question, which is favorite question of. Now one of the favorite question institute. This have been asked I think 2 times in exam. This question have been asked 2 times in exam. Only one point where you can do mistake. What they have here? Minda issued 11,000 shares. 11,000 shares. Appreciation right that vest immediately to his employee on 1st April 2000. चलेगा? Yes. The SAR will be settling cash using an option pricing model. At the date, it was estimated a fair value of SAR is 100. So fair value SAR on initial date is what? 100. SAR can be exercised anytime up until 31st March 2003. At the end of the period, on 31st March 2001, it is expected exercise that 95% of total employee can exercise, 92% at the end of next year, and finally, it was vested only 89% of employee at the end of third year. They have given fair value SARs at the end of each year. Initially, it was how much? 100. Initial fair value was how much? 100. Correct? Correct. Then it become 132, then it become 139, then it become 141. Correct. Now, in this question, first year what will be the expense? How many options? Have you read the question now? I am not drawing. So what is the number of options? 11,000 shares. 11,000 shares. They have not given employee. So 11,000 shares. into what? Bolo. Into what? Into you'll do 100 ki 132. 100 ki 132. Are you able to understand my point? 100 is fair value initially, at year end 1 it become 132. So you'll do 100 ki 132. 130. 1 second I'm asking. You'll do 100 ki 132. Everyone is not responding. How many are saying 100? Why you are saying 100? So only one student had given correct answer. I said, nah, exam is different. Only one student have understood the emotions of the question. I think from my point of view, this question you have done many times, because this question is from ICS study material. But then also in class you are not able to understand information because I am not doing on that sequential basis as given in ICS study material. So when you read some book now, so you always do on that sequential basis, and when you do in sequential basis, you think that you will remember now. In this question you have done that only, to you remember, but in exam the question will not be based on that sequential basis. Any question from any chapter can be asked. So in exam, even the same question they ask, it become a new question. Are you able to understand? In exam, any question, whether from ICS study material, whether from RTP, whether from MTP, whether from any reference book, will be new question, because you are reading for the first time by your own, and you don't have solution. You don't have solution. Therefore, concentration required for each word. Dekho, I have not given stress intentionally. If I would have given stress to that point, or if I would have explained, you would have done correct only. What is given? That vested immediately. Oh, means all 3 are exercise period. Means it recognize the entire expense on which date? Vesting day. Means at the beginning only recognize the entire expense, because it vested immediately, because we recognize expense during vesting period, and here only the first day is what? Vesting day. First day become what? Vesting day. Understood the question? Why become this favorite question of institute? Because they know every student will do mistake in this question. Every student, because we are habituated of 1 by 3, 2 by 3, 3 by 3. Have you understood this mind? So ICM, play with your mind. ICM, who is in the board of the studies? All chartered accountant. Who is in the board of studies? All chartered accountant, na? And they have taken multiple attempts. अरे बोलना देखो 80% CA have taken multiple attempts. 20% CA are first attempt or rank holder. 80% chartered accountant India are multiple attempt. Understood? Are you getting? So there is nothing wrong to pass in multiple attempt. There is nothing wrong. I will just keep you one story what happened with me. When I become initially, I was first attempt. देखो फर्स्ट अटेम्प्ट तो थोड़ा ऐसे हो जाता है ना. फर्स्ट अटेम्प्ट इज आल्सो व्हाट वन सक्सेस ना. अरे फर्स्ट अटेम्प्ट. So that time I was also like you, 20 to 23 age. First attempt passed. Correct now. Then dhire dhire I understood that I'm not capable of doing job. I left it. Then I understood that I'm not capable of practice also. I left it. Then I am not able to understand what I can do. So because I need to survive in the market, I started teaching. I need to survive in the market. Now after becoming CA, if you want some amount from family, they will say, why you become CA? So we can't demand much amount from money. We can't demand much money from our parents. So to survive in the market, I started teaching. And with the phase of that, I started liking teaching. With the phase of that. So what happened? Initially, I met one of the teacher. Because I need to go to for student do bhai. I require student now, no one will come initially to me. So I went to one teacher who was a very popular teacher. I will not say the name. Very popular teacher. So very popular teacher means earning might be 3 crore, 4 crore that time. Matlab, lot of students. Correct now. So when a CA will meet, so he asks me how many attempts. Because CA can only ask. Others can't ask, and they ask me give a big slab. A CA asking respect. Other asking give one big slap. First do CA, then ask. So other asking don't respond, always say first attempt. Interview, because the CA is asking, say right. So we can understand the emotion of CA na. So he said, I said, sir, first attempt. Then I also asked, sir, how many attempts? He said, 10th attempt. I said, acha. Sir, you have taken 10 attempts in both CA inter and CA final together. Means 5, 6, 6 power, ऐसे कुछ करके. And he was earning that time means 2009 I am saying. I think most probably, which I counted mathematically by fees and the number of students, more than 2 crore. Number of attempts will not decide your future. Number of attempts will not define your success. Only decide which will decide your determination. Which will decide your success is not based on number of attempts. Your success is not based on whether you are becoming CA or you are not becoming CA. Success depends on how you are taking whatever is happening in your life. Take it in a positive way. And that is only what success. And believe me, 80% whatever I am saying have taken multiple attempts. Most of them are earning good amount. Most of them are having luxury car. Most of them I am saying. It means multiple attempts is not wrong now. So if you are taking multiple attempts, just think positively in next attempt. This next attempt is my last attempt. If you think in that way, you become CA, the entire market is with you. Entire market has a lot of opportunity to earn what? Money. Understood? But you take it as a positive way. Ki okay na, whatever has been done, done. Now think about next attempt. Correct? One more example I will give. There is one of my friend, till now has not become CA. But there are 20 chartered accountants working under him. Hello? Okay, and everything. So 20 chartered accountants are working under him. What do you want? He is not a CA, but 20 CA is under him. Okay na? Okay na? And he is not having any father business. He is not carrying forward his father business. He built his own empire. And 20 chartered accountants is working under him. He is one of my friend only. Means we become CA at the same atom or 1 or 2 atom either other. Well, he has to not become CA, but we were preparing for CA in the same atom. So this is true story I am saying. So it means even though you don't become CA, I am not saying don't become. Of course you should become. But take it as a challenge. What you can do after that. Everything is upon you. How you are reacting in your life. If you are reacting in a positive way, entire market is with you. Market means entire market is full of opportunities. And a CA who is not, article who is not become CA can do any type of work. Can't you do practice? If only signing authority you don't have now. But can you do all the type of work? Yes. Only signing authority you don't have. Sign किसी और से करवा लो. But you can do all type of work. All type of work. Understood? So this you need to take it as a positive way, I am saying. Correct? I am not saying don't become CA. That is not my intention to say don't become CA, don't write exam. Of course you can become CA and you have entire ability to become CA. But multiple attempt does not count our success. That I just want to say with that example. Chalo. Now, this you have understood. So here only, screen. So not. This will not come after power, na? It will take time. Live class is going on. Now, so can I teach like this? Because you will be able to understand. Huh? It's coming though. Oh. Coming. चल now तो बताओ फर्स्ट ईयर वी आर डूइंग क्वेश्चन दैट क्वेश्चन मिंडा वाला क्वेश्चन तो एट स्टार्ट 1/4 फर्स्ट ईयर इट वाज 1/4 2000 so at the start 1/4 2000 how many option 11,000 and nothing has been given the 100% and you will do fair value of option given what 111 now triple one is given triple one so it become 11 lakh I will show with this only so at the start of the period 100 is the fair value 100% is what to be vested so it is 11,000 into 100 into 100% 11 lakh will be there so entire expense will recognize at the beginning only then on the next this is year 1 this is also year 1 this is start this is end at the end but your expectation change ki now out of 11,000 shares only how many shares will be exercised so they are saying only how many shares can be exercised 95% option can be exercised so you will do 11,000 into what 95% and the fair value has been changed to 132 so you will take 132 but you will not do 1 by 2 or 1 by 3 so this become what total cumulative expense out of this much recognized so this become 2,79,000 expense so this become expense at the beginning of the year this become expense at the end of the year the total expense of first year is this total expense of the first year is this which will be charged to profit and loss account then year end 2 once again they have given 92% of employee can be exercised so you can say 11,000 into 92% and now the fair value option become 139 so into 139 so this will become cumulative expense out of this already recognized this much so this become the additional expense of the second year then once again 89% actually exercised actually how many employee exercise however question there is one mistake they have said finally it was vested this was actually misprinting it should be finally it was exercised by how many employee 89% employee. So there was some drafting mistake in the question, but whenever drafting mistake, you need to understand the emotions of the question by your own. Correct? You can't challenge with the drafting part. You need to understand by your own this point. Okay? So 11,000 into what? 89% into 141. This becomes total final expense. So this reduction of expense. Reduction of expense will be transferred to profit and loss account. So this is one of the favorite questions which have been already asked 2 times. Can be repeated because most of the student will do mistake here. This is SARDA. So we have done ESOP, means equity settlement. We have done cash settlement. Equity settlement understood, cash settlement understood. Now the next one popular question which have been asked 3-4 times, I will say in exam, 3 times to pakka, about SBP with cash alternative. That is one of the favorite question. I don't know why. SBP with cash alternative. So in that I will explain with the question only the entire concept. With one question I will explain the concept because they are asking this type of question only and they are not changing the question. Even though they change the question, you will be able to understand if you understood this particular question. So on 1st Jan 2001, ABC Limited gives an option to key management employee to take either cash equivalent to 1000 shares or 1500 shares. Means either take cash equivalent to how many shares? Means for cash settlement how many options? And for equity settlement how many options? 1500. So they have given different number of shares. Okay. The minimum service requirement is 2 years. So what is the vesting period? 2 years. And the share being taken must be kept for 3 years. Means if you have exercised equity shares, so that need to be kept for how many years? So this become lock-in period. It is known as what? Lock-in period. Means this lock-in period is for equity settlement or cash settlement? Equity settlement. Now whenever there is a lock-in period means the shares is with restriction, without restriction? With restriction. Means my question to you all, just try to understand. Suppose this is stock market and suppose this is Reliance Industry Limited. Now they have market price of shares is 2000. So this market price of shares is for the shares which can be transferred or which cannot be transferred? Which can be transferred? So market price become 2000. But there are some shares which are listed but which cannot be transferred. Which cannot be transferred. So there are some shares which are listed in the stock market but cannot be transferred for 3 years. Cannot be transferred for 3 years. My question to you all, whether that will have market price? Because that cannot be transferred, no market price. Market price means what? Which can be purchased or sale in the market. But if it cannot be sale or purchased in the market, that does not have the market price. But that will have what? Fair value. So my question to you are, the fair value of this share will be more than this, equal to this, or less than this? Less than this. So then fair value of this shares may be 1900. Maybe 1900. Now suppose exercise price is 200. Exercise price is 200. Correct. So what is the fair value for cash settlement? For option, can you see it will be 2000 minus 200? Means for cash settlement you will take market price of shares or fair value of shares with restriction? Because cash settlement there is no restriction, so you will take this 2000 minus 200, so this become 1800. But can you say to find out fair value option for shares with restriction, you will take this fair value. So this will be 1900 minus 200, how much? 700. Means can I conclude in this way, that fair value of option with restriction will be less than the fair value of option without restriction. So this cash settlement fair value will be always more than fair value of equity settlement with restriction. But suppose in the question no restriction is given, then the both fair value will be same. So till now no question without lock-in period is given. Whatever question has been given for this, they have given lock-in period. So if the lock-in period is given, means with restriction, it means you need to identify from this information. They have given fair value of shares are as follows. Share alternative fair value with restriction. This is for what? Equity settlement. And granted fair value on 1st Jan 2000. They have written nothing. So this is without restriction. This is for what? Cash settlement. Understood? Now they have given fair value on 31st December. Fair value on 31st December 2000. This is for cash or equity? Cash. Because nothing has been given, whether with or without. So always assume without restriction. And can you say for cash settlement only you want fair value at the end of each year? For equity settlement you don't want fair value at the end of each year. So that information is not relevant. Understood? So this is also for cash settlement. This is also for cash settlement. Got this point? Have you understood this point? chalega. Means in this question what information has been given? These are the first year, second year, correct? Now they have given what? 1000 share option for cash settlement. They have given 1000 fair value. They have given initially how much the fair value is given? 113. It is 113. Then they have given 113. Then they have given 120 and 132. 120 and 132. Then equity settlement they have given how many shares? 1500. And they have given fair value on this date. How much fair value is given? 102. These are the information given. This is without restriction. This is with restriction. Suppose in exam they have given this also. They have given 115, 130. This is given. Can I say not relevant? Not relevant. Even though given not relevant, because for equity settlement we don't do subsequent measurement. Understood? But these are relevant. These are relevant. Now what is the step number 1 yahan par? Step number 1, calculate fair value of liability component and equity component on grant date. This is the step number 1. Correct? So first in this we'll find out maximum liability. Maximum liability means what? If suppose it is settling cash on grant date, what can be the maximum liability? So maximum liability is 1000 into 113. 1000 into 113. This become maximum liability. So 1000 into 113, how much? It is 1,13,000. This become maximum liability. Similarly, we will find out maximum equity if suppose the entire is settled in equity. Suppose entire is settled in equity, what can be the maximum equity? Maximum equity is 1500 into 102. So 1500 into 102, how much? 1,53,000. Correct? Understood? It means can I say normally whenever there is a compound financial instrument, so normally we assume maximum liability. So this is nothing but compound financial instrument. So the accounting will be done on the basis that it will be always settling cash. So this become maximum liability which will be recognized. And can I say minimum equity will be what? This minus this. So minimum equity will be 1,53,000 minus what? 1,13,000. How much it is coming? So this become minimum equity. So we recognize maximum liability and minimum equity on grant date. Understood? Correct. So this become fair value of equity component. And this become fair value of liability component. Understood? But liability component require reassessment. Equity component does not require a reassessment. So we'll find out the expense. We'll find out the expense at year end 1 and at year end 2 for liability component and equity component. For liability component, because reassessment required, so we'll do 1000 into what? We'll do 120 into 120 into 120 into 1 by 2. This will be the expense of first year. How much? How much? 60,000. So this become expense. And for equity component, because we don't do reassessment, this was the fair value. Because there is no changes in the option, because there is no changes in the number of options, we can do divide by 2. So 40,000 will do divide by 2. And this will become 20,000 and 20,000. Understood? Total become what? 80,000. So 80,000 become the expense of first year. Second year, liability component, equity component. Once again, can I say we'll do reassessment for what? Liability component, that become what? 132. So we'll do 132 into 2 by 2. How much? 1,32,000 minus what? 60. How much left? How much? 72,000. But this will be 40,000 into what? 1 by 2. This is 20,000 and 20,000. So total become how much? 92,000. This become the EB expense. So first journal entry, year end 1. What journal entry? EB expense account debit to SBP liability to SBP reserve. So both will come SBP liability and SBP reserve. Second year also journal entry simple EB expense account debit to SBP liability to SBP reserve. Only I need to explain the settlement journal entry. Settlement accounting will what? So there is two options. Even whenever question is silent, you can see in this question nothing has been given. The key management exercise is cash option. They have given cash option. Means in this question it is given they are opting for cash settlement. But suppose nothing has been given, So you need to give both options. So let us assume nothing has been given, correct? So we will to do in this way. If cash settlement, then what journal entry? Option number A, if cash settlement. Then first journal entry what? SBP liability account debit to bank. Because K is the vesting day and exercise day is same. Therefore, whatever is the fair value, that only you will pay. There is no changes in the fair value, correct? So you will pay how much? 1,32,000. So you will pay SBP liability account debit to bank 1,32,000. And whatever in SBP reserve, that will be closed and transferred to which account? Retained earning. You will transfer to retained earning. How much? 40,000 will be transferred to retained earning. Understood this? Now, if suppose equity settlement, then what journal entry? So can you say SBP liability? How much? 1 lakh. Can you say bank account will come for exercise money? But in this question, exercise money is nil. No exercise money has been given. So bank is what? Nil. To what? Equity share capital. To securities premium. So this both amount will be what? 1,32,000. If the nominal value is given, you can write on premium and nominal value separately. And once again, SBP reserve account will be closed by transfer to what? Retained earning. This is as per ICS solution I am writing. Same accounting treatment I have given for what? Compound financial instrument also. So this will be what? 40,000 will be transferred to retained earning. Understood? This is the journal entry. Understood? Till now this type of question only they are asking. But suppose I create one new question. Let's see how you are reacting. Suppose modified in question. Okay. Suppose they are given 100 employee. 100 employee. Yeah, 1000 employee kar do. Employee left 50. Employee left 30. Employee left 20. Understood? Year end 1 May, year 2, year 3, they are saying we are expecting that 25 and 25 employee may leave. Here we are expecting that year 3, 35 employee may leave. This is our expectation. Now they have given cash settlement. For cash settlement, they have given 100 options, 100 shares. Correct? Fair value of option is given 30, 35, 36, 37. This is exercise date. अच्छा exercise date नहीं दिया. ठीक है. Exercise date and vesting day and exercise date are same. Let us assume. Then equity settlement, it is 150 shares and fair value with restriction, is 27, and they have given 30, 31, 32. These are the information given. I have created better quality of question. This type of question till now not given in ICS study matter, but can be created. Can be created. If I can create, so they can also create. बोला रे? Correct. Now बताओ. What will be the on grant day? If you can do, means you have understood the concept. Can you the first will find out fair value of liability component? बताओ how many? बताओ. What you will do? This is number of employee. Huh? How many employee you will take? On grant day, how many employee you will take? 1000 employee, na? 1000 employee. Into how many shares? 100 or 150? 100. Into what is the fair value? 30, na? 30. How much it is coming? 30 lakh. And then fair value of what? Equity component. First maximum equity will be how much? 1000 employee into what? 150 into what? 27. How much? 40 40 तो I understood. 40 lakh 50,000. So what is the max? What is the equity portion? 10 lakh 50,000. This much you understood. First step, so you understood. Now we'll find out EB expense. Year end 1 liability component. But for liability component at year end 1, how many employee? 1000 minus what? 50. And then minus what? 50. So total minus 100 means how many employee? 900 employee. How many shares? What is the fair value? 35. 35 into what? 1 by 3. How much? 10 lakh 50. So expense will be also 10 lakh 50,000. Equity component, if you can give me equity component, means you can do this type of question in exam. Think and say, if you can calculate equity component, means you have understood. Are you getting what I am saying? Are you able to understand? I have just given example for equity component. Balance so you can do, I know. So let's see how many of you are able to calculate equity component. Calculate. Calculate first. Let everyone calculate. This is a new question till now not given in ICS study material. So new question you can do when you are conceptually strong. Understand what I am saying? Bolo. What is the answer you are getting? First option 12 lakh 15. One answer I got 12 lakh 15,000. Second 3 lakh 50,000. Third option 3 lakh 15,000. Fourth option 4 lakh 50,000. Fifth option, after that no option. So let's see out of this is correct or not. Anyone getting different answer? Means 4 options we got. Therefore in MCQs 4 options. Correct. Let's see. How many have done 10 lakh 50,000 divided by 3? Anyone done? 10 lakh 50,000 divided by 3? That is not correct. It means you have done as per previous concept, and normally it only happens. We always see what we have done in previous question that we apply. It means you are not conceptually strong right now. The previous question, so all informations were not given. In previous question there were no changes in option. In this question there is changes in option because there is a changes in number of employee. Correct. So first in this case we need to find out what is the number of employee. Batao. For this also we want number of employee na. So number of employee remains same. Correct. Number of option is what? 150 into what? Into what? How much? No. Into what? 10 lakh 50,000 divided by what? This. This is how much? Per option is what? It is 1 lakh 50 na. So divide by 1 lakh 50,000 crore. So what is the per option value? 7 rupees. Divide by 7, and we will not do any reassessment on that because this was the fair value of equity component on grant date. Minimum equity you have recognized na. The minimum equity, what was the fair value? 10 lakh 50,000. So what is the per option fair value? Per option fair value is 1 lakh 50,000 divided karo. It is rupees 7, and that you are not going to reassess. That you are not going to reassess. How many have done 7? Into 7 into 1 by 3. What is the answer? 3 lakh. Anyone given this answer? Oh, I have deleted. You have given 3,50,000. Very good. Excellent. Means someone is still giving. In your class only someone is giving. So this is concept. There is no question of this nature. So new question require detailed understanding. Same question require only limited understanding. So detailed understanding, concept is required. Limited understanding, limited concept is required. So of course, if you have understood that this is not going to be reassessed and this was the initial fair value. Now because there is changes in number of options, because changes number imply, so that you need to find out what is the fair value of option on grant date for the minimum equity. So what is the fair value of option of grant date of minimum equity? That is 7, and this you will not reassess. This you are not going to reassess. In the last question, because this remain 11,000 now. Every year it was how much? Sorry, not 11,000. This was 40,000. So this was what? Unchanged. Because this was unchanged. 1,500 remain 1,500 every year because there was no changes in the number of employees. And therefore we have done 40,000 divided by 2. But in this, so we can't do that. Therefore, in exam question, if this type of question, if asked, can be asked, believe me, can be asked. They can create this type of question. So if they ask, do what? This divide by number of options, find out this, then do subsequent calculation. Now you can do this remain 3,15,000. Now you can do any question. Year 2 liability component will be how much? Now what is the number employee? It is 1,000 minus 50 minus 30 minus 35 how much? 1,000 minus 50 minus 30 minus 35 how much? 880. So you will do 880 into what? 885 into what? 100 into what? 36. These all information are not relevant. 36 into what? 2 by 3. Then for this you will take 885 into 150 into what? 7. You will do 2 by 3. And same third year you can do. Then settlement accounting will remain same. Got this point? So I am expecting one of this question exam if they change the question. Till now they have not changed the question. Why they are not changing the question? In that question also students are doing mistake. So because students are not performing, so they are not changing the question. Once students are performing, so they will change the question. This is the rule. If suppose they ask one question, if everyone is giving correct answer, so they will change the question. But if everyone is not giving correct answer, they will repeat that question. This is the trend. Trend is this. Understood? So chalo theek hai. But this question to very super easy, and they have asked many times this type of question in exam. So can you say SBP with cash alternative also done? SBP with cash alternative will be done. Now let us come to modification. Modification is one of the important topic. We have only 20 minutes. Modification. I will take directly one question. I will take one question for modification. And I will take good quality of question. Okay. Now, modification is actually for equity settlement. For cash settlement, so can I say even though modification will do accounting based on fair value of option. So for cash settlement, even though modification happened, we always take what? Fair value of option at year end. So if the question comes from modification for cash settlement, so always we take fair value of option at year end. Understood what I am saying? So if for cash settlement they are giving modification in the question, so it means do take fair value of option at year end and do reassessment. Equity settlement, what need to be done, that we need to understand. Equity settlement. So QA Limited hold on 1st April 2015 granted 1,000 share option to each of its 2,000 employees. The option are due to vest on 31st March 2018, provided an employee remain in employment till 31st March 2018. So what is the number of vesting period? 3 years. On 1st April 2015, the directors of company estimated 1,800 employees would qualify for the option on 31st March 2018. This is on which date? On 1st April 2015. The estimate was amended to 1,850 employees on which date? On 31st March 2016, and further amended to 1,840 employees on 31st March 2017. On 1st April 2015, the fair value of an option was 1.20. This is on which date? On grant date. The fair value increased to 1.30 as on which date? 31st March 2016. But due to challenging business condition, the fair value declined thereafter. Can you say if the fair value is declining, means market price is declining? If the market price of share is declining, means employee will not be interested. If employee is not interested, they will leave the job. So to motivate the employee, they will change the exercise price. Because if you reduce the exercise price, correct now, ultimately once again the interest will come. So they will reduce what? Exercise price. So they are reducing the exercise price to regain the confidence of employee. So that is known as modification. That is known as modification. The modifications are of three types. Either they will reduce exercise price, or they will increase the number of options, or they will decrease the vesting period. They will decrease the vesting period. Understood? Till now they have given only question based on this. That is reduction of what? Exercise price. Can you say when we reduce exercise price, when we increase the number of options, or when we decrease the vesting period, this is beneficial or not beneficial to employee? This is beneficial to employee, it is not beneficial to employee. It is beneficial to employee. But if you do ulta, increase the exercise price, or decrease the number of options, or increase the vesting period, this is beneficial to employee or not beneficial to employee? Not beneficial to employee. Whether entity will do that type of modification, they can do. Why that they can't do? They can do, but they will not do. So what our IND AS 102 says that if the modification is not beneficial to employee, ignore the modification. What they say? If what IND AS 102 says that if the modification is not beneficial to employee, ignore the modification. Do or is continue original accounting as if there is no modification. Means if it is not beneficial to employee, ignore modification. Continue your original accounting. That type of question they will not ask. But if they ask, be careful. Be careful. No accounting treatment for modification. It means they will only give modification which are beneficial to employee, because practically that is only possible. So what they want to say, in that case we need to find out incremental fair value of option on the date of modification. Incremental fair value of option on the date of modification. How to find out that incremental fair value of option on the date of modification? We need to find out fair value of modified plan on the date of modification. Compare with the fair value of original plan on the date of modification. So we need to find out fair value of modified plan on the date of modification. Fair value of bolo na, fair value of modified plan on the date of modification. Compare with the fair value of original plan on the date of modification. Any difference will be incremental fair value of option, and that incremental fair value of option will be recognized as an expense during the remaining vesting period from the date of modification. Remaining vesting period from the date of modification. This is the concept. Understood? Now, so on 1st April 2015, the fair value of option was 1.2. The fair value was increased to 1.30 on 31st March 2016. But due to challenging business condition, the fair value declined thereafter. So it is not declining, fair value is declining. So what they will do? They will do the modification. In September 2016, when the fair value option becomes 0.90, the director repriced. They have repriced the option, means they have reduced the exercise price, and this caused the fair value to increase to what? 1.05. So this is what? Fair value of modified plan on the date of, and this is the fair value of original plan on the date of modification. So what is the incremental fair value? 1.05 minus 0.90. Understood? Understood? Trading conditions improve in the second half of the year, and by 31st March 2017, the fair value option is 1.25. QA Limited, this point don't read. The company has required suggested accounting treatment. Lot of information given. If you are not constantly strong, you will do wrong, because they have given I think 5 to 6 information of fair value only. Means let me write down everything. So what they are saying, there are 3 years. This is 1/4/2015. This is 16. This is 17. This is 18. Number of employee was how much? Initially 2000. Then they have estimated on this date कि it will be 1800 employee. But the estimation changed to what? 1850 employee. And then again estimation changed to how many employee? 1840 employee. And they have not given actual number of employee. This is missing in the question because they have asked only accounting treatment of first year and second year in this question. They have not asked about third year. Okay. Then they have given fair value of original plan. How much given? It was initially 1.20. Then on this date it become how much? 1.30. Then on this date it become how much? 0.90. Then they have modified. Modified is 1.20. 1.05. 1.05. Okay. Then they have further said on this date the fair value become how much? 1.25. These are the information given. Now let us find out the expense. For first year, batao, expense will be what? How many employee you will take? You have three options. 2000, 1800, 1850. How many employees? Bolo. Means you have three options now. Either you say 2000, 1800 or 1850. How many are saying 1800? How many are saying 1850? This is you are not confident. ऐसे बोलो. This is not confident. This is not confident. This is confident. This is not confident. This is confident. Okay. This is not confident means in exam you will take more time. You will not be able to write only and you will say leave it. Go to other question. This happens in exam. Okay. Means if you are not confident about correct answer, you leave it. In exam, not in classroom. In classroom, so you will do unlimited time is there. Those who are saying this means they have not understood till now the concept. Till now they have not understood the concept. But we are recognizing expense at year beginning ki at year end? At year end. So which information is relevant? At year beginning ki at year end? But we calculate depreciation at the beginning, at year end. We want useful life at the beginning, at year end. Year end. Correct na? So if you are taking 1800 means all previous question you have not understood. Tukka lag gaya. Thoda sa information change and you are struggled. Understood? So all information relevant at which year, which date? At this point of time. If this is not given, we'll take assumption now. If this is not given, then we'll say this only assumption will prevail. Yes or no? Means just try to understand. Suppose you purchase one machinery. I'm just giving one bachpan wala question. You purchase machinery, cost price rupees 1 lakh. And the estimated useful life is 10 years. Correct? But you calculate depreciation at which date? Y0, Y1? Y1. But useful life is not given. So what you will assume? Same estimation will prevail na? Are bolna re? This is also estimation na? Useful life is estimation or actual? Estimation. But suppose they have given useful life is 9 years, then you will take 10 years ki 9 years? 9 years na? Then you don't take 10 years? Same year na? We are calculating expense on which date? This year. If the 1850 is given, so you will take 1850 give 1800. 1850 is given na? So this information is relevant. If this is not given, so we will assume this information will prevail. We will say that whatever assumption was taken at the beginning, same assumption will prevail. Same estimation will prevail. So quite possible कि 1850 is not given. Then take assumption. Understood? So 1850. 1850 into what is the number of option? 1000 share. Into 1000. What is the fair value? Batao. You have two options. 1.2, 1.3. 1.2, 1.3. 1. Everyone is not responding. If you are saying 1.2, say loud 1.2. If you are saying 1.3, say loud 1.3. 1.3 is not correct. I just want the whatever you are doing wrong. It is equity settled or cash settled? Equity settled. Arey, identify that now. If you are saying 1.3, it means you are doing cash settlement. Dekho, I am here for everyone. I am not here for those who are saying correct answer. I am here actually those who are saying wrong answer. So I just want to identify how many of you are giving wrong answer. You know the concept, but then also you are doing wrong because you are not thinking. Information given, you are using that information. You are saying this is at year end, so this will be also at year end. Maja aa raha hai. This is equity settle or cash settlement? Equity settle. Can you reassess? No, you can't reassess. So you will take 1.20. If it is cash settlement, then your answer is correct. But we can't change the question. Can we change the question? No. So 1.30 into 1 by 3. First you have to done. अरे 1.2 रे 1.2 ठीक है okay. How much? $740,000. Now it means in second year modification done on which date? This was 30th September. 30th September. My question to you all, EB expense you recognize on 30th September ki at year end? At year end ki at 30th September? बोल ना रे. At year end. At year end. Not on modification date. Correct? Understood. Now EB expense, यहाँ पर there will be two parts. One is original expense, one is modified expense. Original expense will be based on original plan. Based on original plan. So based on original plan, how many employee now will take? 1840. Into how many option? 1000. Into what? 1.20. Into what? 1 by 2 by 3. This you can do. How much it is coming? 15,33,333. Correct? Correct na? I was knowing it is wrong because I have done this question multiple times. 14,72,000. Please avoid calculation mistake, Baba. This is the worst mistake we do in exam. Calculation mistake. We have calculator, then also we are doing mistake. So suppose we don't have calculator, then what we'll do? We have calculator now. Don't do calculation mistake. Okay? Now, this I need to explain. So this will be same number of employee because we are recognizing expense on which date? Year end. Year end. Into what? How many options? This will also remain same. But this will be incremental fair value option. Incremental fair value option is what? This by this minus this. Means fair value of modified plan on modification date. Compare with fair value of original plan on modification date. Not on grant date. So this minus this, it will become 0.15. So 0.15, this become incremental fair value of option. And this will be recognized during remaining vesting period from the date of modification. So from the date of modification, how many year? 1.5 year. And for current year, it is for how many months? 0.5. So we'll do 0.5 divided by 1.5. This will be the answer. Have you understood? This is coming how much? Correct. Then expense, so you can find on expense this minus this will be the expense. Last year also I am explaining. They have not given the information. Suppose they have given actual number of employees 1800. Suppose they have given actual number of employees. You will say original expense will be what? 1800 employee into what? 1000 into what? 1.20 into what? 3 by 3. Modified expense will be what? 1800 into what? 1000 into what? 0.15 into what? 1.5 divided by 1.5. You can do it. One question of modification you have understood. Suppose this is a cash settlement because in one of the exam by mistake they have asked cash settlement. By mistake. Intention was not there, but by mistake they were. If cash settlement, so very easy. Then to take only what fair value of option on year end. Yes or no? Then this entire concept is bekar. Will not calculate what fair value of incremental fair value of option. Then take fair value of what modified plan or original plan at year end. And based on that, find out a cash settlement. Understood? Means at this point of time, you will take 1.50 imply and 1.30. 1.30 now. At this point of time, 1840 and what 1 point? So this information is bakwas na. By mistake in one exam they asked, actually there was no intention to ask. By mistake they have drafted cash settlement. Understood? So if they ask cash settlement, so this all information become bekar because we do reassessment at the end of each year. Understood? Correct? This also done. This also done? Only done. Only one thing is left, cash settlement, cancellation, and one more point is left, group share-based plan, share-based payment plan. These two if you do, so share-based payment is over, but I can't exceed more than 6 because some other class will start. Correct. So that two other questions, the two other concept, whatever is left, that we'll do tomorrow morning. Then we'll start consolidation. For consolidation, I just want to say, I don't know from which faculty you have done. Irrespective of faculty, I will try my level best to teach you. But there is one disadvantage because every faculty have a different style of teaching what? Consolidation chapter. Understood? But concept remains same. The format is changed. Format. Understood? So in that regard, we'll go conceptually. Format, you can follow your format. Don't change as per me. If you are comfortable with your format, follow that format. But concept remain same. Means it is quite possible I am doing deduction from working note number 1. Your faculty is deducting from working note number 5. But ultimate answer will remain same. So initially I am saying that if suppose I am saying some other point, but concept remain same. So we'll go conceptually and then we'll try to make one format which will be easy from examination point of view. And if you feel that my format is easy, you can follow my format. If you feel that no, you are comfortable with your previous faculty format, follow that only. Because in exam you are supposed to pass. Follow those format which you are comfortable. Got this point? Thank you very much for today. I hope that you have understood entire thing. I hope you have understood. And we'll meet tomorrow with the same conceptual studies. And I feel that whatever we have done, you have understood, but this will be useful only if you do all the balance question of these two chapters by your own today. So give me one promise. Today when you are reaching your home, you will not sleep because we are meeting morning 9. So you have lot of time. So today and tomorrow morning, you will complete all the balance question of financial instrument and all question of this chapter. Only two concepts we have not, a cancellation and group share based payment. Apart from that, complete all question and whatever doubt we can discuss after class. Means after 6 PM will be available. I will be available because I don't have family here. So I am alone now. I am alone, so I can be with you. So after class you can stop me. Even though we are outside the class, we can discuss now. So we can discuss. Okay. But if you complete, then only it will be helpful. Otherwise, it will not be helpful. Okay. Thank you very much. We'll meet tomorrow. Till then, bye bye. Enjoy your remaining day with studies. Bye bye. Bye bye.